लाइन दिखाते रहना, वो इंडिगो का बोर्ड दिखाना, ठीक है?
Listen, I wanna be there with you no matter where you go. Life has a table for two and we're starting the show. I'm gonna spread my wings and fly so high up above the clouds. Simple.
It's a very, very good morning indeed in the Mumbai News Centre. I am Hormuz Patakia. You're watching Power Breakfast. As CNBC TV18 celebrates 26 remarkable years, we extend our heartfelt gratitude to each one of you. Your trust, loyalty and constant engagement have been the driving force behind this journey of ours. From breaking news to deep market insights, every milestone we have achieved has been made possible because you chose to stay with us, challenge us and inspire us to raise the bar every single day. Thank you for believing in our mission, for welcoming us into your homes and for being an integral part of the CNBC TV18 family. Let's start off with the top headlines at the top of this week. Stocks on Wall Street and Friday's trading session higher as traders digested the core PCE data for September. The Dow gains over 100 points while the Nasdaq adds more than 70. The indices end off the highs of the day. Asian markets trade largely higher as investors look to ahead of China's trade data which are due later today. The GIFT Nifty is indicating a subdued start for our own markets. Crude prices are steady at 2-week highs on geopolitical risks that threaten oil supplies from Russia and Venezuela. The gold prices also gain on the optimism over a Fed rate cut this week. The aviation regulator DGCA has issued a show-cause notice to Indigo's top executives as massive flight disruptions continue. The regulator has now given them time till 6 p.m. this evening to respond, warning that failure to submit a complete and comprehensive reply on the crisis will result in ex parte action. And Biocon will be making Biocon Biologics a 100% subsidiary. The board has also approved the swap ratios for the transaction and cleared a proposal to raise up to 4,500 crore rupees through a qualified institutional placement or a QIP. And as we celebrate 26 glorious years, it's a very important week that lies ahead for our own markets and of course for the global markets as well, as all eyes will be on the US Federal Reserve. But first up, let's take a look at how the Asian markets have started off, and it is a fairly subdued picture across the Asia Pacific as well. No major directional cues. Of course, we are also counting down to the end of the year. So as the days go by, as we close out 2025, volumes would be lower, participation will be lower. The Hang Seng around about 1/3% lower. The Taiwanese index trading with gains of around 0.5%. No major moves seen across the rest of the Asian markets as well. The Nikkei is trading below the flat line, the Kospi just above the flat line, as is the Shanghai Composite. So no major directional trend that is emerging from the Asian markets this morning. To pull up the GIFT Nifty and give you an idea of how our own markets are likely to start off, and a similar trend showing as to what the Asian markets are reflecting as well. An absolutely flat start is what the implied open is currently suggesting. But to set you up for today's trade, our research team is here with the trade setup, the stocks to watch, and of course cues from the FNO side as well. First up, Vivek is here to get us all the market cues that you need to watch out for. Vivek, good morning.
Well, good morning. Quite a few events, and it's going to be an extremely important session as well as an important week, especially as far as equity markets are concerned. US markets overnight or on Friday ended with marginal gains. Oil prices largely steady. Brent now hovering around the $63.7 a barrel mark. In terms of Indian market, well, the story across last week was that while we managed to end flat both the Sensex and the Nifty, it was a significant underperformance versus the emerging market peers, and something that we would like to see reverse going forward. The other thing to watch out for, of course, will be the rupee. In terms of events to watch out for today, quite a few important events. For the first time ever, you will see a pre-open trading session as far as the F&O space is concerned. So market participants will keenly watch how that particular event transpires. Secondly, two important conference calls that will happen prior to market open, both gains after the kind of beating the stock took in the week gone by, and Biocon after the Biocon Biologics merger. The other stock to watch out for, Fino Payments Bank, they will now become a small finance bank. Wakefield IPO opens, and also keep an eye out for the entire Indian IT space. Some positive news flow coming in. Salesforce went ahead and upgraded its FY26 revenue growth guidance. On the back of that, Indian IT could see some positive takeaway. GIFT Nifty indicating a mild negative start for markets today.
Vivek, thank you for that update. Over to Ria now with the stocks that should be on your radar. Ria, good morning. What's on your list?
Well, good morning, Homer. Starting off with ITC Hotels, where a big block deal has taken place. A 9% stake has been sold off for an amount of rupees 3,856 crores. And the buyers on this front include HCL Capital as well as Nippon India Mutual Fund. Eternal will also be in focus as a big block deal is expected here as well. The seller is an undisclosed institutional investor, and they're looking to sell up to roughly rupees 1,500 crores worth of equity at a floor price of 289.5 per share. ICICI Bank will also be in focus since ICICI through AMC has filed its RHP for its IPO, which is set to open between the 12th and 16th of December. Keep an eye on Biocon as well. The company's arm has received a tentative US FDA nod for capsules that are used in the treatment of Parkinson's disease. And separately, the company is also going to fully integrate Biocon Biologics as its wholly owned subsidiary going ahead. Moving on to some stocks that will be in focus on the back of order wins and order flows. Zentech has bagged an order worth roughly rupees 120 crores from the Defence Ministry to set up combat training nodes in Madhya Pradesh. For Nugent Software, a Kuwait entity has withdrawn its tender for a process management platform tender. And for MTAR Tech, they have bagged an order worth roughly 194 crores in the civil nuclear power sector. Ashoka Buildcon will also be in focus after bagging an order worth roughly rupees 1,573 crores from BMC for highway construction. And HFCL has bagged an international order worth roughly 656 crores from a US client for the supply of optical fiber chains.
Ria, thank you for that update. And lastly, Sudarshan joins in with cues from the F&O space. Sudarshan, good morning. Back near the 26,200 mark on the index, but what's the F&O data indicating this morning?
Good morning, Harmas. Congratulations and happy 26th to each one of us as CNBC celebrates 26th year of a remarkable journey that we have had. Now coming to the market, it was a good Friday and hope it turns out to be a good Monday, though GIFT Nifty is indicating a subdued start. Now, what has led market high on Friday? The RBI's policy that has announced a cut of 25 bips led to a market sharply higher, and now 20-day moving average for Nifty has moved higher and now it's above 26,000. What does F&O data indicate? On the flows front also, we have seen FIs buying both in the index futures as well as index options. Now FIs long exposure has increased to 14% versus earlier level of around 12 to 13%. On the options data front also, on the call side, we have seen major activities in 26,400, 26,350 and 26,250 call options, while on the put side, 26,000, 26,100 were the most active ones. So support for Nifty is now at 26,000, that is 20-day moving average. Resistance 26,300 for Nifty Bank. Support would be around 59,000 and resistance would be around record high of 60,000.
Sudarshan, thank you for those updates there from the F&O space. The other major talking point over the last week has been Indigo, where the DGCA has now issued show cause notices to Indigo's top brass as massive flight disruptions continue. The regulator has now given the airline time till 6 p.m. this evening to respond, warning that a failure to submit a comprehensive and complete reply on the crisis will result in ex parte action. Madhya is joining in with latest on this. Madhya, good morning.
Well, Hormuz, you're right. This is a crisis that India has never seen before, Indigo has never seen before, and Indigo would never have anticipated that it will, see itself in this kind of chaos. It all started, or rather the cracks started showing up on the 2nd of December when flights started cancelling in large numbers. And so far, Indigo has cancelled at least 6,000 flights, impacting nearly 9 lakh passengers across different airports. And we've been seeing visuals on social media of how passengers are very, very severely impacted due to these cancellations. Operations are now stabilizing. CEO Peter Albers said yesterday that they operated 1650 flights. Their daily operations are about 2,300. So he said they operated 1650 flights on Sunday, which is yesterday. That still meant that there were over 500 cancellations. So operations are slowly stabilizing. Of course, it will take time for them to normalize operations. What also came out from the aviation ministry yesterday was refunds worth over 600 crores have been processed, and the airline has been able to return about 3,000 bags to passengers, because all these cancellations led to lost bags. People's baggage was stuck across airports. So 3,000 bags have been returned to passengers, and refunds worth 600 crores have been processed so far, is what the aviation ministry gave out in the statement. Regulatory pressure, as you mentioned, has been increasing. Indigo was given 24 hours. Indigo CEO and the COO were given 24 hours by the DGCA to respond to a show cause notice. They wanted more time. They asked for another day. So today is that deadline, 6 p.m. Today is by when Indigo CEO has to appear before the DGCA and explain why they failed in ensuring reliable operations. And if they fail to do that, it will lead to an ex parte action by the DGCA.
Madhya, thank you for that update there. All eyes will remain on Indigo. We'll take a short break. All the action from Wall Street on the other side. Stay tuned.
My heartiest congratulations to CNBC TV18 for completing 26 years, and to you, Shriram, for your 25th year completion. What an incredible journey that you all have had. This journey has resulted in you establishing yourself as the most credible channel for business news in the country.
Years of CNBC TV18.
My father used to perform, then second brother traveled, then third brother traveled. But somehow, in between, they were not serious, or they didn't give enough time. So all my father's friends, father's disciples, अब तुम्हें ही करना है, you have to do, you are the Khalifa and you have to do that. So to make me realize my responsibility. But I could not, because of that I could not enjoy my childhood, the freedom of childhood. My father did not want me to go to school. He didn't believe that it's necessary. वालिद साहब हमारे कहते थे हम एक जीवन में एक ही काम कर सकते हैं. You can't do everything. या स्वर को समझ लो, स्वर का मतलब the sound, the music, या किताब को समझ लो. And because my father was most revered and respected and very popular, and he was called Aftab-e Sarod, prophet of Sarod, Sarod wizard, and this and that. तो उस वजह से मुझे भी लोग बचपन से बुलाने लगे. I mean, I must have been, but my first concert, according to my biography, I was 6 years old when I was pushed onto the stage. सूली पे चढ़ा दिया जैसे. तो ग्वालियर की एक ऐसी हिस्ट्री रही. ग्वालियर produced many musicians. I mean, legendary Tansen. Mia Tansen was born in Gwalior. His samadhi is in Gwalior. और लेकिन वो माहौल, यानी आज का जो माहौल है ग्वालियर का कि हर आदमी एक नेता बनना चाहता है, अब वो साधना वाले लोग अब वहाँ नज़र नहीं आते. तो हम भी 1957 में वी शिफ्टेड टू दिल्ली. तो आज जो कमानी हॉल है, रविंद्र भवन है, हम लोग वहीं रहते थे पहले. वहीं था भारतीय कला केंद्र.
26 years of CNBC TV18.
Welcome back. On to action from the US markets. It was a fairly subdued session there as well. The indices ended in the green, managed to eke out weekly gains. But on Friday's session, the indices mainly ended off the highs of the day. The Dow was up 100 points, but that came off around 200 points from the day's high, as did the S&P 500 and the Nasdaq. The inflation data was in line with estimates. The Fed rate cut hopes are still intact. 87% is what the probability currently indicates. So all eyes will be on the Fed. The decision comes out late Wednesday night or, of course, Thursday morning Indian time. Now, the other major talking point on Friday was the major deal that Netflix announced with Warner Brothers, a $72 billion deal, and US President Donald Trump has weighed in on that proposed merger. Now, speaking to reporters on Sunday, he said that he expects to have a say in whether or not that deal should move forward. Listen in.
I met with Ted. I think he's fantastic. I think he's, in the history of Hollywood, has really been almost, you could say, nothing like what he's done. He'd go back to Louis B. Mayer, maybe, Metro Goldwyn Mayer, MGM. Ted has done an incredible job. I mean, he had a company that was very troubled 7 or 8 years ago, and he took it over, and he's really done a legendary job.
Should they be allowed to buy Warner Brothers? Should Netflix?
Well, that's the question. They have a very big market share. And when they have Warner Brothers, you know, that share goes up a lot. So I don't know. That's going to be for some economists to tell. And also, and I'll be involved in that decision too.
Did they make?
They have a very big market share.
Did he make any guarantees to you about the merger if they do merge? That
No, not at all. He came up. He was in the Oval Office last week. I have a lot of respect for him. He's a great person. But he's done one of the greatest jobs in the history of movies and other things. And he's got a lot of interesting things happening aside from what you're talking about. But it is a big market share. There's no question about it. It could be a problem.
Donald Trump on the Netflix Warner Brothers proposed merger. Take a short break. Cues from the commodities market on the other side. Stay tuned.
"26 years of CNBC TV18.
और यानी वहीं से बंगाली मार्केट, दैट मंडी हाउस एरिया, सो वी यूज्ड टू लिव देयर. तो while
26 years of CNBC TV18.
Welcome back. Now, a US trade delegation will visit India from the 10th to the 12th of this month to push forward talks on the first tranche of a bilateral trade agreement. Sources say that the team will be led by Deputy US Trade Representative Rick Switzer, with India being represented by Joint Secretary Darpan Jain. While this isn't an official negotiation round, both sides are aiming for strong progress on the tariff issues. And Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. What's on your radar today?
Well, thank you for that, Hormuz, and a happy 26th to you as well for CNBC TV18. What I am looking at is the crude oil prices to begin with, because we're trading at a two-week highs right now, back above 60 for WTI and 63 for Brent as well. We do know that the US-Russia talks on Ukraine peace deal have failed to produce a breakthrough. There also is a possibility of a US military intervention in Venezuela, and the markets are absolutely, expecting a US interest rate cut this week from the US Fed, and that clearly seems to be supportive, not just of crude, but the gold prices also, which are trading at October highs, silver, which is trading near all-time highs, and the U.S. copper prices, which are trading at a 4-month highs as well. Well, the large withdrawal of metal from LME warehouses and the fact that perhaps U.S. could put in taxes for refined copper are some of the other factors which are keeping copper prices on the higher side.
Manisha, thank you for that update, and a very happy birthday to you as well. Take your leave on this edition of Power Breakfast from me and the team. Thank you so much for watching, but don't go anywhere. On this very special occasion, we have a very power-packed lineup all through the day. Bazaar Morning Call on the other side to set you up for the day's trade.
26 years of CNBC TV18.
Putin's agenda for New Delhi. Parikshit.
Keep chasing the sunshine and go out and play.
Happy 26th birthday.
भी लगाएगी तू देखो है तो देखो
Happy 26th birthday CNBC TV18 from the crown.
लाइन दिखाते रहना वो इंडिगो का बोर्ड दिखाना ठीक है
Listen, I wanna be there with you no matter where you go. Life is a table for two, and we're starting the show. I'm gonna spread my wings and fly so high up above the clouds.
Simple.
Well, happy 26th birthday to all of you, all our viewers, to all of us. Nigel, Reema, morning. Happy birthday.
Happy birthday, guys. And today is not just any other Monday morning, right? It's a milestone. It's 26 years of news, analysis, bull markets, recession, policy shifts. We've seen war. We've seen technology disruption. I think CNBC TV18 has lived through it all. And thank you to all our viewers.
Well, that's right, 26 years. I'm so excited. Goosebumps, guys. You know, 26 years. I've been happy to be part of the family since CNBC TV18 went into double digits. Been here for 15 years. Thank you to all the viewers, you know, and since the morning, whether it was the dress dada or the makeup person or our PCR team who's talking to us in the year, well, whoever you asked, they said, we have been here 15, 20, 22, 23 years. So we have evolved as a channel and we thank all of you all out there. You know, what a journey. I love you, CNBC TV18.
Oh, that's nice. And I guess one of the reasons why this place is special is because the teams are almost, I mean, it's unbroken from so many people here, as you said, 10 years, 15 years, 20 years.
I've been here longer than both of you.
Put together?
Without sounding old and giving away my age, but I've been here longer.
Just to carry that forward. You know,
quick game. How old were you? 20? No, okay, I should ask you that.
I mean, we've come here as spinsters, bachelors, you know, got married, had our kids, you know, seen each other evolve over here. CNBC TV18, what a special place. Glad to be part of you, and let's go from strength to strength. And thank you all our viewers, because without you all, we wouldn't be here.
Indeed, thank you for watching, thank you for believing, and thank you for making CNBC TV18 your window into the markets for 26 whole years.
Oh, absolutely. And I think, you know, why not rewind the clock back a little bit, right? And just look at the journey that we have traveled together. And that's what we're going to do here. 26 years ago, CNBC TV18 went live. And India's markets were a completely different universe. Even as we sort of complain about how this year has been a tough year, why not take you back 26 years to tell you the shape, size, structure, and of course the returns that we've seen together during this incredible period. Let's take a look at the massive reset which is played out. And let's start by looking at the size of the market itself. From under 5 lakh crores, which was the total market capitalization of the NSE when CNBC TV18 started, to now over 470 lakh crores in market cap. It's been an incredible 100-bagger in 26 years. I mean, just look at that. 4.9, not even 5 actually, from 4.9 to 472 lakh crores now. So that just tells you, I mean, I think so many things go into that 100-bagger, the making of the 100-bagger, right? But let's look at some of the numbers. The number of companies listed has also grown nearly 5 times in this period. Look at the growth that's a number, 648 companies in 1999, 2,883 companies as we speak at this point in time. Now, trading activity, right? This is cash market daily trading activity. Used to be 1,650 crores 26 years back. We are over 1 lakh crores in daily average turnover as we stand. Well, perhaps the biggest structural change, the financialization of India. If you look at mutual funds share in household savings, and I sort of went back and looked at data from when it was available, it was 0.9% in 2011-12. I couldn't get data all the way back in 99. It stands at about 6% plus in 2000 as we wrap up 2025 today. And of course, I mean, you know, as many, and we also believe that this journey is just about starting. From barely 20 lakh demat accounts in 1999 to more than 14 crore demat accounts today. And these are unique accounts, investor accounts that I'm talking about. The journey's been incredible. From almost no SIP culture, systematic investment plans, that's basically become the bedrock, the foundation for the money which is coming into this market, to now basically every month crossing 20,000 plus crores. This is a market no longer owned just by institutions or only by institutions. It's a market largely owned by India's households. Let's go back to the Nifty 50 itself, right? I mean, the OG, as the youngsters would call it, before the Y2K hit. 50 names that told the story of old India. You can see it. Do you recognize some of the names? There's Ranbaxy there, there's MTNL there, so many PSUs. OBC, Oriental Bank of Commerce, as you can see, was part of the Nifty. IDBI Bank was part of the Nifty 50. EIH Limited. I mean, the composition has changed. That's what the Nifty looked like 26 years back. Now, of course, it's different, right? There are, by the way, only 17 of the 99 Nifty 50 constituents which survive today in the Nifty. On your screen now, the survivors, the 17 of the original, which are now part of the Nifty as well, as we look at it at this point in time. Now, let's just take a look at the, the size of the average company in India, listed company in India. Look at large cap, mid cap, small cap. What I've done is I've taken the current definitions of what is a large cap, what is a mid cap and small cap for comparison's sake, like-to-like comparison's sake. So top 100 is large cap, next 150 is mid, that is mid cap, and everything, after that, which is 251st onwards is small cap. Let's take a look at this. In 1999, the top 100 companies made up 87% of the total NSE. It's 60% right now, right? That's one. The largest stock back then in 99 used to be HUL with a market cap of 50,000 crores. The largest company is Reliance with a market cap, not current, but at the end of November, is Reliance Industries, 19.5 lakh crores. So basically, what I've done is I've taken average market cap for 3 months, back in 99 and for 2025 as well. And that's Reliance at 19.5 lakh crores. Now, mid-caps make 20% of the NSE now, while back in 99, that is 26 years back, they were just 9%. The largest mid-cap used to be Gujarat Gas with just an 800 crore market cap. Think about it. Largest mid-cap, 800 crore market cap. The largest mid-cap today is 125 times that, DRL, with 1 lakh crore in terms of market capitalization. Small caps now make up 20% of NSE today. Guess what they were? 4% back then. The largest small cap was a company called Foseco India with a market cap of 150 crores. We're talking about tens of thousands of crores for small caps now. ACC with 35,000 crores in market cap today is the largest small cap in that sense. I'm just going by SEBI definition as it stands right now. Well, markets ultimately follow earnings, and India Inc.'s earnings story tells you why this bull market is legs. And I think the numbers will come up. And I've just looked at phases, right? Between F5 of 2005 and 2010, EPS grew at a CAGR of 11%. Then came pretty much like a lost decade, which is FY10 to FY15. There was just 3% recovery, followed at 6% between FY20 and between FY15 and FY20. And then, of course, we've seen this COVID and post-COVID breakout. EPS has grown at a CAGR of 20%, nearly 20% between FY20 and FY25. This is the strongest earnings acceleration in 2 decades. I will end with an asset class return table. Over long-term, equities have delivered. The Nifty is compounded at over 12% for 26 years now. That is the CAGR. It's beaten gold. It's beaten, of course, fixed income as well, basically beating every other traditional asset class. That has been the compounding story as far as equities is concerned. So that's a 26-year journey. Just a brief look back at, and there are so many ways to do this, but I just looked at a few matrices which tells us the story about what has happened over the last 26 years now, and what an incredible journey it has been. Well, Nigel has walked across to the, okay, I think, Rima, next 26, you want to take a shot?
But it's absolutely incredible, right? Markets were so much smaller. Information didn't move as fast, much slower.
Yeah.
And India's investing culture still hadn't taken shape. But that's been the journey over the last 26 years. And CNBC has helped shape so many of those conversations which made those decisions. But a quick check on Asia before we get to Nigel. Asia is a mixed picture this morning. You've got the Hang Seng, which is down about 0.5%. Nikkei is flat. We had the July to September the GDP print, and that disappointed for Japan, coming in at a contraction of minus 2.3%, worse than what the street was anticipating. But on the flip side, Taiwan is holding up 0.6% higher, and Kospi, which has had a banner year with a 70% up move, continues to chug along higher. GIFT Nifty, on the other hand, is pretty much flat. But Nigel, what are you looking at?
Well, over the longer term period, if you look at the last 26 years, on an average, you get returns of close to 11 after around 12% on the Nifty, which isn't bad. And hopefully the next 26, we can move maybe to mid double digits as well. So that's just about history. What happened in Friday's trading session? Well, you had the institution numbers that were positive. Yet again, the FIs were mild sellers, not too much though on that front. The FI data actually in the futures market is encouraging, because if you look at the stock futures, they added more longs than shorts. And even on index futures, well, they added more longs than shorts. Remember, this market is still net short, with more than 80% of the positioning on the short side on index futures. So you have shorts in the system. And now the data points that are coming in there, both on the futures data, as well as if you look at the option side, they bought more calls than puts, and they wrote more puts than calls. So that's giving you a sense that maybe, in fact, in the near term, even the FIs don't expect the markets to see a big correction from here on. Quickly moving to the options data, then you had a couple of strikes that were very, very active. The 26,400 call, good amount of open risk build up. That appeared there was some out of the money call buying out here. So, someone taking a bit of a pound, if you get that trade deal, or if the markets want to take off from here on, then you'll make some money on that front. And the 26,000 put, from the start of the week has been seeing a lot of writing. At the start of last week, the premium was close to around 100 rupees. That's come down to around 20 rupees, which is telling you that 25,900, 26,000 markets extremely important on the downside, while the recent high at around this 26,326, that becomes a near-term resistance. The Nifty Bank, that's the one that's been leading the way. And now you have the 20 DMA, that's at around that 59,000 odd mark, so close to around 750 points away from current levels. A couple of stocks that we'll be tracking in today's trading session itself. You have Keynes Technology. I recall in the final hour of trade on Friday, I said there's a possibility that this one goes into the F&O ban. Well, that's precisely what's happened. It's moved into the F&O ban. Massive selling that we saw. Remember, they have a con call, so we'll keep an eye out on this one, whether or not the management can come out with some clarification. And a couple of other names that have newly listed. The lock-in period does open up close to 2% of the total shares that are outstanding. They are eligible to be traded. So Pine Labs as well as Lenskart, because of the unlocking of that cool-off period, shares will be freely tradable. So I'll keep an eye out on both these two.
Indeed, for Pine Labs, about 500 crore is available. I mean, the lock-in ends. And for Lenskart, about 1,700 crore. But it's going to be such a busy IPO week. We've got a rush of IPOs, 5 of them. One of them is Wakefit. They're looking to raise about 1,288 crore. Corona Remedies, Nephro Healthcare, Park MediWorld. And the big one will be ICICI Pru, which is looking to raise about 10,000 crore rupees plus. IPO opens on Friday. But lots to track, plenty of action with the Fed, the INR, what's happening with single stock actions like Biocon and Interglobe Aviation. So straight away, let's first talk about the global macros. Drew Pettit, Director of U.S. Equity Strategy, ETF Analysis Strategy Research at Citi, is now joining in. Drew, great to have you. Thank you very much for joining us on this special day. CNBC TV18 turns 26. Well, the big event to watch will be the Fed outcome. Wednesday night. So India reacts only on Thursday. But it looks pretty much like a done deal. We're going to get that rate cut. Will it be such a market-moving event? And what would be the signals you will watch, considering that perhaps next year you will be having Kevin Hassett at the table?
Yeah, so first off, I have to start with happy 26th birthday to everyone at CNBC TV18. And look, just to jump right into it now, like the Fed, 25 basis points for the next meeting is probably priced in by the market. We saw the market price that out leading into December, and that's been priced back in. What we really want to watch out for is that path of cuts into next year. Our economists and team expect 25 basis points, I believe, at the next 4 meetings after December. But the key to us is, do we get those cuts? And are we actually going to get weakness in the U.S. economy, or will it be resilient? If it is, that's a soft landing setup for next year. You should get follow through, not just in the growth side of the market, but some of the cyclicals where earnings growth might actually improve as well. So to us, that soft landing narrative is really key to broadening beyond just mega cap growth in the United States.
Drew, hi, good morning. S&P is up 12% year to date, 17 days to go to wrap up 2025. Typically, I mean, trading activity, etc., trails off, starts to drop off when, Drew? I mean, 10, 15 days usually is like a bit of a, low volume part of the year, right?
Yeah, that's pretty typical. And it's funny, everyone talks about seasonality, that you get this rally into the end of the year. In a sense, you're not going to get a lot of new data. So whatever people have been trading, they do continue to trade that way through the end of the year in the United States. To us, look, sentiment's very high. It's very strong. It's been like that for about 6 months now. And that's unlikely to break. That probably means the S&P 500 is going to end up something, I would say, above our base case that we set in mid-year. And it could threaten our bull case of 7,000. Look, somewhere between 6,600 and 7,000 feels about right for the S&P. Again, you probably don't have a ton of news outside of the Fed to really change people's behavior in the last 2 weeks.
All right. Hi, Drew. Good morning, and thanks a lot for the birthday wishes. I thought you'll do a little bit of a jig for us, Drew. You know, it's our birthday. But getting back to the markets, I think your preference was developed markets, right, over emerging markets. Do you stick to that? And where does India feature in? I think you were talking about a better entry point. Do you think that entry point has come about? India has gone through a long period of underperformance, and a bit of consolidation.
So I'll start with the last question first here. Look, we're still neutral on India. The last time I was on, we talked about a really good growth setup. I think you guys touched on that in your open to the show. Look, that hasn't changed. We still believe the growth story. The valuation story also hasn't changed. So you have priced in a really good earnings and growth backdrop for India, so it remains neutral to us. But more broadly, we're actually overweight EM in our global strategy in our allocation recommendations. So look, we pair Europe ex-UK as the cyclical area of the world we want to be overweight. Think there's inflecting growth there. The whatever it takes moment has kind of happened or at least been talked about in Germany, for example. So we like those markets for value. On the growth side, EM is actually a way to get growth and AI exposure at a pretty reasonable price. And we lead the overweight in EM with China and South Korea. When you look at some of the names that screen in our AI at a reasonable price basket, you're going to get names like Baba, Tencent, SK Hynix, and Samsung even. So look, you can get AI at a reasonable price in EM, China, South Korea. That leads our overweight there.
Okay, so China, Korea are overweight on account of the AI exposure. India is a neutral. So your thesis is that tech momentum will continue into 2026. And back to India, what does the currency weakness signal as macro indicators? I mean, that's one of the reasons why India has had one of the worst years of underperformance versus other emerging markets. MSCI India is up 2%, while MSCI emerging market basket is up 27%. That's an underperformance of 25%, and partly on account of currency.
Yeah, look, I'll keep this high level because, again, equity strategist here with you, but the tie together here is perceived tariff risk. And that's relatively high when we look at our models across EM. It's higher for Mexico. It's higher for India. I think the first relief valve for tariff concerns for any trader, global macro traders, is going to be the currency.
Drew, we'll leave it there. Thank you very much for coming on. Appreciate your time here on CNBC TV18. And wonderful speaking with you, as always.
Great seeing you all. Happy birthday once again.
Thank you very much. Thank you. Markets here, as we look back at 26 years, and I started by saying that even as we complain about how tough this year has been, and this year has been pretty tough.
Sure.
I mean, it's only fair that people at the S&P is up 12% and people there are also complaining. Here in India, in rupee terms, we're up 2% for the year. So there is actual real cause for concern, and especially in the broader market. People are a little frustrated, and that common refrain is that paisa nahi ban raha hai, right? I mean, I think, so you need a trigger, and that trigger which markets were waiting for is not materialized is the US-India trade deal. So I just want to, for our viewers, and not to get hopes high or anything at all, but a US trade delegation led by Deputy USTR, Rick Switzer, is going to be in India this week. They're going to be here 10th to 12th. So I just wanted to sort of, put it out there that this market needs something to turn sentiments around a little bit. And RBI, of course, sounded much more dovish than expected, and that helped the market turn around post that stage, that recovery on Friday, etc. But you need something more durable to kind of latch on to, and this one is going to be closely watched as we go forward.
But they've also said that this is not the official negotiation round, but it's a positive that conversations are happening.
No, it's about tariffs, not the BTA. So they're going to talk about the tariffs, the actual 26% penal tariffs. But the BTA is going to take time, as I think the Commerce Secretary told Shireen as well. Well, let's just quickly run you through the interactions which are lined up here on the program. So as CNBC TV18 celebrates 26 remarkable years, catch the biggest and most influential voices all day today. We have Nilesh Shah of Kotak Mahindra Asset Management Company, Ramesh Damani of BSC, Manish Chokani of Enam, Samir Arora of Helios, Ashish Chauhan of NSC to talk about their take on the market and the way forward through the day. Catch top industry voices, N. Chandrasekharan of Tata Sons, Ramesh Swaminathan of Lupin, Rajiv Bajaj of Bajaj Auto, Sanjeev Goenka of RPSG Group, and more. Join us as we sort of ask them what they've made of the journey. Very closely linked, of course, with growth of India's corporate sector, markets, all of it documented and shown here on CNBC over the last 26 years or so. It's a action-packed day. It's a sharp lineup. Shailesh Chandra, Sunil D'Souza, Navneet Munod, Sunil Singhania, Abhijit Roy, and more. So those are voices you will hear through the course of the day on CNBC TV18.
All right, well, time to slip into a short break. On the other side, we'll go full throttle on all the stocks we're going to be tracking for you in our special Top 10 segment.
Years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. It's time now for CNBC TV18's list of top stocks for the day. And first up, it's going to be Biocon on our radar. Ekta joins in with the news.
Well, yes, Biocon is in focus because they did announce the big news over the weekend. Biocon is going to make Biocon Biologics a 100% subsidiary. They're going to be doing that by issuing shares at 405.6 rupees per share to Biocon Biologics shareholders. Now, the total equity dilution will be around 17.1 crore shares, amounting to around 6,951 odd crores in terms of the share swap. They will be needing an additional 400 million to pay Mylan, which is around 3,600 odd crores, to buy out the entire stake. Now, the company has already taken approval to raise funds of up to around 4,500 odd crores. Biocon Biologics is going to be valued at around $5.5 billion as per the company. You're going to see around a 13% dilution in Biocon shares. This is only with the share swap. Shriram will hold around 3.6% stake in Biocon, which is only with the share swap, and Mylan around 6.09% stake. The promoter holding is going to fall to below 50%, around 44% if you count in the QIP dilution as well. Couple of key points to note. The holding company discount is going to go away for Biocon going forward. The overhang will probably remain on the QIP funds, which they need to raise up till the 31st of March, and net debt of around $1 billion. But the company has indicated that the EBITDA and the EBITDA growth should be sufficient enough going forward to cover the debt obligations. The analyst call is going on, so I think the commentary is going to really determine how the stock moves. But let's see. It seems as though the commentary is basically maybe a little bit of the QIP overhang could weigh, but the debt concerns is possibly assuaged at this point.
Okay, all right, Ekta. Thanks a lot for that. Well, let's hop across to Madhya to tell us the latest on Interglobe Aviation. Morning, Madhya.
Well, Indigo is going to be the stock in focus. It's a big day, a very, very crucial day for the airline today. The CEO and the COO have been given time till 6 p.m. Today to respond to the DGCA with a comprehensive, response on why the disruptions have happened at the airline. Indigo is the backbone of India's aviation. It controls about 65% market share of the Indian aviation market, and which is why we've seen that some decisions taken by them, some misjudgments that they caused such a large-scale disruption. Since December 2, 6,000 flights were cancelled, hitting hard about 9 lakh passengers, and we can see so many videos surfacing on social media of passengers stranded, affected across Indian airports. 1650 flights is what they operated, is what they claimed yesterday. And of the 2,300 flights they do, I think the cancellations are still over 500 on a daily basis. So operations, there are signs of operations normalizing, but it is still going to take some time. Big day today for Indigo. They've also set up a crisis management committee internally to look at the cancellations and to look at normalizing operations. They've processed refunds worth 600 crores so far, and they've returned bags, about 3,000 bags have been returned to the passengers, what the aviation ministry has informed. But big day today, all eyes will be on what the Indigo CEO and COO tell the DGCA.
All right, Madhya, thanks a lot for that. And we'll keep coming back to you all through the day to get us the latest on that front. Thanks for joining in. Well, another big stock of the day is going to be Fino Payments Bank. Ritu joins us to give us the latest on that front. Morning, Ritu.
Good morning, Nigel. Fino is going to be very much the stock of the day as well, finally securing that much-awaited in-principle note from RBI to convert into a small finance bank. And if all goes to plan, it is officially going to be the first ever payment bank in India to make this kind of a transition. Now, remember, they only got their payment bank license in 2017, so this marks a big shift in their journey. For now, they're going to keep operating as they currently do until the final small finance bank license comes through. In terms of what changes, quite a lot if they become a small finance bank. One, and the most important, is they can finally start lending. They can take full unrestricted deposits. They can operate pretty much like a full service bank. They also get the green light to open branches from day one, although a quarter of those will have to be in unbanked rural areas within a year. They also have to meet key regulatory milestones like hitting 300 crores of net worth requirement within 18 months. They'll have to keep 15% capital also comply fully with CRR, SLR norms, just like banks do. There's also the big condition for shareholders where large investors will have to pare down their stakes within 18 months to comply with SFB shareholding norms. But overall, this opens the door for them to evolve from just a payment-only digital player into a full-scale lending-capable bank with a much wider product range and customer reach. So going with green with that stock.
Indeed, thank you very much for that. The stock was up 3.5% on Friday as well. Vivek is now joining in to tell us more about the large deal expected in Eternal.
Well, that's right. Expect a large trade to happen, and most likely this will happen in the block deal window itself. As per the term sheet we managed to access last evening, an undisclosed institutional investor. We understand this could be a domestic mutual fund. We are expecting close to 0.5% of the total equity to go ahead and change hands today. Up to 1,500 crore will be the total size of the block. Floor price is at almost just a 1% discount, so 289.5 rupees a share. Now, one thing to note is that come today when it comes to block deals, instead of just having a 1% move that will happen in the block deal window, plus or minus 3% stock moves or floor price can actually happen in the block deal window. So expect this particular trade to happen in the block deal window, and post which you may see some recovery coming as far as the Eternal is concerned.
Okay, all right, Vivek. Thanks for that. Well, let's move across to Sudarshan. He's here to give us the November insurance data. Morning, Sud.
Good morning, Nigel. So it's a mixed business update from general insurance companies for the month of November. So we'll start with ICICI Lombard, which has seen a growth of 7% in the premium for the month of November. But if you take a look at April to November data, the growth is just 2%. Even company has lost market share of around 50 basis points year on year. Next is New India Assurance, which has seen a healthy growth. It's growth of more than 10%, but it's much below the industry average of around 22 to 23%. And April-November period, the growth in the premium is up to 13%, and it too has gained market share of almost 60 basis points. Niva Bupa though has seen a healthy growth of almost 47% in premium for the month of November, and for April-November period, the growth is up 18%, and market share it has gained 18 basis points. So I'm going with green for Niva Bupa and red for ICICI Lombard and New India Assurance.
All right. So thank you very much for that. PG Electro Plus is the next one. Upasana is here with details on this one. By the way, if you remember on Friday, so many of these EMS companies, starting of course with Kames, but PG and Amber and Sirma, all of them sold off. Upasana, tell us more.
Good morning. Yes, so the stock remains in focus as the company has clarified to the HDFC Securities note, which highlighted some of the key concerns in terms of the company's financial health and long-term stability. Now, company states that the article contains certain statements and observations that are factually inaccurate and not reflective of the company's actual financial position. Company has also clarified that it has consistently complied with all the applicable disclosure requirements and all the material information required. It has also emphasized that there are no undisclosed material developments concerning the company's financial health, business operation or expansion plans. And lastly, company's audited financial statement and results are accurately represented the financial position of the company is what the company is indicated. So this stock will certainly remain on our radar today on the back of this.
Okay, so the company pushing back on claims and saying that the balance sheet is in okay condition. That's PG Electro Plus. Let's see whether it rebounds after the fall that it had on Friday. Ria now joins in to tell us more about Ashoka Buildcon and NBCC.
Well, yes, starting off with Ashoka Buildcon first, the company has received additional orders worth roughly rupees 447 crores from the BMC for the Sion Panvel flyover. Now, as a result of this, the aggregate cost of the project has gone up to roughly 1,574 crores, and the total execution time has now been revised up until January 13 of 2028. Moving on to NBCC, this company has sold 175 residential units at the Aspire Leisure Valley in Noida for roughly 485 crores. So positive news flow for both of them expected to open in the green today.
Thank you very much for that. I'll also be tracking Yatra and Ease My Trip to see or assess if there is any first order impact on account of Indigo's cancellations, because a lot of the bookings happen through these OTAs. So keep your eye on these companies. A quick recap then of the top stocks. Stocks with positive news flow are Biocon, Fino Payments Bank, Niva Bupa Health, PG Electroplast, Ashoka Buildcon, NBCC. Stocks with negative news flow are Interglobe Aviation, Eternal, ICICI Lombard and New India Assurance.
Time to slip into a short break. On the other side, Dharmesh Kant of Chola Securities will be joining in for some fundamental stock talk.
My heartiest congratulations to CNBC TV18 for completing 26 years, and to you, Shriram, for your 25th year completion. What an incredible journey that you all have had. This journey has resulted in you establishing yourself as the most credible channel for business news in the country.
Twenty-six years of CNBC TV18.
Welcome back. You're tuned into Bazaar Morning Call, and as promised, we have Dharmesh Kant, Head of Research at Chola Securities, who joins us on the show. Hi, Dharmesh. Good morning. Good to see you again. Well, Dharmesh, let's discuss a few stocks. Top of mind is going to be Biocon. You know, unexpected lines, or what the street expected, was Biocon Biologics business now has come into Biocon. It's going to become a 100% subsidiary. The equity base obviously goes up because of additional amount of shares that will get issued. But what's your take on it? That holding company discount goes away, the leverage appears pretty okay, but there's a QIP as well overhang. Put everything together, your view on the deal.
Yeah, good morning, Nigel. First of all, happy birthday to you all at CNBC TV18 for 26 glorious years of unmatched excellence. And what is outstanding, Nigel, is that it's not only about unmatched excellence, but living up to the inch of expectation every day when you log on to your channel and kudos to all of you. Yeah, coming back to the Biocon thing, I think if you look at Biocon, it's always been a overhyped kind of a company with much of expectations built into it. But last 10 years, if you look at the numbers, they've done hardly on the profitability part. 9 to 10% kind of a growth has been, that's the best kind of a growth they have delivered. At the same time, the ROEs have been a mid-single digit. With this merger coming into play, it's not that it's value accretive or EPS accretive. I think it's EPS dilutive. First of all, the QIP itself will take care of the dilution. Secondly, there are certain expenses will go up because of the debt burden which will come into play. So 1 year or 1.5 years will go into this entire synergy to play out as per, Biocon's order. And the fact that they are doing this because they feared value. I mean, instead of unlocking it would have been value dilutive if it would have gone for, IPO proceed. So those are the caveats in place. Business will continue as usual, nothing great out there. So to my mind, I think I am expecting some sort of a correction on Biocon, and the correction is likely to stay for a year or so till things they come to the double-digit kind of a growth trajectory.
Dharmesh, hi, morning. Good to see you here on this special day. Just a quick word on, Upasana, I don't know if you heard, put out this information on PG Electroplast, but my question more was Keynes and actually what happened on Friday. Keynes, of course, is a singular case with specifics there, but market really taking the axe to some of the others as well.
Yeah, good morning, Prashant. I mean, it's more to do with the entire EMS play business-wise. There has been a deceleration in the entire EMS space that we have seen, be it PG Electroplast or the others in the play like Keynes, Dixon, Amber. Everybody is facing the heat of decelerating business growth trajectory. At the same time, valuations are not at all comfortable. They are pretty high. And there is a competition hitting up going forward maybe in the next couple of years by L&T when they foray a big time into this space. So these were already riding onto the play. Keynes, I think that speeded up the selling pressure out there. And with PG Electroplast in particular, the much depends on the transfer technology tie-up with the Chinese company when it gets through. Still, the permission is pending. If that happens, then definitely it will be a different story in the entire EMS space to play out, because compressor technology of the AC is still elusive to Indian manufacturers. So that stands out. But to my mind, I think we can have, today the con call is there, you can have bounce back on some of these stocks, but it would be a bounce back rather than, a structural play into the making. So our call is to avoid the space for some time.
Stock down 43% year to date. Dharmesh, thank you for joining in. Short conversation today, but thank you once again for being a part of CNBC TV18's journey. Now, moving on, Persistent Systems is the first management on the show today as CNBC TV18 celebrates 26 years of leadership. We have with us Sandeep Kalra, CEO and Executive Director at Persistent Systems, joining in. Sandeep, thank you very much for joining in. We're thrilled you're joining us on this special day. The big debate right now is on whether what we're seeing in the global markets with respect to AI is a bubble. Whether all the investments that are going in will be productive, or will we see a crash similar to the dot-com crash? What is your view? And what is the impact you expect on various constituents, whether it's NVIDIA, Microsoft, to startups, and even services companies like yours?
Sure. So first of all, Rima, it's a privilege to join all of you today for CNBC TV18's 26th anniversary. Congratulations to all of you, the entire CNBC TV18 team, for making the channel a trusted voice for all of us. Now, coming back to your question, my short answer is AI is not a bubble. It is, again, there are two different things that we are talking about. One is the technology, the adoption of the technology, the impact in the longer run. The second is the valuations. Now, obviously, valuations is, more, you can find more experts than me, but if we were to look at, in your parlance, the 3-4 constituents. So on one side, we have the chip manufacturers, like the NVIDIAs of this world, the AMDs, the Googles, the players like Broadcom who support all this ecosystem. In our mind, short to medium term, they're the biggest gainers because there's a lot of data center setup and many other things that are happening. And if you look at their order books, they are booked out for the next year, 2 years, and so on. So as far as the AI chip player is concerned, this is less of a bubble, more of a super cycle. Again, I'm not talking valuations. Valuations, there are other experts. If you look at clouds and cloud part, hyperscalers, the Microsofts, the Googles, the AWS, and so on, these guys are spending hundreds of billions of dollars in capex over the years. But they're also monetizing all of this through AI cloud services, developer tools, co-pilots, ads, commerce, depending on their business models and so on. So there is definitely a real revenue for them, real profitability that is being built over a period of time. So there is that component as far as they are concerned. And don't forget, as the enterprises consume AI, build more AI apps, they're going to consume more of Microsoft Azure, more of Google GCP, AWS, and so on and so forth. Now, if you look at the tech services companies like ourselves, we are going to be winners in the longer run on this, because having technology is one part, taking that technology in an enterprise context, building the business use cases, building newer business models, and so on and so forth, it requires a lot of system integration activity. So that's where companies like us, in the longer run, people who invest, understand this technology ahead of others, there's enough and more to be done. So I'll take a pause.
So, will there be a period, a gap period between when, you know, the use cases really start, because right now the entire focus is on, everything is going into building these technologies, and, you know, the race is on. You think it'll start showing up in a big way for companies, Indian IT services companies, maybe, you know, 12 months out? I mean, what's your projection?
Yeah, so if you were to look at it, a number of these people are technology builders. A number of enterprises have already started adopting, while they may be in absolute initial stages. The first thing that people are doing is getting their data ready for consumption by AI. So even people like us are seeing bigger programs on that. So we are looking at AI in three parts. AI for technology builders. So the people we talked about earlier, how do we work with them? From a tech services perspective, what is the market for us? Second is where we are working with enterprises to get them data and AI ready. And even, you know, some of the largest Fortune 500 companies, we are working with them. And we are big winners in the data and AI project related space. And so are a few others in our, you know, ecosystem. The third part is what people call agentic AI. That's in initial stages. For that, you need enterprise-wise data to be absolutely, you know, talking well to each other. Pockets of excellence exist in that. So that's a longer term journey. And I'm pretty sure, you know, all of this for the people who are building the technology ahead of others, it is showing in their revenues. Is it more than single digit revenue today? Not necessarily, but it is a multi-year journey. And let's say 3 to 5 years from now, this should be 30 to 40% or more AI native kind of a journey for many.
All right. 30-40% of revenues for IT services companies.
Yeah. Over the next 3 to 5 years. I'm not saying 3 to 5 quarters.
Yeah. No, I got that. Najal.
All right, Mr. Carlo, let's wrap this discussion up then with a quick word on the Indian rupee, because no discussion nowadays is complete without discussing the rupee. So tell us, what's the impact of the rupee depreciation on your business? Will we see some kind of margin tailwind coming on? And can you do better than that guided 200 to 300 basis points improvement in a bit margin over the next 2 years because of the rupee weakness?
So I'll not do the forward-looking guidance here. We are in the thick of the quarter, so I wouldn't want to comment on that. But if you look structurally over the last several years and decades, rupee has depreciated in a slower manner. Right now, for various structural, you know, reasons, and you talked on this show earlier about the trade deals and so on and so forth. So there are macro that are impacting the shorter term thing. So shorter term, yeah, there will be a currency impact. But look, this industry is built not just on currency impact. That's one enabler for the industry. And I'll say a smaller enabler. In our mind, for the next 3 to 5 years, the biggest thing people have to pivot on is build capabilities on AI. And again, not next 3 to 5 quarters, but next 3 to 5 years, you will see significant amount of tailwind for our industry in this.
Sandeep, thank you very much for joining in. Short conversations. We've got a lot lined up on the show today. But Persistent in their last conversation had also reiterated $2 billion of revenue by FY27 and $5 billion of top line in the next 3 to 4 years. Get into a break. On the other side, technical trades with Sudarshan Sakhani and Mitesh Thakkar.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. 4 minutes to go for the pre-open session and about 20 minutes to go for the market open. Sudarshan Sukhani is with us and so is Mitesh Thakkar. Gentlemen, good morning. Special day, 26 years at CNBC TV18, and thank you both for being part of the journey every single day in the morning. It's such an incredible feeling to talk to you on a day like today. Well, let's just look at what happened on Friday, both of you. Sudarshan, you go first. I mean, decent bounce, maybe a little bit of help from the Reserve Bank, 20-day kind of held on and protected once again. Where does it leave us now, Sudarshan? And are there trades to be taken?
Yeah, good morning. Well, we had a minor correction, and then, as you said, the Reserve Bank helped, and maybe the correction was over in any case. We wouldn't know that ever. But the point is that we are back in a trading range. Inside this trading range, we need to be buyers on small dips with a very tight stop at 26,050 in anticipation that this range will break out. Maybe, but we still have to be on the long side of the market.
Mitesh, what's your sense on the index, first of all?
Yeah. Morning, Prashant. So I have maintained that Nifty will be between 26,300 and 26,850 broadly, and I think that stance is still continuing. I think this consolidation will help the Nifty eventually to break on the upside, but for the time, I think the signals are not there. So we must assume that the range will be in force.
What about stocks, Mitesh?
Good morning, Nima. I have a mix of buy and sell calls. On the buying side is Cyient. I think after 2-3 days of rally, it gave a pullback on Friday, so it gives you a better entry point. Keep a stop at 1151. Look for targets of 1200. Indus Tower is a buy with a stop at 409 for targets of 430. And on the selling side is ONGC with a stop at 246.5. Look for targets of 230. And Gas Authority, if it breaks 169, short with a stop of 172.25 for targets of 162.
Sudarshan, what about you?
Well, it's almost similar. Indus Towers is also a buy for me with a stop under 410. Another Indus Bank, which comes as a buy after a long time with a stop under 855. PI Industries is a buy with a stop under 33.30. And Oberoi Realty, which is again coming in my list, is a buying opportunity with a stop under 16.25. It's an all-buy list.
All right. Thank you very much both for joining us, and come back to you a little later. Appreciate it. We take a break. We are back, and we're going to be talking about, of course, the pre-open session, which should be with us shortly in about 2 minutes' time. And joining us will be some of the big and influential voices who've been part of the 26-year journey. On your screen, Nilesh Shah, Ramesh Damani, Madhu Khela, Manish Chokani, Sameer Arora, Ashish Chauhan, and many more. So we'll, of course, have a special bell-ringing ceremony coming up as well.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. Just counting down to the pre-open. You should keep your eye on Interglobe Aviation. That in pre-open is down close to about 10% For starters, because of the flight cancellation, Q3, which is typically a seasonally strong quarter, is unlikely to see that earnings pick up. So that's reason number one. And two, on account of these new, the new rules for pilots, etc., the company perhaps will have to take on more pilots, which also adds to the cost structure. And Interglobe Aviation slammed down 10% lower in pre-opening. Investec has a sell rating, and they've put a target price of 4,040 on that, about a good 20% lower than the current market price. But other than that, it looks like a flattish start. A lot of single stock action should be on your radar. Biocon, positive news flow where the company is looking to make Biocon Biologics a wholly owned subsidiary in a deal valued at $5.5 billion. The only question is, while it's a long-term positive, in the near term, there is going to be some dilution as the company raises money via a QIP to fund the acquisition. Matrimony, I think news was just out that the company on the 15th of December is looking at a buyback, and pre-open, it's looking like a big mover. And Fino Payments is the other one we will be tracking today because the company has got the license for a small finance.
All right, Rima, thanks for that sneak peek into all the top stocks we should be looking at. But Sudarshan wakes up early, goes through a lot of brokerage notes, but he joins in to just give us an insight into a few of them. Sud, please take over.
So first one is Kotak Institutional Equities has initiated coverage on Tata Capital, and it has an ad call, and target here is 360 per share. It's a third largest NBFC company with a loan book of almost 2.44 lakh crore as of Q2 of FY26. It has a well-diversified portfolio with a major focus on the retail, which forms almost 61% of the total loan book. It expects ROE to expand to 15.7% by FY28 from a low base of 12.5% that company reported in FY25. Next one is Max Healthcare. Goldman Sachs has initiated coverage with a buy call, and target here is 1325. It expects 23% top line growth and 24% EBITDA CAGR over FY25-28, and it believes that company has highest potential to expand capacity amongst all the peers. Next one, GS on Krishna Medical, that is basically known as KIMS. It has initiated coverage with a buy call, and target here is 900. It expects company to deliver industry-leading top-line growth of 30% CAGR over FY25-28, and it believes that company is well-positioned to achieve top quartile return metrics with ROE of as high as 25% going forward.
Okay, all right. Thanks a lot for that, sir. I think we have Hormuz as well that's joining in to run us through some of those shareholder lock-ins that actually open up. Lenskart, Pine Labs, Grow, Urban Company, that comes to an end. Hormuz, tell us, which are these companies that we should be keeping on our radar?
Morning, Nigel. Most of those much talked about IPOs, right, from last month, they should be on your radar this week because their lock-ins come to an end. We'll start off with the ones that end today. First up being Lenskart and Pine Labs. So for Pine Labs, of course, we have close to around 19.8 million shares freeing up today, 2% outstanding, value of close to 500 crore rupees. Then the stock is around about 15% higher from its IPO price. That lock-in ends today. For Lenskart, it's again 2% equity, but around 40.7 million shares that will be freeing up for trade today. 1,700 crore rupees is the value here. The stock has remained above its IPO price despite a lot of chatter with regards to its valuations. Now, when you go on further, Grow as well, the lock-in there ends on Wednesday. The value of those shares is well over 2,200 crore rupees, almost 150 million shares or 2% outstanding frees up for trade here. And the stock, despite having this recent correction, is up around 50% from its IPO price. And Pine Labs, again, there are two instances when the lock-in ends. Again, on Thursday, actually on Friday, where around 39.7 million shares will free up for trade, 3% outstanding. The value here is close to 1,000 crore rupees this time around. So keep an eye out on Pine Labs today as well as on Friday. And on next Monday, we'll have Urban Company, where the 3-month lock-in comes to an end, where close to around 41.5 million shares, 3% outstanding. The value of those shares is well over 500 crore rupees. So that will free up for trade next Monday. But the bigger talking point, of course, is that the way the shares moved, particularly Urban Company and Grow, those shares are now significantly off those post-listing highs. Grow is down around 23% from those levels. And Urban Company, which made a post-listing high of well over 200 rupees, is now down almost 40% from those levels.
Thank you very much for that. I'll also watch for PVR Inox because of this mega deal which took place where Netflix is buying Warner Brothers.
Yeah.
Now, within this deal, Netflix will be acquiring Warner Brothers Studios. So basically, they will now control the Hollywood content. And historically, Netflix has deprioritized theatrical first releases and they prefer to release it on streaming. So if that plays out, then the big global Hollywood blockbusters which come to the theaters first, especially for PVR Inox, could be impacted, which is why even the Multiplex Association of India has raised some concerns about this, mega deal, which is worth more than about $80 billion. But it's also an action-packed week. The big one, of course, is the Fed decision. On Friday, we also have the India November CPI inflation print. That will come out on 12th of December. And if you remember, October was that record low of 0.25%. So we'll watch what the November inflation number throws out. And then, the US trade delegation led by Switzer will be in New Delhi for the 3-day meet. So let's see whether we get anything on that trade deal and if they can iron out some differences. So that's going to be the big one. And of course, IPO action, as Hormus pointed out, lock-ins end, but many new IPOs open today. So that's going to be on my watch list for the entire week.
Okay, all right. So that's all the cues that we have. Mitesh is waiting by to give us his 9-10 call. Mitesh?
I'll go with the buy on Cyient with the target of around 1200.
Got it. Sudarshan, what about you?
Indus Towers, buy Indus Towers with a stop under 410.
Indus Towers. For Indus Towers, of course, the big trigger will be when we get the AGR relief package from the Supreme Court, because that will be positive for Vodafone Idea, and that indirectly will be positive for Indus Towers. So that will be the big trigger, to watch for when we get details of a relief package.
I think if we still have Mitesh with us, Mitesh, I wanted to ask you your view on Reliance Industries, because that big boy has been holding one end up. It's at a 52-week high. It's been looking quite good. Actually, as CNBC TV18 celebrates 26 years of leadership, Prashant is in conversation with all the biggest and the most influential voices. Prashant, take over.
Well, thanks very much, Nigel and Rima, to you. And it's not just me. There's Nimesh with me. There's Mangalam, who you'll be able to see. And, of course, we are joined and really flanked by some of the best voices, biggest voices.
And the biggest supporters.
And the biggest supporters, absolutely. And, these are people we go to. I mean, you come to us and we go to them to get the view, both market and corporate as well. So really a star-studded lineup. And they've made it Monday early morning to our studio, so it's
only for us.
Really wonderful to have all of you here. Mr. Ramesh, thanks very much. Madhubhai, great to have you. Ashish Bhai has got a function a little later, but he's made it with us. Thank you, really appreciate it. Nilesh Bhai, thank you very much. Navneet, appreciate it. Mr. Chatwal, thank you very much for joining us. Mr. Damani, it's always a pleasure to have you.
I'm told Mr. Chatwal has created a discount code on CNBC TV18's 26th birthday. It's IHCL26. Type in that and you'll get a 26% off on whatever booking you're making on the Taj.
I think it's a brilliant idea. Let's just go with it.
Let's just go with it.
But not implemented yet?
He just got the idea right
away,
now.
right after this.
I hope it's not plus 26. As long as minus 26, you're okay.
No.
Market men prefer plus.
We are large-hearted.
Thank you, sir.
I'll go to Ashish Bhai first. I mean, Ashish Bhai, you are the platform on which everything happens. I was putting out data earlier. 26 years, if you look at the market capitalization, 99 and where we are now, 100x is the growth which has happened. And, you were right there at the beginning, if I may say so. Your reflections of what we've seen over the last 20 years.
India has changed. Mumbai has changed. And I recall your office just behind the TV tower at Worli. And you are closer to that now. But basically from there, I think I was probably there in the first debate itself on derivatives.
Right.
And so the only guy who is constant in NSE is me, although in between I also changed. So a lot of things, but markets have given almost 13.5% CAGR. The market cap has gone up 17.5% CAGR, which means more companies have come. In a way, India is becoming more financialized. More assets are getting listed on every count, right? So,
I was just looking at data in 99, the largest, and many of you would recall, the largest The biggest large cap was HUL with a market cap of 50,000 crores. Wow. The biggest small cap, by current definitions, was a company called Foseco India with a market cap of 150 crores. I mean, just unbelievable growth we've seen, right? I mean, this is the average. The largest large cap, the largest small cap, the largest mid cap. I mean...
the market cap of one company is bigger than the total market cap of 1999.
Yeah. I mean, yeah, absolutely. 5 lakh crore was the total market cap, and you got...
2-3 lakh crores.
And Nifty, Nifty was around 1,500, 1,480 or something, if I recall correctly.
Yeah.
And today it's 26,000. Of course, you have to take into account the dividends, but it has been a phenomenal run.
I think one place in India has changed. It is only capital markets, I would say.
Yeah.
You know, by leaps and bounds, whatever number you look at it, number of demat account from 2.5 million to 22.5 million, market cap 130x, the size of the companies, retail investor participation, SIP inflows. It looks absolutely unbelievable, like a story, picture perfect. For capital market.
The money, I mean, you know, we kind of quib and complain about near-term performance and how it's been a tough year. Maybe it's been a tough year, but sometimes when you reflect back over 26 years and the compounding we've seen, I mean, it just tells you to essentially the advantage of staying in the game, right? I mean, being there.
You're right, Prashant. I mean, when I joined, the index was not even 1,000, 1,500, as Ashishji said. It was actually the Sensex was 800 at that point. Today we're at 80,000. We had a 100x move right in the Sensex. And it's hard to believe today, but when Infosys went public in 93, the market cap was, I think, 40 crores. 40 crores. You couldn't buy a flat in Bombay for 4 crores. And yet you had Infosys market cap 40 crores. Extraordinary journey. But let me just put in perspective for you your journey at CNBC TV18, which we're also proud to be a part of. You know, Helen Keller, the famous woman, once said that a well-educated mind will always have more questions than answers. And for 25, 26 years, CNBC has been providing the answers to the questions that the public has posed. So congratulations and a happy anniversary to all of you.
Thank you very much. Really well put.
On this occasion, we have another question as well, and we'll probably go to Nileshji on that one. You know, last 26 years, the numbers have been phenomenal. For someone entering right now, do the next 26 years look better than the last 26?
Undoubtedly, yes. But in real return, not in nominal returns. If you are expecting 100x in next 26 years, it may not happen because our inflation is down from double digit to mid-single digit, low single digit.
You know, guys, we're being told that 20 seconds to go. So, आप mic मंगलम ले लेगा. आप गाँव उठा लीजिए नीलेश भाई. I mean, I think ये ऊपर, यहाँ पे ऊपर. आशीष भाई. So I think we're going to ring the bell in. By the way, this is only 17 bells to go for the end of the year. That's the other thing. I think. And
both closing and opening.
4, 3, 2, 1.
There we go. Please. By the way, please. Ramesh, please. Ramesh.
Give it a go, give it a go, give it a go.
No, I think...
many congratulations.
Navneet, I mean, just your reflections in terms of what you've seen.
It's been a phenomenal journey. As I said, that the largest market cap company today is bigger than the entire market of India. And our mutual fund industry was less than 1 lakh crore, which is 80 lakh crore today. And I must say, HDFC Flexi Cap Fund NAV was 20 rupees, which is 2,000. I have to say, past performance is no guarantee of future performance. Mutual funds are subject to market risk. Offer document carefully. No, but the point is, I think it's a phenomenal journey as an economy, and you have played a very big role in shaping policy, in corporate governance, and overall economic transformation of the country. So many congratulations.
Thank you so much.
Let's dive in some strategic thoughts as well. Over the last 26 years, the hospitality industry has seen a big shift, the way people have begun to consume, experience, etc. And similarly, media has also faced that shift. So if there was one thing that you would like to suggest to us over the next 26 years that would be more consumer-friendly, better, relevant, and what changes we should do, what would you say?
You know, consumer-friendly, all service businesses have to be, and they have to keep reimagining themselves. So it's very difficult to say what you do in 2 years, what you do in 5 or 10 or 15. It will keep coming. But definitely where India stands today, where India's GDP stands today, where the capital markets stand today, hospitality, travel, tourism, aviation is bound to flourish. And if we get some kind of change in the mindset, in the positioning of the sector, it can grow immensely the soft power of the brand India. I think that's the one major difference versus past. It's not only about consumption. If you want to establish brand India, one of the ways to do it is hospitality and tourism.
Right. And I think Mr. Chatwal has reinvented, reimagined the Taj brand, right? I mean, absolutely over the last a few years coming through. Mr. Ramesh is, of course, with us as well. And, you lead a company and, of course, you're part of an industry which has really been, like IT services, pharma has been really the flag bearer. I mean, there's a soft power, there's export power as well. And I think pharma has played such a big role. And you've been with us over these last 20 plus years. Just your reflection, Mr. Ramesh.
Yeah, so congratulations in the first instance about your 26th year. Very well done. You've been synonymous with corporate reporting for quite some time now. Speaking about the healthcare industry, pharmaceuticals in general, not for nothing is India regarded as the pharmaceuticals capital of the world. So essentially 40% of volumes in America comes from India. So clearly we have come a long way over the last 20 years, so to speak. And India is also transitioning into more specialty. We've been good at generics for ages now. But if you look at, in fact, some of the firms today, we are looking at pretty, a lot of specialty products. So we had the in-licensing, out-licensing from Glenmark. A lot of other companies also are in the same track that way. Sun Pharmaceuticals has established a name for specialty and so on. Lupin is also going that pathway. So clearly, there's a lot to look forward to. And in terms of healthcare, there's a lot of potential in India, given the fact that there's still huge underpenetration. And clearly, from my perspective and from the pharmaceutical industry perspective, many more miles to cover before we reach any levels of satisfaction, so to speak.
Yes, it's ambitious, absolutely.
By the way, you had an experience of creating 100x in your Reliance mutual fund. Your journey and just to reflect on what you look forward to in the next 25 years.
As I said, it's nothing short of phenomenal, picture perfect, very, very satisfied that we are born at the right time and right place. And it's been phenomenal,
What's been your key learning? I mean, in one or two learnings?
Key learning is just stay. I think believe in India and stay invested, because over the years, so many things have changed, so many ups and downs we have seen. And people who have stayed, I would just like to maybe put things in perspective. It's not 100x, but it's 130x now from 99 to 2026. So someone who just stayed invested is the one who has laughed all the way to the banks. I must say again, congratulations to you guys. I think CNBC has played a very, very vital role in the way capital markets in India have shaped. You've got the best voices. I think a commentary which is completely unbiased, and yet I must say all you guys individually remain so humble. So congratulations to all of you. Thank you.
Thank you so much. I was thinking of what everyone was doing when they were 26. I realized that when I was 26, just below 26, I joined CNBC TV18 and CNBC turned 26. Mr. Damani obviously was a student, if I remember, in the US around that age.
When I was 26, yeah, probably.
Yeah. So the one thing that has stood out for you is the mastering of multiple cycles. You mastered the IT cycle, thereafter the other cycles that came in, as recent as the PSU cycle as well. So, the next 26 years, what's the cycle that you're betting on as of now?
As my wife tells me, Kismat Balwan to Gada Pelwan. So I don't want to take too much credit for mastering the cycles, Banglam. But having said that, I agree with the consensus in the room that the next 10, 20 years are going to be even better for India than the last 10, 20 have been. And remember, we've gone from 800 to 80,000 on the index. So it's a very tall claim to make. But it just seems we're in the right place at the right time. And I'd just like to add that my generation, Navneet, me, all of you my age, we're part of the blessed generation of India. I mean, we came to markets in the 80s. What happened? The Berlin Wall fell. What happened in 92? Economic liberalization started. What happened in 96? The TMT boom started. So we've been beneficiaries of a huge tailwind that has carried us so far to 80,000. But I think this tailwind of India, the demographics, the digitization, the democracy, will ensure that we go much higher. And I'm going to make a bold prediction because it's your birthday today, that someone asked me yesterday, where is India going to be in 2047, 100 years after independence? I think get ready for us. Index in the 7 figures.
Wow.
Okay.
Wow. Index in 70.
That's about 12% compounded, so not that great as it sounds, but we'll get there, I think. You know, not 6 figures, 7 figures.
Wow, 7 figures. Oh, what were you doing at 26?
So I think all of us were very lucky that in early 90s who came to the financial services and saw the entire journey of India, and I think 99 you happened to be at the right time. In fact, some of the largest companies in the Nifty today, TCS, Maruti, Bajaj Finserv, maybe Coal India, so many of them were not present in the Nifty of 99 when you started. So it shows that in next 26 years, we are going to be many giant companies in India which are like yet to be born.
But which ones would you bet you're on to be the next top market cap companies?
Invest in the fund. No, on a more serious note, I think the compounding story other than United States, India has shown. We had a great campaign, Incredible India in 90s. The time has come, we start another campaign, Inevitable India.
That is something that will be music to Puneet's ears.
You know, Maneet, Mangalam, I was asking that instead of saying what they were doing at 26, let's ask just one round of what they were doing in 99.
Okay, let's do that.
26 years ago. Mr. Ramesh, 1999?
1999, I actually switched to Wazir Sultan Tobacco as CFO there. So that was the change that I was undergoing at that point of time.
Madhubhai?
I was with the broking firm 26 years back.
I was in school.
Birla Mutual Fund. And saw the tech boom of 99 and the bust of 2000. Very interesting days. Yeah.
Lovely. Nilesh bhai?
I was a fixed income fund manager.
Wow.
And as long as I was fixed income fund manager, I outperform all equity fund managers.
I was heading development for Carlson companies that time, today called Radisson Hotels, for Europe, Middle East and Africa, based out of Germany.
Wow. Mr. Damani?
Yeah, well, I was still a broker in the Bombay Stock Exchange watching the rise of tech in India at that time. And I think one of the tributes we should pay in the last 26 years is to the technology boys. I think they've made India what we are. So in the Infosys market of 40 crores in 93, I think what tech has given the pride and the panache to Indian markets, I don't think can be replaced or undercounted.
Okay, quickly, one question to all four the market participants. Madhu, I'll start with you. One stock in the last 26 years that you've betted on, and similar thing you can reflect the same in any of the fresh companies or the newer companies, which can become the next big thing. One thing that you can think of and highlight. Maybe everybody can.
So my story is very boring, guys. Still the same Divi's lab. It's the same Divi's lab.
For last 26
So I think, but Nimish, I would like to make one comment. A lot of people who are watching us, they must be saying that so much has happened. Yeah. So what in the next 26 years? Yeah. Now you see what has happened in America in last 5 years in the AI boom. Half the market cap roughly is now contributed or influenced by the market cap, by the AI boom. I would say in the next 25 years, the easy part of India re-rating story and multiple expansion has happened. Now the difficult part starts, wherein you have to now really work hard to make the money. The easy multiplication of money because of re-rating out of India may be behind us. But if you catch the industry right, if you catch the companies right, where earning growth is there, still there's a lot to happen.
That's a job cut out for us. Yes.
Any theme, any idea?
Well, I think one theme that I'll say controversially, I think the American century, as we knew it, is probably going to start declining. I have a strong feeling what Trump is doing is absolutely wrong for what is America, tariffs, there's crony capitalism that America is practicing. For India, of course, I think Mr. Ramesh will be very happy. I think pharma will do well over the next 5 years, so which is a rare call for me, sir. So I'm
pharma over the next 5 years.
Anything that stood out for you last 26 years, which can probably reflect again in next 25 years?
So 26 years ago when market used to correct, we used to go to investors, stay invested, be a long-term investor. Now when markets correct, investors come to us, Nilesh bhai darna mat, gore ko khali kar dena. But the real change which has happened is not just the mindset. 26 years ago, our investors were urban India, male, upper middle class, super rich. Today my investors are urban, semi-urban, rural India, male as well as female, and not only the upper middle class and rich, but also the lower middle class. 100 रुपए की SIP करके लोग अपने ख्वाब हमें दे रहे हैं.
I remember last year I complimented Shriram for Young Turks, 25 years before the startup became a buzzword. Startup is the new guitar in colleges today. And we have seen the journey in the last few years. But you look at like 90s, even an HDFC Bank or so many companies is standing here. And many other companies, the way they have compounded. I think they were a small startup and today giants from a global standard. I think we are going to see the same in India over the next 25 years. And best way to invest is through our funds.
If you had to ask the corporate leaders here as well, when hospitality boomed, a large part of that was led by luxury. Do you believe the way, fashion has become affordable, the next leg of hospitality also, say, Zudioization of hotels, will that happen as well?
I would not call it Zudio-led growth because we have something nicer. It will be gingerization, of all district capitals of India. And we are just at the beginning. I mean, we'll have 250 ginger hotels in operation at the end of next year. So that gives you a perspective of where we started, where we are. And we are very pleased. And with all the good investments you make, with all the good returns you make, we are the happiest because you come and spend in our hotels. And please keep doing so.
All right. And, the Indians were pharma manufacturers of the world up until now. Do you think we'll be the pharma innovators of the world in the next 26 years?
I think the first part would be potentially be search and develop. You might actually see a lot of in-licensing opportunities from other parts of the globe and develop it for India and the like. But clearly we are on this track. And at some point of time, we would certainly be looking at out-licensing a lot of products from India. It's already started. Glenmark has done that. But a lot of other corporates would also do this over the next several years.
So more R&D in terms of Indian pharma as well. We're going to toss it back to the studio. Mr. Ramesh, thank you very much. Madhu, I appreciate you coming in. Navneet, appreciate you coming here. Nilesh bhai, always. Mr. Chatwal, Mr. Damani, thank you very much.
Happy birthday again. Happy birthday, yes. Happy
Happy
birthday.
to all of you and all the best. And I'm sure you create more investors, more wealth, and help India grow. Thank you.
Thank you very much. We're going to toss it back to Nigel and Rima in the studios, and programming continues. Thanks very much.
Well, it's a quietish start right now for the Indian markets this Monday morning. The Nifty is hovering around 26,150. It's a mildly lower start of about 0.1%, 0.2%. Midcap index is swinging between the red and the green line. The big drag today is Interglobe Aviation. So the downtick on Interglobe Aviation continues, still in the eye of the storm with the flight cancellations. So Interglobe Aviation straight away 3.5% lower. You've got a few pharma names, softish in trade, Sun Pharma, Cipla. Bajaj Finance is weak. Nestle India has corrected about 3/4 of a percentage point. BEL is under pressure. Asian Paints has started off trade on a downbeat note. On the way up, sectorally, strength is seen in some of these tech names. So Tech Mahindra, Wipro, Infosys, TCS. If you pull up the tech index, maybe that will give you an indication that sectorally, the IT index is still resilient, a gain of about 0.5%. At least the rupee has stopped depreciating. I think that early rate will once again come up. After the dramatic fall that we had last week, the depreciation seems to have stopped on the rupee. HDFC Life is your top gainer, and Eternal, where there was a block deal in the morning, I think at least as of now, it's up in the green, so it's recovered after that block.
Yeah, the large trade is out of the way. The street was sniffing it, and that's got cleared out of the way. And remember, the stock was a 360 rupee stock on the day it came out with its set of numbers. So that's corrected a good 20% from the top. A few stocks in the broader markets that deserve special mention. SPML, Infra, that stock is up 8.5%. So big move is what we're seeing out there. Ashoka Bilcon as well. There was some positive news flow on that one. That stock as well has perked up a little bit. So good move on that name. You have Suzlon, actually, that's moved up. Remember, the stock has corrected from 90 rupees to around this 50 rupee odd mark, but that stock has shown some kind of green out there. And Fino Payments Bank, surprise, surprise, that's one of the top losers. Massive profit taking is what you're seeing on that one. Volumes are very, very high. The stock is down close to around 5%. And just a word on Interglobe Aviation, though the stock is down 3.5%, at the start of trade, in fact, it was down more than 6%. So that's seeing some kind of bottom fishing as well in today's trading session. Net, breadth of the market is negative. The Nifty is down a little bit, but you'll have to say we're still in a bit of a range out there on the Nifty. Until the 20 DMA, both on the Nifty and the Nifty Bank is protected, the bulls will fancy their chances to end the year on a high. The breadth of the market, though, Rima, that's concerning. Even in Friday's trading session, everyone was talking about the big move that we saw on the Nifty Bank. The small cap index was down 0.4%. So portfolios are not feeling good as of now. Hopefully that catch-up does take place, because otherwise it's not feeling like fresh all-time highs.
Indeed, I was seeing some analysis over the weekend that over half of the NSE 500 stocks are still trading 30% below their peak levels, which is why portfolios are not feeling very good. But Fino Payments Bank is actually the surprise stock, 5.5% lower on Fino Payments Bank. Remember, the news here is that this is a payments company which has now got the RBI approval to convert itself into a small finance bank. So as a payments company, it couldn't lend money. It could only accept deposits up to 2 lakh rupees. But now once it converts into a small finance bank, it can lend freely. It'll decide whether it's retail, MSMEs, but it can lend freely. There is no cap on deposits. Though on the flip side, they have to maintain some regulatory requirements. So one would have thought the news would have been positive, but that stock is reeling under pressure. Biocon too, the news is positive, the long-term promise, but maybe in the near term, the dilution is weighing on the stock, and Biocon has opened up with a cut of about 3/4 of a percentage point. Niva Bupa, that's a stock because I think the November numbers are actually looking good. The November premium went up 47%, with the April-November market share rising by 18 basis points on a year-on-year basis. We will get into a short break with the news. The openings in flat. The Nifty is trading just shy of the 26,150 mark, mile down tick. On the other side, we'll continue our conversation with Indian Hotels' Puneet Chatwal. Stay tuned.
My heartiest congratulations to CNBC TV18 for completing 26 years, and to you, Shriram Finance, for your 25th year completion. What an incredible journey that you all have had. This journey has resulted in you establishing yourself as the most credible channel for business news in the country.
26 years of CNBC TV18. 26 years of CNBC TV18.
Well, as CNBC TV18 celebrates 26 years of leadership, we're now joined by Puneet Chhatwal, the MD and CEO of Indian Hotels, who's made his way up from one studio to the other. Thanks, Puneet, for joining in. But, before we get to that discussion, I'm just going to point out the three focal points that we're looking at. The growth roadmap of the next 2 decades, the holiday season performance, what's the outlook on that front, and the macro trends in the hospitality business. Well, Puneet, we're going to touch upon all these three. But first up, what about the recent fiasco with regard to flights not taking off? Indigo, or Interglobe Aviation, which is the listed name, they have been facing some headwinds. What has been the impact on your business? Because a lot of people could not get to their desired destinations. Has it impacted business in any way? Have there been cancellations, any kind of revenue loss?
See, firstly, good morning.
Morning.
Thank you for having me on 2 studios today. There is an impact. It's very small, so the reverse also works. You get cancellations because people could not fly in, but you also get extensions and rebookings because people cannot fly out. So I think in the end, it averages out quite well. The major markets that are important for hospitality sector in India, that's the top 10, I would say, the impact has been negligible.
Okay.
And as we have seen during COVID, this sector is so resilient, it bounces back. And actually just 3, 4, 5 days creates a pent-up demand, and what did not happen in those 4, 5 days happens a week later.
But is it possible to quantify the impact?
It's so negligible. It's less than like 0.1% of our total revenue.
So you maintain that Q3, in the past you've said Q3 PAT is typically higher than the first half. That stays?
It's significantly higher. Okay. So the Q3 PAT is higher.
Significantly higher
than the Q1 plus Q2 put together.
Got it.
And that is a trend we have seen in the last, 14 quarters.
Is it better this year?
Of course, it will be better. We still have some time to go, but the trends, the business on the books, all points in the right direction.
And the 12 to 15% top line guidance? Do you do better?
I never said 12 to 15.
Okay,
I said a double-digit growth.
Okay.
Anything between 10, 12 and higher is most welcome. But our base is so high, it's very, very high. So it's not just the percentage. We have to look at the absolute amount.
Well, I'm telling you, the absolute ARRs are moving up. As an interested party, I'm traveling towards the end of the year. Obviously, I couldn't get to your property because the ARRs have moved up so much. but you tell us.
We have just agreed with Mangalam to do a special promotion, IHCL at CNBC 26, so to get 26% off. So he's made that suggestion. We'll work on it. Let's see if we are able to advertise it.
Mangalam, Rima, you continue with the interview. I'll just book my ticket. No. Give us a few details then in terms of occupancy, in terms of ARR as well. How do you see the trend shape up, for the second half of the year? And Q3 has been as good as what you estimated?
So far, it has been as good as estimated. October had both Diwali and Dussehra. So that was less buoyant, but because of that, November was very, very strong. So you have to look October and November together as far as India is concerned. And in December, the first 15 days are really very, very strong. You have also the wedding dates, the auspicious ones, and we also have, state visits. A visit of the president of Russia does make a big impact on business in Delhi.
I want to pick on the point that you spoke about gingerization of hotels, right? Not studios, okay, whatever. It's a tough one to say, but gingerization of hotels. So today, Taj, as a brand, contributes about 75% plus to your overall revenues.
Correct.
Now, considering how fast Ginger is growing, or even the improvement that we're seeing in Amma stays, etc., say by 2030, how much do you think the contribution of these newer verticals will be versus what it is today?
So, gingerization of the business would be reflective of the new India and where India is marching ahead in terms of its middle class, low middle class, high middle class, etc. The opportunity is very big, but the revenues in ginger, you need, like almost 50 gingers to come to the same level of revenue as Taj Mahal Palace in Colaba. So the revenue will keep coming and the profitability to a big extent, which could be 60% from the Taj brand itself and 40% over the other brands by 2030. It could look very different by 2047 when India is at 100, where Taj may come to 50% of the total because other brands would have scaled up. But Taj will always occupy the larger share of the pie by virtue of having presence, let's say, in London. One hotel in London or one in New York contributes, I mean, it's a very big amount of revenue.
So the numbers you shared, 60% of by 2030 and by 2047, it will be 50%. That's in total number of hotels, not in terms of revenues.
No, in terms of revenue.
In terms of revenues.
In terms of in number of hotels, Ginger will grow much faster. Actually, by the next 6 months, in number of hotels, Ginger would have overtaken Taj. Today, Taj is higher, but in the next 6 months, Ginger would have exceeded that number.
Let's come back to the Taj brand then. And there's a property that we have been speaking about over the last few years, which is Sea Rock. I think I'm getting there. Bandra property, erstwhile lobby bar used to be there. All my first dates were there. Beautiful place. But now Taj Bandstand is something that you're looking at. What is the capex you're looking at? And by when do we see completion? Because that's a very, very good location.
Yeah. So I think that construction site is already become busy. We are doing the excavation works. I kind of think, based on my conversations with the teams, anything between 4 to 5 years is realistic because it's 164-meter tall building and we have to also dig deep into the basement, and that's a lot in water. That's why it was called the Sea Rock.
Yeah.
So it's not the easiest of the constructions. Having said that, this would be the next iconic asset for India. Okay. So like you look at Singapore and you have a Marina Bay Sands, you look at Dubai and you had the Burj Al Arab, I think this will be the iconic statement made by the city of Mumbai, made by the House of Tata, and made by India to the world. And we are very, very excited about it. We will not, kind of become frugal in the wrong places. Yeah. So whether it's your lobby bar on the floor or on the ground floor or it's the topmost floor of the building, it will be just best in class. That's the whole vision, and the capex would be big. It's already in our books with 1,500 crores, the cost of the land. And a number higher than that would be the final construction and design expense. So because of the land being very expensive in Mumbai, it will be 40-45% of the total capex. And so that gives you an idea. Anything between 1,800 to 2,000 crores is realistic.
So 2030, Rima, Puneet and Nigel will have a coffee with that.
And at that time, we'll probably be at 30% discount. CNBC will be celebrating 30 years.
30, yeah.
So maybe
we are very large-hearted. We can host CNBC. But this was, at 26, was meant for CNBC viewers.
Oh, not us. Okay. Thank you. Thank you, Puneet, always for joining in, and look forward to these conversations.
Thank you for having me.
All right. Get into a break then. On the other side, the management of Lupin will join in. Stay tuned.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. Down about 0.25% now on the Nifty and the Sensex. Midcap index down 135 points. The advanced decline ratios turn adverse. One stock in the green for two in the red. But let's welcome now in our studio, as CNBC TV18 celebrates 26 years of leadership, Ramesh Swaminathan, who was there for the ringing of the bell, is now with us in the studio. He's the ED and Global CFO at Lupin. I was listening to what you were saying, right? Like, India is known as sort of the generic capital of the world when it comes to pharmaceuticals. But your vision is that we move towards specialties, like more branded drugs, as we look ahead to the next decade. And that is the potential for us. So for Lupin, how will this this vision of yours change? What is the current contribution of generics? Because you do supply, I think, 40% of the US drugs come from Lupin. How do the numbers change? First, give us a big picture and then we'll get down to...
I think it's basically a question of evolution. So essentially we started off with generics, as did a lot of companies from India. Clearly, America was the El Dorado, so a lot of companies flocked to that for sure. 40% of the volumes of America certainly comes from India. But I would also add that we export to a host of other countries, including Europe, emerging markets and the like. So clearly it is the pharmaceutical capital of the world. And as with evolution, a lot of companies would like to transit to more specialty. And that is indeed because we need to grow up. So clearly IP-driven products would be the way forward. We have also forayed into specialty, if that's what you are...
you have, yeah?
Yeah.
All right. What is the contribution today of specialty and what would that number look like?
Currently, we have a number of products. So we have products in, but this is across the globe, so to speak. We have products in Canada. We have a couple of products in Europe and the like, and so on. Our total contribution is close to about $80 million, so to speak. But clearly, with this foray into Visupharma, into ophthalmology, this is set to go up dramatically. This is doing about $50 million, but over the next several years, it will certainly blossom into a much larger number. And that's the way we see things going forward for us.
All right. Hi, sir. Welcome to the studio. Thanks a lot for joining in. We want to get some clarity as well, because the street has been a buzz with some reports which suggest that you're looking to buy UK's largest nutraceutical company, which is Vita Biotech, I believe. And the valuation could be, 1 billion pounds, I believe. And your talks in with PEs. Clarify on that front. Is there any truth? Are you looking at it or no truth whatsoever?
Honestly speaking, there are a number of propositions that come our way, and we keep evaluating a number of them, clearly because the fact that we need to see whether it is a strategic fit and the like. So from that perspective, there are things that we certainly look at, but doesn't necessarily mean that we need to pursue every opportunity that comes our way. So as long as the proposition is compelling and it is something which fits into our overall strategy, we would look at it seriously. But nothing like that at this stage for Vita Biotech.
But strategically, this does fit into your thought process in terms of direction, at least?
I might not
It may or may not move into a transaction or may not get concluded. But it's an asset that you all would like to look at it?
We would like to look at certain parts of it, if at all, but clearly the full asset is not something which might be interesting because it is actually present across the globe. It's more nutraceuticals and the like, and clearly it has got a very different kind of a flavor, so to speak.
Okay.
So I wouldn't actually say that this is something that is very strategic to us.
Ramesh, you were saying that how, with the evolution, the shift has taken place away from US to other markets, and like Visupharma, that's the big acquisition that's going to conclude in December. So from an M&A point of view, are the Europe-UK markets a bigger M&A focus for the company compared to US now? And how much capital are you looking to deploy for M&A? Do we have a number?
Okay, a number of questions in the same breath, so to speak. But clearly, America started out as being, a feast of several kinds, essentially. But the feast sometimes turns out to be a famine. So clearly, one has to look at diversification, and other markets are alluring enough. Europe might not necessarily have the same kind of flavor in terms of realizations, but it's a less volatile market from my perspective. And of course, emerging markets have their own flavor. India is, of course, extremely alluring, and it's a market that we would like to invest a lot in. Other emerging markets, of course, carry risk as well as potential and the like. So from that perspective, we would be looking at various buys, so no market is actually cancelled out, but I think the capital allocation policy itself is very well framed from our perspective. In terms of horsepower that you spoke about, I would say that our overall limits to to borrowings would be twice that of our EBITDA. That would potentially make it about $1.5 billion to $2 billion, so to speak, over time. Our sweet spot would potentially be about $250 to $300 million. But we've also clearly drawn out thresholds in terms of where we would be investing and the like. It would be potentially in India. It would also be specialty in various parts of the globe. And clearly, PSU Pharma is a reflection of what we have just done.
What about INR depreciation? How is it impacting business for you and numbers?
INR depreciation always helps exporters, as you would appreciate, because the realizations go up. From that perspective, it certainly adds to our EBITDA margins and the like, and we are happy about it. Though, of course, it has got its own connotations in terms of pricing and, of course, in terms of input costs, if you reflect on that.
All right. So if you're talking about margins, I think for the last quarter, the adjusted margins were closer to 30% odd. But you have been maintaining that mid-20s is the number you're looking at. So what should be the margin guidance from here on, given that, business is doing pretty okay, going by what you're saying, and also you have this tailwind now with regard to the rupee depreciation. Does it help? Give us a guidance.
Clearly, we are being very cautious when we actually guide for this. And for example, Tolvaptan, so we expected the loss of exclusivity to click in on 13th of November, but though there have been a couple of approvals, they have not launched, so the party is still on insofar as this product is concerned. Clearly, we look at maintenance of this of the margin, so to speak. But I think the truth is, when you actually launch a generic product, it lasts for some time, and after that, it kind of the price erosion clicks in, and it's a bit like running on the treadmill. It has to erode at some point of time. And from that perspective, we believe that for the full year, about 26% would be very appropriate for our guidance. But clearly, we are confident about stepping up on the margins over time for sure. Next year, for example, we're guiding for close to about 24-25%, so to speak, because we do expect certain molecules to decline from a competition perspective, more players coming in. So shares let it be.
Got it. Just a quick final word on the two plants, Goa and Nagpur. There were some observations. How serious are they? And by when do you expect things to get all clear?
As with everything, we play a lot of reliance on compliance and the like, and we are certainly we are working with the authorities to make sure that it is remedied. It is where it is, but we are confident of actually getting this remedied as early as possible.
We have so many more questions, so we hope you join us soon again. But thank you, Ramesh, once again for being a part of CNBC TV18's journey and coming here down to our studio to celebrate this special day with us.
Always a pleasure. Thank you very much.
Thanks a lot.
Thank you. By the way, markets continue to slip and now below 26,100. So it gives us the perfect segue to invite Rohit Srivastava, founder of India Charts and Strike Money, on the show. Rohit, thank you very much for joining in. This is Rima here. Wish you would have joined us in the studio today. But how are the charts looking, and what is your near-term, medium-term view on the markets now?
Yeah, I wish the entire CNBC team on this special day, 26 years is a lot, and congratulations to all of you for having made it through this, and I'm sure there'll be many years to come. So wonderful job by all of you. And coming to the market, my sense is that we are still consolidating inside this congestion. 26,300 on the upside, 25,800 on the downside. I don't think there's a lot of downside beyond that. I do think that the markets will consolidate and eventually break out on the upside. It may be taking time, but the eventual direction is going to be higher, is what I think as far as the Nifty is concerned. On the Bank Nifty, around 59,000, I think, is the critical support. It's managed to hold on to that 20-day average for quite a long time. And I think it should probably continue to do so. So, in fact, Bank Nifty is probably the outperformer of the lot. Banking stocks have done better than most other sectors, and should continue to outperform going ahead as well.
Okay. All right. Hi, Rohit. Good morning. Good to see you in. Give us a couple of levels. You believe the Nifty is headed higher? Where is it headed, and who leads us up? As you said, the Nifty Bank is looking good. Almost went to that 60,000 odd mark, slipping a little bit as we speak. But levels on both these two?
So I think we go towards 26,800, eventually maybe cross 27,000 next year, but 26,800 is going to be the next level we'll be watching for once we complete this consolidation and break out above 26,370. On the Bank Nifty, initially probably 61,800 and eventually maybe around 64,000 is where it should go to. So both of them should continue to make new highs into the year end or apart from the near-term setbacks that we are seeing, mostly because of, I think, the small cap index, which is still weakening today.
Any stocks, Rohit? Any trading ideas for the medium term?
So I think I think the interest rate sensitive sectors, they come out on top. They are also been the best performers over the last month, which includes auto, banking, but I would also include metals, which is not up there yet. But I think commodities as a segment will do well given the rate cycle, given the potential direction of the dollar. And therefore, that would be the third sector to really focus on. So banking, autos, metals, I think are the easy ones to latch onto.
Any word on gold, since you're talking about metals or any other metal, base metal, precious metal, if you like anything from there? And also quick word on the Indian rupee if you've tracked the charts.
So on the base metals, I think they're going to do better than the precious metals, at least for the initial period of this year. And if it comes to equities, I think 2026 will be a year where equities outperforms gold. I know 2025, we've seen gold outperform equity. But if I look at the monthly chart of gold, the RSI is almost 91, 92, and that's extremely overbought. So I think it's a little risky to be in gold right now from a 6-month perspective. But I don't think that's the end of the gold bull market long term. Over 3 to 5 years, it might still eventually make new highs. But right now, I think it's a good time to shift that asset allocation away from gold towards equities. That will probably do better. However, the base metals, as you mentioned, are actually picking up, because when we go and look at prices of copper, aluminium, zinc, all of them have actually moved up over the last 2-3 weeks, gaining meaningfully. And I think the direct impact comes on commodity stocks. We are not seeing that so much in the domestic market. But if you look at the Dow Jones Industrial and Metals Index, it's actually made a new high, and it started to trend higher. So I think we will see that in Indian metal stocks as well. Actually, Indian metal stocks did pretty well last year, making new highs. So I think that is probably the reason they are not exactly tracking that move, but they will continue to do well. So I think base metals over precious metals is what I'm saying, and equities over gold is also what I'm saying. But when it comes to the currency, which also helps the commodity trade, because in India, when the currency weakens, commodity prices also inch up. I think the worst for the rupee is probably over here at 91, 92 range. I don't think we will go significantly above 91 level. And we should probably see strength in the rupee going forward.
Right. Rohit, thank you very much for joining in. In fact, Biocon is on our radar. This is on the back of the company looking to make Biocon Biologics as a wholly owned subsidiary. Ekta spoke to Kiran Mazumdar-Shaw on the deal. Listen in.
Two things that basically, I guess, swung it in this direction. The first, of course, was a holding company discount. And the second was the perceived debt overhang, which we basically acquired because of the acquisition debt. When we acquired the commercial interests of Viatris at Biocon Biologics, it was done with the aim of creating a large global enterprise, a very uniquely positioned integrated biosimilars company, which we thought would be rewarded, because I think that was the first time it was being attempted in India. And it was the biggest biopharma acquisition ever done, 3 billion plus. And we were a bit taken aback. We were very disappointed that we were actually penalized for doing that acquisition. And we saw Biocon's stock take a beating. The reasons ascribed were that they were very uncomfortable about the acquisition debt. And coupled with the, as you say, the holding company discount, we saw a huge devaluation of the Biocon stock. And that, by extension, lowered the intrinsic value of Biocon Biologics. So the whole, approach or the strategy of saying, let's take Biocon Biologics public because of this acquisition, which anyway has made us into amongst the top 5 biosimilars leaders globally, was not being met in terms of our objectives, our stated objectives, and we felt it was intrinsically undervalued. Now, with that in mind, we said, let's look at what's the best value accretive step we can take. And that's when we mandated Morgan Stanley to evaluate all the options for value unlocking.
Okay. Well, interestingly, now you'll have Shriram hold around 3 to 4% stake in the company, in Biocon. You have Viatris, which will hold around 6 to 7% stake as well. Just give us a sense in terms of what the relationship with such large shareholders would be, or such strategic shareholders would be with Biocon.
I mean, basically, when we look at all the strategic investors, like you mentioned Shriram and Viatris, I think it's really about how long they want to hold that shareholding in Biocon. But more importantly, I think the business that we are running, which is a biosimilars business, has a force of its own. And I don't think any of the strategic investors really would make a big difference to our path ahead. So whilst I welcome their presence in the Biocon shareholding, I don't know whether it would really influence the way we are building the biosimilars business. I think this is an opportunity for us to really now create a large biopharma enterprise which combines both biosimilars and specialty generics, especially when it comes to what I describe as diabesity, because we now will be the only company in the market globally to have a portfolio of interchangeable biosimilar insulin analogs complemented with a growing portfolio of GLP-1s, and that makes us very uniquely placed.
Absolutely. I'm going to get to the diabesity opportunity in just a bit. But one of the speculations, might I say, which might emerge is that Shriram holds stake. We have Mylan, which holds stake in the company as well. And there's always been speculation about Biocon's succession plan. So would that be an assumption that maybe the Shrirams of the world could possibly increase their stake, would probably approach you for maybe even buying out Biocon?
I don't even think that's really on the table, because I think, people talk about succession planning, and I really don't think people should worry about succession planning. I think we have an excellent management team. I think Biocon is professionally run. We have an excellent, board. Board succession has been very well managed, and I really don't think, we need to really think about any of the companies that you mentioned as having to be considered in a succession plan. So at this point in time, I think we are very well set up to drive the business in a very professional way, in a leadership manner.
Years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. Markets a little bit lower, but it's a good time to welcome our next guest, Pirojsha Godrej, Executive Vice Chairman, Godrej Industries, who joins in. Hi, Pirojsha. Good morning. Thanks a lot for joining in to celebrate our 26th birthday. Appreciate it.
Good morning, Nigel. Great to be with you, and congratulations to you and all your colleagues on this milestone.
All right, Pirojsha, we've got a few questions for you, but just to run through a few discussion points, that we're going to be focusing on properties, we're going to be focusing on which stage of the cycle we are at, the project pipeline, project funding as well. We'll also discuss the consumer business, demand outlook, commentary with regard to competition, and scaling up the acquisitions. Pirojsha, let's start with the real estate piece first. How's demand on ground? Are you seeing enough traction? The stocks, all real estate stocks have come off quite a large extent from the top. But on ground, how is demand? Is it still strong enough? And also, if you could give us a sense in terms of your analysis, which part of the cycle are we in for the real estate sector?
Yeah, I think, demand in the sector has actually been very robust for the last few years. We've seen Godrej Properties, for example, a compounded growth rate over these 3 years of over 50%. And we continue to see good traction in the current year. Even last quarter, our booking value growth was in excess of 60%. And I think there's a very strong outlook likely for the second half of the financial year as well. From where we are in the cycle perspective, Nigel, it's hard to be very certain, but my sense is that a typical real estate cycle in India has usually lasted between 7 and 9 years each end of the cycle. And I think this cycle upswing started around early 2021. So we probably are at the mid stage of the cycle, and I expect positive momentum to continue until at least 2028 or 2029.
Pirojsha, hi, this is Rima here. Nigel, CNBC is carrying a legacy of 26 years. But here is the Godrej Group carrying a legacy of more than 125 years.
Wow.
Built on trust, innovation, and just staying relevant. So it's apt that on a day like today, Pirojsha, you are joining us. So thank you very much for being here with us. So just continuing with, real estate and the momentum that we're seeing, up until now, growth for you was driven by, Mumbai, Bangalore, the NCR region. But now you're also expanding outside into newer cities, like you've got land parcels in Kolkata, Ahmedabad, Indore. So as you look ahead, say 5 years down the line, what would your revenues look like from the current 5,000 crore rupees? And what will be the contribution of newer markets? Can you give us a big picture and some guidance long term?
Thanks for your kind words, firstly, Rima. Look, I think the company is all set to scale very rapidly in the years ahead. If you look at how the accounting in the industry works, you're accounting for projects only for most developers, accounting for projects only once they are completed. So we have seen, as I mentioned, a 50% plus CAGR in our booking value, which will translate into our accounting revenue over these next few years. So while you rightly said our accounting revenue is only about 5,000 crore last year, our booking value last year is about 30,000 crore. So you should expect Godrej Properties reported revenues over the next few years to get to those kind of levels. And from this high base, we still believe there is a huge opportunity to continue to compound at, say, 20% a year. Because if you look at it, while Godrej Properties was the largest developer in the country by sales value over the last couple of years, we estimate our market share at only about 4.5% or so. So we think there is a huge opportunity to both participate in market-led growth, but also to continue to gain market share. We've almost doubled our market share in the industry over the last 4 or 5 years, and the goal will be to continue to gain market share. So I certainly think the opportunity before the company is a very large one, and we can certainly hope to see a very significant increase in numbers. And a lot of that has already been locked in through operations that will reflect in the P&L as these projects are completed.
All right, Pirojsha, let's turn our attention into the consumption space. Since you're talking about market share, what about in the consumer space? What kind of market share do you look at? How's the competitive intensity as well out there? Help us out with some guidance on that front.
Well, it's interesting. I think there is something to the kind of K-shaped recovery that a lot of people have talked about post the pandemic in India. We've certainly seen higher income asset classes like real estate performing very well. There has, as you know, been a bit of pressure on demand in the FMCG space, but I think we're quite excited about the steps the company has put in place and about the overall FMCG opportunity long term, which continues to remain robust. So I think in the short term, we're focused on establishing category leadership in all of the markets that we're present in consumers. So for example, we're already today the leading player in household insecticides, in air care, in hair colors. We have a strong number 2 position in soaps. So the goal there will be, again, to, in all our existing categories, establish leadership positions. We also want to ensure that we're increasing our total addressable market on a consistent basis. Sudhir, the CEO, has worked on a plan to look at what we expect FMCG in India to look like in 2040, basis how the categories have grown in other developing countries, and have kind of backcasted from there to see what are the categories that we as a business should be in. And have taken several strategic steps to make sure we are addressing those. So, for example, we expect perfumes and deodorants to be one of the largest segments within FMCG in 2040, which it isn't today. We've tried to address that by establishing a strong position through acquiring Raymond's FMCG business, which has a large perfumes and deodorant play. Similarly, we expect pet food to be a huge opportunity. Pet care, if you look at globally, is a huge market. Somewhere like China now, it's been quite crazy to see the growth in the number of pets. You've had statistics cited that there are now more pets in China than children under a certain age.
Yes.
I think this is a huge opportunity here. We've entered organically through a brand called Ninja, which is in its very early days, but something we're extremely excited about. Similarly, if you look at home care, we've entered through Fab, the liquid care market, and that's been one of the fastest growing products in any FMCG category. So I think this combination of focusing on the core, trying to establish leadership positions in all our existing categories, while making sure we're laying down the bets for the future categories, is how we're approaching the business.
Pirojsha, are you still on the prowl? That male grooming business is what you bought. Any more inorganic growth should we be looking forward to?
Well, I think we have a clear preference for organic growth. I think that's where we think, most value can get created. But where we see exciting opportunities, we're certainly on the prowl, as you put it. Ustaq, for example, we thought it was a great business, relatively small in scale, but already very profitable. I think the team there has done a fantastic job using influencer marketing and things like that to ensure the brand has scaled quite rapidly entirely online. We hope to now take it offline as well as learn some of their tricks on their online marketing capability.
Pirojsha, it's always a pleasure having you on the show. Thanks a lot for joining in, celebrating this big day with CNBC TV18, and thanks for supporting us over the last few years, and looking forward to your support over the next few. Have a great day ahead, and we catch up soon.
Great to be with you. All the best.
Time to slip into a short break. Lata's waiting for us on the other side. She's got the management of PNB. Don't go anywhere.
"26 years of CNBC TV18. 26 years of CNBC TV18.
26 years of CNBC TV18, and I have been in the company for 24 of these years. Thank you, viewers, for watching us, trusting us, and questioning us if we don't question our guests enough. We have brought you and will be bringing you the best and the brightest of India Inc. today, as we have done all these years. And joining me now is the CEO and Managing Director of the second largest PSU Bank, Ashok Chandra of PNB. Mr. Chandra, good morning, and thank you very much indeed for joining us on a very special day. Well, let me let you in on a secret. Our birthday is actually December 6th, and we wanted to celebrate it on Friday. But we anyway had the governor for the better part of the day. We had the SBI chairman. So we decided to celebrate our actual party day with you. And therefore, thank you very much for joining us.
Thank you. Thank you very much. I think on my personal behalf and on behalf of the entire PNB Parivar, we wish the CNBC TV18 team a very good luck and all our good wishes. And we are very confident that the momentum which you have brought it in the system and your insights on the finance, banking, and the Indian economy, global economy will continue to enrich the people going forward also.
Thank you
all
so
my good
much.
wishes.
Thank you so much, sir, for that generous praise and for the responsibility. Let us get to brass tacks. As soon as the governor announced the rate cut, we saw that home loan cut being announced by Punjab National Bank. But clearly, deposits you all have not cut. You think there is no space for your cost of funds to go down?
See, we have already done two exercises in two phases in the deposit front. One, we had done one exercise in the saving deposit, and we expect that with this 25 basis point cut, is not going to influence the rate cut in the saving deposit. That is the first thing.
Okay.
Saving in the term deposit front also, we have done the rate cut in the fixed deposit, whereas we had that special deposit scheme. We have brought it down, and with this 25 basis point cut, I think we are going to absorb it in our system. And going forward, we will see in the Q4 how it pans about, and then we will take any decision. As of now, in this particular quarter, we are not going to cut any deposit rate now.
So what happens to your margins? In Q2, your margins dipped by 10 basis points, and you said this is about the worst. Will you experience more margin push now, this Q3 and Q4?
See, we had indicated that if the status quo is there, I think I had already given the clue also that around 5 to 7 basis point improvement will happen in the Q3. Now, we all know that the 100 basis point CRR cut which has happened, and the full benefit which we are supposed to get, we have got that. So almost 15,000 crore PNB has got, and that amount has been released. So we expect that whatever the benefits that is going to accrue with this release, I think that is going to offset this 25 basis point cut which has happened in the system. We have calculated what is the impact that is going to happen on our NII. I think around 100 crore is going to impact in our NII in this particular quarter. And going forward in every quarter with this 25 basis point cut, I think around 325 crore will have the impact on every quarter. The way the credit growth is happening, I think definitely I am very confident that the guidance which we have given, we will be able to hold on to that level.
Okay. You did 10.5%. Now with the rate cut, will your advances growth be even better?
Yeah, we are expecting in this particular quarter, I think 11 to 12% growth should happen.
Okay.
QOQ, if you see the last quarter also, we had a good growth, especially in the corporate segment. The last quarter also, QOQ, if you see, it was more than 3%. And in this quarter also, I think the QOQ growth will be around somewhere 4%. And 11 to 12%, definitely I'm expecting the credit growth will happen.
Which verticals are demanding maximum credit?
The retail, definitely there is a very good push is happening, especially the vehicle loan front, 30 to 35% YOY growth is there now. Housing is also doing very well. So the momentum which was there in that Q2, I think there is some improvement further it has happened in the Q3. MSME, we had grown at 18.6% in the Q2. And that trend is continuing in this quarter also. Corporate loan book, I think if you see our Q2, we had shown a growth of 7.5% in the Q2.
Yeah.
There has been some good improvement happening in this Q3, and I'm expecting that we'll be touching to that double-digit mark, and that will be the real good improvement happening in the system.
Oh, that is good news. The State Bank of India chairman was hoping that there will be capex growth. He was saying there's corporate demand, but not yet capex demand. What is your sense? Do you think that private capex demand is picking up at all?
I have started seeing that trend happening somewhere from the latter part of October onwards. And that is the reason I have indicated this figure. And that is happening in the various segments in the corporate loan book, whether you talk about the renewable energy or the infra, power in general. Then there are other InvITs are there, retail InvITs, data center. I think various segments, the traction has started happening in the corporate loan book. And that is a very good sign for the economy as a whole.
Okay, sir, before I let you go, any word on mergers or consolidation? We heard some buzz. Will PNB become bigger because of some inorganic acquisitions of banks, consolidation?
I think we need to wait and see how this entire thing happens. And see, today PNB is one of the strongest banks in the country now. And if you see our balance sheet size, the qualitative improvement that has happened in the different ratios, I think we are well poised to take any such decision happens in the system. I think we are capable of handling anything in the country.
Okay. Just a word, when you spoke about margins, this quarter also margins will go down. You were about 2.9%. Will you see a further dip in margins?
No, our domestic margin was 2.72% in the Q2. And I'm expecting that I think we will be holding to that level.
Okay.
Around 2.7 to 2.75, definitely this level will be there in the domestic NIMs.
Okay, okay. Have to leave it, sir. We have a string of big and best and the brightest from India joining us. And thank you very much for being part of our celebration today.
Thank you very much, and my pleasure to be with you. Thank you.
Okay, well, that's the word coming in from the second largest PSU bank. He says he's capable of handling any consolidation. So not ruling out that maybe something will come. Let's take a break on that note. Up next after the break will be Chartbusters.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and as we speak, well, the market's a little bit under pressure, down close to around 100 points or thereabouts. And Mangalam, it's the 26th birthday, so we continue to be in good mood, you know, and keep it going.
That's good cardio, Nigel. You know, perfect for the wake-fit guys who will come later for the IPO, because once you're tired, you'll probably get better rest as well. But be that as it may, I'm sure when you joined CNBC TV18, you weren't 26, were you?
I was younger than 26.
Yes, same here, Nigel. And, you know, it's so good to see the channel turning 26 and we remembering that we feel 26 still, you know, oftentimes less than 16 as well. But be that as it may, what a brilliant journey this has been for us, the channel, the viewers, and we have no one to thank but our leadership, but more importantly, the viewers who've been constantly giving us incredible feedback, constantly nudging us as well. Guys, you asked that question wrong, so why not improve upon that?
Yes.
So we've tried our best, and from Nigel and me, all we can promise is we'll continue to do our best for the next 26 as well.
Well, that's right. Feedback is what makes us. You all have made us, so we are happy to be out here. And Mangalam, you know, I was just looking at the records today, and I think, you know, I joined in as a, you know, as a trainee, as a junior out here. And I think as of now, in terms of male anchors, I think I have the record of the highest number of years male anchor at CNBC TV18 in 15 years. That's a record maybe you break in the time to come.
Let's see. I know we'll do this together, Nigel. And it's only poetic that the Nifty is at 26,000 when we turn 26 as well. But let's talk about fueling the market ahead and fueling our cars as well. Our colleague Sonal spoke with HPCL's Vikas Kaushal and discussed multiple factors, including the impact of rupee depreciation, the company's crude sourcing strategy, and the updates coming in on the demerger of their lubricants business. This is HPCL that we're talking about. Let's hear out that conversation, come back, and then after the break, we'll have the management of Wakefit joining in.
Depreciating rupee is more of a macroeconomic situation. We've touched 90. Obviously, the increased rupee to dollar has an impact on crude imports. Companies like us import a lot of crude, but still the depreciation, if you look at it, has been in range of couple of rupees, which we've been able to absorb. On the second point you said about diesel cracks, etc., well, that is a demand-supply phenomena. In our industry, that really is dependent on global demand supplies. The diesel crack, as we see, are actually globally published numbers. We look at Dubai cracks and others, and we follow those. Now, for an integrated marketing company, refining and marketing, actually it does not impact. What impacts me is the price of my crude and the price of my product. For anybody who has a balanced portfolio on both of these, if your crude, the cracks are higher, you earn higher refining margin, you earn slightly lower marketing margin, but net you earn roughly the same amount. At HPCL, we have a slightly less balanced portfolio as compared to some of our peers. We have refining of about 25 million tons on our own, plus we have some joint venture refineries, but we sell more product, and hence we are a net buyer. To some extent, it impacts us, but then this is something which we are very used to in our business. We plan around it, and I don't see that as a major concern. Yes, there was a spike to even early 30s on diesel cracks, but those have started cooling off right now, and it does not make a massive impact on our numbers. The good part is we are also coming very close to balancing more of our refining and marketing portfolio in the next few quarters.
Mr. Kaushal, you mentioned that what matters at the end of the day is crude sourcing and the product prices. So let's talk about the crude sourcing, because there have been a lot of developments there. Is HPCL not buying any more from Russia and adhering to the following the sanctions that came by? And what is the crude basket looking like right now?
Yeah, I think, Sonal, there are two parts to that question. Are we adhering to the sanctions which are there? I think every law-abiding citizen, every law-abiding company follows the international decorum, international rules in this entire thing. So we also follow that. The rule prohibits companies like us from, the sanctions prohibit companies like us to buy from select companies. We are not buying from those. Remaining everything is an economic decision which we take on a regular basis. Just to give you a bit on how we buy crude, Some of our crude is bought on term agreements, which are like an annual agreement where we commit to volumes and we commit to time periods when the cargoes are going to come over. And remaining is bought on spot. The term is anyway done at the beginning of the year. In fact, right now we are thinking of how we do the terms for the next year or planning that. On the spot, every month we go to the market a couple of times and buy what are the best available cargoes to us from an economic decision. At that point of time, we see what is fitting in our crude basket, what crudes we have available, what is needed in our refineries, what can we run at this point of time, and what will make the most economic sense there. Again, if I just look at the global crude situation, you would have seen the crude prices have been reasonably stable despite the upheaval around geopolitics. They have been in mid-60s all this while, which points that there is a reasonable amount of crude which is available. At HPCL, we have technical capabilities of processing anything up to 180 kinds of crudes globally. In any year, we would evaluate up to 100 plus crudes, which we take, and many of them, a subset of them, we run in our refineries there. So every time we go to the market, we look at 30, 40 different crudes, see which is economically fitting into our scheme of things the best, and buy that particular thing. We see enough crude is available. Our basket of buying crude is wider. We have bought crude from South America. We have bought crude from, we recently bought it from US. We have brought it from Guyana, a lot of Western African crude, and then of course the Middle Eastern crude. So there is a different variety of crude which is available, and all those options are available. Plus we also run the indigenous crude which is produced in India. So we are quite comfortable on that. Thankfully the prices on crude have been reasonably stable, which gives sort of a predictability to our business.
Got it. You know, the other part of the business is the lubricants demerger. Analysts were quite positive on that, but there is some postponement on that. What happened here?
Yeah, I think that's a very interesting question. Every analyst call I get asked that question. 2-3 years ago, HPCL board, I wasn't a part of the board at that time. I wasn't in the organization then, but the board then decided to demerge the lubes business and float it separately. In the last year after I came on board, we've had a chance to think through that particular strategy, and we believe that there is a lot more we can do by building that business internally at this point of time and unlocking the value at a future period of time. So let me say we have prioritized our efforts on building a stronger consumer brand. So if you see a lot of advertisement, if you're watching the India-South Africa cricket, you would see the Virat Kohli century with the HP Lubes advertisement in the background. So those are the things we are doing in strengthening that business, because we believe lubes is a very interesting business for us, where we can create, we already have a strong brand and we can create a bigger consumer facing business and hence create a greater potential around that business. So it's just I would say a strategic call that we believe the business can be built better internally at this point of time.
Got it, got it.
And but maybe when the decision was taken, we needed it more. It was more of a financial call also. Fortunately, in the last 12 months, we have done, touch wood, quite well financially. So it wasn't, we are more keen on building that business for the future.
It's very interesting to know. Such a pleasure speaking with you, Mr. Kaushal, today. Thank you so much for joining in with your insights and the outlook going forward. It was a pleasure.
Yeah, thanks, Sonal, and I wish you and your team all the best on this great day, and continue entertaining, providing information as you all do. Thank you.
All right, providing information indeed. That's what we do. Thank you, Sonal, for taking us through that conversation. The Nifty closer to that 26,100 mark. We take a short break, come back on the other side. The management of WakeFit Innovations. The public issue opens today. The management joins in on the other side to decode the growth prospects for the business. Chaitanya Ramalingagowda joins in.
26 years of CNBC TV18.
Welcome back. It is the season of primary issues, and this one comes in from the consumer durables, consumer use case space. It is that of a mattress, furniture and furnishings company, Wakefit Innovations. Chaitanya Ramalingagowda, who's the promoter, executive director of the company, joins in. The near 1,300 crore IPO opens today, of which 900 crores is an offer for sale. Around 380 crores is fresh issue. Thanks a lot, Chaitanya, for joining in. You're seeking a market cap of nearly 6,400 crore rupees at the upper end of the issue price, which is pretty much similar to, the market cap of Sheela Foam, which obviously post the Kurlon listing has a market leadership position as well. So the one thing that the street would definitely like to know is a sustainable growth rate for the company. Over the last few years, your revenue has compounded at around 25%. What we want to understand, with the money that you will deploy towards building your company-owned, company-operated stores over the next couple of years, and the growth that you will have in alternate channels, etc., will this 25% sort of revenue growth sustain? If yes, if you could break that up into same-store sales growth, if you could break that up into channel-wise growth, and perhaps category-wise growth as well. I think you're on mute.
Sure.
Yeah, go ahead, Chaitanya.
Firstly, congratulations to you and the whole team for completing 26 years on this day. In terms of what you said about the Wakefit versus the industry, the one thing that I'd like to mention is that Wakefit is different from some of the listed peers, primarily because of the way it's grown up in different categories. For example, we are a multi-category company, which means mattresses is only one part of the overall business. Furniture has already grown to be about 30% of the business. Furnishing and decor is also 10% of the business. The second big differentiator is we are a vertically integrated full stack company, which means from research and development, manufacturing, engineering, supply chain, logistics, your own sales channel and brand, we own everything, which means there's no middlemen, nor are there contractors. So we source everything, manufacture everything, and hence we are a D2C brand. So we completely work with the customers directly. Good, bad feedback we take, we learn, and we iterate. So those are some of the major differentiators. But in terms of growth levers, all three categories are growing very steadily. Mattress is obviously the 11-year-old business, very steady, very mature, very profitable, and that is 60% of our overall numbers. Furniture, barely we entered about 3 to 4 years ago. That's already become 30%. Given the smaller base, it's growing way faster. Furnishing and decor also has crossed 100 crore mark. So all three businesses are scaled businesses. But when you put them all under one single umbrella, between our same-store sales growth, online growth, we are confident of delivering a sustained number. In our industry, unlike a tech company, we're a tech-enabled real business with physical products, 5 factories.
Got it. Right. All right. Hi, Chaitanya. Good morning. Good to see you again. And hopefully 26 years later, your company is one of the top companies getting into the top indices as well. We wish you all the best on that front. But give us some more detail in terms of growth. As my colleague Mangalam asked, you can continue at this momentum. That would be mid-20s in terms of a percentage growth. And also, since you're both furniture as well as mattresses, what will an ideal mix look like? And what is the margin difference?
So in terms of growth rate, obviously I cannot comment on a specific number, but
you can tell us whether the growth will continue at the similar momentum. That's par for the course. Regulators are okay with that.
Correct. You're absolutely right, because we are not a tech company, we're a tech-enabled business. And so many physical moving parts are there. Any improvements that we bring, any growth channels that we bring has a sustained impact for a period of time. It's not a flash in the pan. So when our stores are opening at a pace of about 35 to 40 stores per year in a very sustained manner, that really compounds over a period of time, because last year's stores become mature this year. Similarly, premiumization. We didn't have premium products 2.5, 3 years ago.
Right.
Today in stores, nearly 30% of the product sold is premium. So those are the kind of secular trends that Wakefit is which gives us confidence that we can continue to keep the momentum.
All right. So revenue momentum continues. Just a final one before we let you go, because you're in the stock market now, the street will look at your margins and your earnings a lot more closely as well. And surprisingly, 1 half before your IPO, the EBITDA margins have jumped from 4.6% in FY25 to 11.9% in the first half of this year itself. What is a sustainable margin and profitability run rate that we should expect going forward?
We believe that there's a lot of juice left in the business, primarily because we are relatively new in one of the major categories, which is furniture. It's also profitable, but we believe the headroom there is much, much more, especially because it's a greenfield project. It's one of India's largest furniture factories. It's in Hosur, 50 kilometers from where I'm sitting. And that the ability to sweat that asset as the demand goes up, ability to sweat our warehouses and logistics as the demand goes up, there's a lot of headroom there in terms of margin improvement. And just to give you a sense, in the first 6 to 7 years of our existence, we were profitable. We went into the red only because of the greenfield project, and now we are back in profitability.
All right, Chaitanya, thank you so much for that. The street would take note of this on issue opening date. But mind you, both Nigel and I will be speaking to you on the listing day as well. And that time we'll press you a little more for questions and numbers. By then you will be able to answer a little more as well, and you'll be out of the regulatory lens. With that, what we'll do is take a short break and allow you to take that break as well. On the other side, we'll get you more on the markets and stock-specific action. Stay with us.
"26 years of CNBC TV18. "26 years of CNBC TV18.
Welcome back. As you can see, to the bottom of your screen.
Usually it's the top of the screen, and now it's the bottom of the screen.
Bottom of the screen, the Nifty is a little bit lower, Sensex a little bit lower, but the 20 DMA still continues to get defended, which is ballpark around the 26,000 odd mark. It's our birthday, 26th birthday. We'll wrap up on Chartbusters. The team of Trading Hour is standing by. They come up next.
Years of CNBC TV18. Years of CNBC TV18.
"26 years of CNBC TV18 of leadership, of innovation, of impact." We come to you live from the CNBC TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormaz Fatakia, and joining us from Bangalore is Ritu Singh. There you have Ritu. as well in all her golden glory, celebrating the 26th birthday of CNBC TV18 as well. The good part is the Nifty is holding on to that 26,000 mark. Poetic or not, we don't know. Currently 120 points lower from the highs, around 250 points off its record high as well. No real worries in the front end of things, but the broader markets, that's where a lot of selling has taken place right now. As we're looking at it, nearly 2,100 stocks which are in the red, for about 700 stocks which are in the green. Let's go across to Ritu. Ritu, I believe you have some more to add on the market and the 26 years of CNBC TV18 straight from Bangalore.
Well, yes, and good morning to you guys, and a very happy 26th birthday to CNBC TV18. Manglam, I heard you say you were not 26 when you joined the company, but I actually joined CNBC just a few days after I had turned 26. So, I mean, quite the journey it has been, and the markets, from finding their place to now where they've gotten. Now, of course, Sensex, down in trade today, of course, about 345 points as we speak. Nifty down about 120 points. Lots of stock-specific action, but we're going to focus on some of them here. But first, it's off to Hormaz for the buzzing stocks of the day.
Yeah, and Hormaz is actually right now as we speak. Hormaz, tell us more.
I would surely love to be back to 26 again. But yes, as you mentioned, the broader markets, right? The broader markets are not doing too well for themselves. Neither are the benchmarks. But the 20 DMA on the Nifty is the more important level to watch out for. But that, of course, does not take away from the fact that there are plenty of stocks that are moving around in the broader markets. The SpiceJet is one of them. It's up 11%. Matrimony.com, the company announced they will be considering a buyback of shares. That's up 9% as well. So there are enough and more stocks that are seeing traction in the broader markets, and one such name is Fino Payments Bank. It's a news flow driven name, and Ritu has more on this, and of course we are joined by the management as well.
Well, yes, Hormaz, they've got an in-principle approval from RBI to become a small finance bank. The final approval, of course, is still awaited. If all goes to plan, they will officially become the first ever payment bank to successfully transition or make this jump. For now, they're going to keep operating exactly as they are today until the final license comes through. Rishi Gupta, the MD and CEO of Fino Payment Bank, joins us now to talk about how life changes. Rishi, congratulations on getting that long-awaited in-principle approval now from the RBI for the small finance bank license. Begin by telling us how life changes in terms of the structural, the capital, the governance changes you have to bring about, specifically with respect to shareholding as well. You of course have Fino Paytech that holds majority stake at the moment, within which the investors may have to look at reducing their stake to comply with RBI norms.
Okay, thank you, Ritu, and thank you to all your viewers. Congratulations on your 26th anniversary as well. And we are grateful to RBI for giving us this opportunity to convert the first payments bank to convert into a small finance bank. So too many questions. Let me just try to broadly cover. So Fino Payments Bank continues to function in the current form till the time we get the license operationalized. We have enough capital to start with, but we will soon see how we want to augment that capital as we move in that direction. From the life point of view, Payments Bank cannot do lending and has limitation on the liability. So both from a liability point of view as well as from the lending point of view, it's a big change for us. We have set up a large distribution and have been very advanced on the technology part. So with the distribution and the technology and the digital mindset which we have, we plan to create a very differentiated small finance bank. A very asset-light small finance bank and a very low fixed cost kind of a model. The way we have built up the payments bank, we are also going to augment our IT as well as our HR resources as we go forward in that direction. But all in all, I would say it's a very, from a payments bank model to an SFB model, our outlook is very bullish, and we are quite positive that the transformation of the company with the kind of benchmarks they have built in the last 7-8 years will really differentiate Fino vis-a-vis the other SFBs in the ecosystem.
All right, Mr. Gupta, we've been having this conversation for the last 2 or 3 years, and the first time this idea was floated, the stock price was closer to where it is right now, and now because of the fears that the investors are having on near-term selling by the funds or shareholding structure changes, the stock's taken a bigger knock as well, down around 7%. So technically, the investors aren't sitting on any returns, negative returns if we account for the opportunity cost, etc. as well. So from a larger standpoint, from here on, if you could give us a sense on how business would be shareholder friendly, or will it be? How do you change some of your key matrices from here on? Say 1, 2, 3 years from now, what's your target?
So from where we are currently, the lending business obviously will take 12 to 18 months to come as we get into the entire restructuring and everything which we have to do at the holding company level. Capital, as I said, we don't require. From a margin point of view, I think the margin of a lending business and annuity income which will come up will definitely boost the bottom line of Fino to a large extent as we move in the direction of a small finance bank. As I said earlier, we already have the rails on the ground. We have the people at the corporate level. We already have a lot of people on the field. So our cost structures will not drastically change or will get added to a large number when we move from a payments bank to a small finance bank. From an investor point of view, I think a lot of profit booking is happening at this stage because this has been in the offing for the last couple of months. So some profit booking is happening. But from a long-term point of view, I think the build-up to the small finance bank and further as a small finance bank, I think the certainty with regard to the top line and especially on the bottom line will be there. We expect that the bottom line growth will be exponential once we move to a SFB model. See, one of the big differentiator, apart from the fact that we have a distributor-led model, but our cost of fund is also at about 2%. And we have about 2,600 crores of total deposits with us. That is a good starting point. We have a merchant network which we can use for lending purpose. So that starting point which we have both from our liability as well as distribution, I think is the key and will differentiate us vis-a-vis everybody. So from an investor point of view, I think this is a big positive move from the company. And we expect that once the selling pressure is off, we should see some recovery happening. And from a long-term point of view, I think the stock will jump from the point of view that we have building a model which is more stable and more predictable.
Well, Mr. Gupta, given that you've been preparing for this for the last couple of years at least, just give us a sense of what targets you have specifically on lending. How large a book do you think you can build on your existing base, say in the first year of operations? How much of it will be secured versus unsecured? And on liabilities, now that 2 lakh cap goes away, you've already got a 2,600 crore rupee book. How do you plan to grow that, especially with the new branches you'll open?
So two things. One is we are digitally enabled bank and secondly, we are a liability first. So we expect that the liability growth will be about 4 to 5 times from the current level over the next 4 to 5 years, maybe 3 to 4 years post the operationalization of the license. So we expect a significant growth coming on the liability side. We want to keep our credit deposit ratio around 70 to 75% to start with. And vis-a-vis that, our numbers will be about 70 to 80% of our deposit ratio. So we expect that the journey in the next couple of years will be about 8 to 10,000 crores of lending book and about 14 to 15,000 crores of deposit, maybe 3 to 4 years post our operational license.
All right. Thanks a lot, sir, for joining in. Thank you, Ritu, for taking us through that conversation as well. What we'll do is take a short break, but there seems to be a bit of a pair trade which is going on in the markets right now. Interglobe Aviation, the crisis that there is right now, we've seen the stock being, beaten down almost 6.5% from its peak. It's down over 20% right now. And on the other side, Horma spoke about SpiceJet. Just pull up the intraday chart of that one as well. Some point, if both of them come together, you would see SpiceJet up around 10% as Interglobe is down about 6% because aviation, obviously, a zero-sum game when it comes to just that day of bookings. Take a short break, come back, doing more market talk continues. Sunil Singhania, the founder of Abacus Asset Manager, joins us here in the studio.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. You're watching us here on Trading Hour. A couple of stocks which are making some moves right now on the way up. Matrimony up in double digits. The board meets on December 15 to consider a buyback. So that's something we will be monitoring for them. Seagal India, that's another stock which has picked pace in just the last few minutes. In fact, this year it's been fairly weak, down about 29% from the peak, but currently seeing some bit of buying. And Dronacharya as well. After a big down move that we've seen over the last few trading sessions, the stock is now seeing some purchase. But it is our 26th birthday and we are celebrating it with people who've been with us for so long and constantly spoken about the industry and industry leadership as well. Abhijit Roy, the MD and CEO of Berger Paints, now joins us. Abhijit, thank you so much for joining us today, but also more importantly, thank you so much for being the voice of the paint industry through our channel for the last many years. And you've been with us through the good times of the paint industry, competitive times. Every time there is any development that happens, you've definitely been the first port of call for all of us to increase the awareness on the industry from a viewer standpoint as well. So we would like to thank you for that. And that's exactly what we will ask you today as well. We're about a month and a half into the third quarter. How has demand been? Because the second quarter obviously was impacted by unseasonal rains, earlier festive season. You said all of this is demand delayed, not denied, and it will come back in the third quarter. Has it come back?
Good morning, Mangalam. So, in October month was a bad month for entire paint industry, in the sense that, the rains had continued at that point of time. And therefore, there was a demand lag at that particular time, and therefore that month of October was for the entire industry possibly negative. In November, it did come back to some extent. We had a single-digit growth, and we are likely to see better, in the month of December. So this is what has happened so far in the quarter 3.
All right. Likely to see better growth in December, saw single-digit growth in November. How has competitive intensity been? I spoke to Asian Paints earlier, and they said that the worst of competitive intensity is behind, but they're getting fairly aggressive. Now, everyone wants to be number 2. You are number 2 already. So there is a fair amount of, pressure cooker-like situation where everyone is aiming for your spot. The leader is looking to hold on to their spot, and all of that has been taking place over the last 2 years or so. But now, has the intensity waned off?
Yeah, it has reduced a little bit, because, now everyone is aware what has happened, what is going to happen. More or less, things have settled down to normal levels. It was coming in from a zero base, there was an aggressive competitor which was gaining ground and gaining market share as well. And therefore now the curve has stabilized at some point, right? It was growing from 0 to say, 6.5%, 7%. And from 7% on, it has been stable at these points. More or less, the incremental gains are still happening, but, that's not, very big in terms of the disruption on the ground. So it is better now, and hence going forward, this is going to remain, stabilized, hopefully, because we don't see major changes happening anymore in the industry as such.
Abhijit, what does that do to the entire financial scenario then? Because now you are heading into a season where you are heading towards the new year. The wedding season is at its peak. There will be demand for paints and so on. Are you looking to ramp up ad spends in the second half of the year? And if so, what does that do to your margins and to your otherwise financial profile as well?
So the advertisement, is booked in advance, and, it is, done with a planning for the year. We will not change it, suddenly. So it's already there as budgeted, and we will continue to spend as per that. Of course, if the demand picks up, that will possibly help in, improving the margin a bit. That will happen possibly more towards the fourth quarter and then going forward the next whole year. So that's what we are looking forward to. And as things stand today, the demand is there. It is improved from what it used to be, in the last 4-5 months because of the rains. As I said, it was very bad, and there was a lot of angst in the in the dealer community as well, which has been, eating into the growth rate also, therefore. And now with that going away, with demand picking up gradually, we see demand coming back as far as the growth is concerned. The growth momentum is improving month on month. So November to December, we see an improvement already. And from December to January, and January, February, March should be better. As we had predicted, November, December possibly should be single digit growth. And December will be more closer to, in terms of value growth, I am talking, more closer to 7-8% levels. And maybe next year we will go back to the double digit growth that we were used to.
All right, Mr. Roy, back to double-digit growth. Next year, you're talking about growth momentum picking up month on month, demand improving. How will you support that? Could you give us a sense of what your capex plan is? And also, how do you think you could end the year in terms of market cap? You've been talking about competition. Now you have about 20% plus share as of FY25. Where do you think you'll end FY26?
Similar at similar points, more or less, it will be static. I don't see that, changing too much. It will probably be around the 20% mark, by the end of the year as well. That's where we are likely to be, because the industry is not growing too much, even the new incumbent who has come in, sort of, stabilized as far as market share is concerned. No great big gains happening. So therefore, more or less, it will be static levels, going forward, and it will end possibly around the same point at the end of the year.
26,000 crore revenue by when? Asian Paints told us 50,000 crore in the next 4 years.
We had said that 20,000 crore by 3031, and that's what we stick to. We will be there at 20,000. We will be at about 12,000 crore at the end of this year. We pen in, a growth rate of about 11% to 12%, hopefully in the next 5 years. And that should take us to the 20,000 crore level without any acquisition.
Pleasure having you as always, Abhijit. Thank you so much for sparing time and joining us today on this very special occasion. Wish you good luck for the rest of the year as well. Take a short break. We'll be joined by Sunil Singhania, the founder of Abacus Asset Managers, on the other side to talk more on the market. Stay tuned.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back, and taking the conversation on the markets forward, still 100 points lower on the index. We are joined now by Sunil Singhania, the founder of Abacus Asset Managers, on this very special occasion today. Sunil, good morning. Thank you for joining in on our very special day.
Thank you, and best wishes on the 26th anniversary of CNBC.
It's a lot of coincidences, right? Your daughter celebrates her birthday around CNBC TV18's birthday, and
every year I come on December 7th.
Right.
Which is a birthday. This time
that's CNBC TV18's birthday as well. We are celebrating it on December 8th because the markets were shut yesterday. And also, it's a momentous day for you. The mutual fund launches today. So, multiple occasions for celebration. We only request you to come more often to our studio here to celebrate this. And also, obviously, we'll...
No, thanks a lot. So, yes, mutual fund gets launched today. So, it's a big thing. Nigel's mother shares the birthday with Khushi. So, it's always a pleasure to be here on December 7th. This time we are on December 8th. And as you said, Mangalam, it's a coincidence that we are also launching our mutual fund today.
Very congratulations on that as well. You know, Sunil, it's been a year of resilience, right, for our markets. We fell to those lows in April, then we have recovered, and we have had multiple headwinds. We had the tariff tantrums and so on and so forth. But what do you see now going forward into 2026? There are still headwinds that are still there. The trade deal is not signed yet and so on and so forth. But do you believe that the markets will continue to remain as resilient as they have been this year, especially because of the domestic money that's coming in?
And I think you're right, but you're kind that we have been resilient. I think we have You know, it's been a challenging 15 months when you compare it to other asset class, including global markets, obviously gold, silver, and particularly broader markets in India. Last 10-15 days have been causing a lot of concern. But I think, as you rightly said, we have also seen so many headwinds, you know, multiple small wars, and then this tariff thing just does not seem to be getting out of the way. Hopefully, I think tariff, the delegation is coming 10th of December. That is what I read in the news, and hopefully we'll have some positive coming out of it. We have seen at least world being more peaceful. Except Russia, Ukraine, most of the conflicts, at least for now, are set to rest. And even Russia, Ukraine, there are talks going on. I think domestically, both the central bank as well as the government seem to be on an overdrive. You know, 10 lakh crores of liquidity surge into the system, 4 rate cuts totaling 125 basis points. From the government, you have an income tax cut, GST cut, and the mood is clearly to support domestic growth. So hopefully, as we move forward and we go into the next year, which will also be the time for budget, we will have this momentum continue. Corporate profits have picked up. September 25 was better, not the best, but better. But our view is that if some luck on the tariff thing happens, then the next half and the year following that will be good. I think one thing which is sort of a headwind apart from tariff is the huge flow or supply of paper. Right. And that is meaning that all the incremental inflows are just going into absorbing that flow. Right. There's not too much money left to buy stocks which are already listed.
Which is why we need people like you who have the money to go ahead and buy some of the stocks, etc. You know, you said that we were kind in calling this market resilient, but you've also been humble in calling it bad, because some of the stocks that I was looking at, you know, some of the names, Shriram Pistons, etc. 1,000 in this market has become 3,000. Some of these SME bets that you've made, all of them are at near record high, if not at record high as well. So you've been good in the space that you have, you know, identifying mid caps, small caps, the themes that there are, betting on the Indian entrepreneurship. Are there any opportunities right now? Because I remember Nimesh had put out a piece last Friday saying that even as the indices are at near record high, in the broader markets, there are 40-50% of the stocks which are down 30, 40, 50, some of them even 60-70% lower. So in this correction, are you looking at some opportunities? What are the themes?
So we are always looking for opportunity. I think that is our job. But, you know, just to give you a little bit of perspective, I think in 2024, particularly when the election fever was on, between June 24 to October 24, we had sort of a blowout rally in some of the smaller companies. So my view is, you know, that time they got priced maybe 20-30% higher than they should have had. And I think now we are seeing in that correction mode. Obviously, it's coincided with at least a few sectors and few companies having headwinds in terms of their profit numbers, largely because of tariffs, some because of other reason. And I think, therefore, the pain looks pretty high. Yes, you know, there have been winners, but there have been losers also. So you're very kind in just pointing at winners. We have also had a share of losers. But one thing which we are very clear is that we cannot afford to make mistakes at this point of time. Yeah. And mistakes can be of multiple, for multiple reasons. One is, obviously you buy something where fundamentals are not that great. So that we are very, very clear. And secondly, if you buy something priced to perfection, then even a small disappointment leads to a big drawdown. And I think that is what we have seen, that if you are priced to perfection, then the small drawdown leads to a big correction. And I think there is what one has to be careful. Coming to your question, yes, there are opportunities, and I think it's a good time to start looking at companies, start accumulating, because you are now able to buy without impact cost.
Right.
You're able to buy at a price you basically would have loved to 6 months back. But it is going to be a waiting game.
So what themes are looking attractive right now?
So I think among the fallen angels, I would say that engineering companies, a lot of them have fallen quite significantly. Outlook is pretty good. Some of the pharma names, they have not done anything. I would not say they have fallen, but they have not done anything because of tariff issues, so on and so forth. So there you have opportunity. We are also getting constructive on some select renewable plays. It was like the darling, and suddenly in 15-20 days, it's been the reverse. But I think that segment has a lot to offer, particularly in an energy deficient country like India. So that is also where we are quite positive, and we continue to be positive on all facets of financials. I think that is a great play to be in.
Speaking of financialization and financials, you can see the flashes on your screen of the SEBI chairperson speaking about bringing a consultation paper with regards to the F&O market at an appropriate time. And he's mentioned about bringing a consultation paper pretty soon. And you can see the reaction within stocks like BSE and Angel One and so on. But that's what the SEBI chairman has had to say. But is capital markets a theme, considering the fact that we are growing the way we are, the rise in the number of demat accounts? How do you play this capital markets theme?
See, it has to be. We are a large country and we are growing in terms of per capita income and also savings. And the most important thing is financialization of savings. You don't have to now teach. Everyone knows. The best way to play it is through our business, frankly, asset and wealth management companies, because 6 crore unique investors are going to be 15-20 crores for sure. I think we are less than $1 trillion in mutual fund assets. I think we have a long way to go. One single asset management company in US is $13 trillion. So I think that is a good way. But I think all parts of, I would say, financialization of savings will benefit out of it, whether it's insurance companies, custodians, exchanges, and so on and so forth. Obviously, valuation are something which investors will, I always keep on saying this, because the best company and the best theme might not be a good stock if it is priced beyond perfection.
Just a final question before we let you go. Everyone has been talking not only about the financialization theme, also the discretionary experiential, theme where hotels, hospitality, travel, all of that would do well. And you won't speak about specific stocks, but I know Interglobe Aviation, you have to ask, one has to ask you this question, because the stock industry leader, everything is doing well, 65% market share, and suddenly something comes by, and as a result of it, stock's down 20% from its highs, with no real immediate solution in sight from an investor standpoint. Because what we know right now is the disruption which is taking place in their operations, the financial disruption because of this. It's a wafer thin margin business. How do you...
I won't talk about stocks, but see, generally, Mangalam, if this is a very critical industry.
Yeah.
And you can't have a monopolistic kind of a situation in any critical industry. And I think this is a lesson to us, to everyone, including the regulators, that you have to encourage more players, at least in very, very critical industries. You can't have one company or two companies. Like in India, two airlines are like more than 90% market share. One is more than 65% market share. And a little bit of issue can happen to anyone. Some may be internal, some may be because of external factors, but it can happen. And you see how the whole country has been held to ransom. I was also traveling last week. Luckily, I did not have that much of an issue. But, you could see the airports, you could see the anguish, you could see the tears and so on and so things. I think across critical industries, we have to encourage more and more players so that there is no monopoly.
All right, the only outlier to that, I would say, is CNBC TV18. We celebrate our 26th birthday for the last 20 years plus. We have had over 90% share, and we are extremely humble about our leadership because viewers come first always.
Humbleness will take you far.
Thank you so much, sir. With
Best
that,
wishes again.
Thank you. We take a short break, come back on the other side. We have another Sunil waiting by to discuss business, and this is Sunil D'Souza. From Sunil Singhania, we go to Sunil D'Souza, the MD and CEO of Tata Consumer Products, joins us in our studio.
26 years of CNBC TV18. Net. 26 years of CNBC TV18.
Well, on our 26th birthday, to get a state on the pulse of consumption, or to get a pulse check on the state of consumption in our nation, we do have a Nifty company joining us from the consumer space. Sunil D'Souza, the MD and CEO of Tata Consumer Products, joins us here in our studio. Thank you so much, Sunil, for joining in, being with us through the last 26 years, but at the same time, giving us a status check on how consumption is. The Tata Group, obviously a hallmark of all things leadership and longevity. We can, take a leaf or two out of their book as well. But just from a consumer business standpoint, sentiment standpoint, how has it been post-festive season? Has it stayed the course, or has it seen a tapering post the festive season?
So Mangalam, first of all, my congratulations to CNBC on your 26th anniversary. I would take a slightly longer term view. I think post last October, November onwards, things have started to get better. I think the GST cuts, especially on a lot of food items which are 12 and 18 going down to 5, that definitely the hypothesis was it will give a spur. We are in the food and beverage business. There's a little bit of seasonality around festivals, but broadly, I mean, tea, salt, people have it on a daily basis, right? So we did see a bit of, I would say, channel-related disruptions last probably third week of September, just before GST kicked in. But after that, we're seeing decent amount of volume growth. So, but I would say the best is yet to come, because normally what happens with all the, I would say, stimulus which has happened in the economy, whether it is capex going in, whether it is income tax slabs getting reset, GST now coming down, or interest rates dropping, normally the first impact is on discretionary stuff, right? Yeah. I would go and buy my scooter, my television, this thing, before I start to upgrade my food and beverage preferences. So I would say probably Q4, end of Q4 is when you should start seeing the real uptick starting to come in.
All right. We have Ritu asking a question as well.
Well, Mr. D'Souza, I quickly wanted to come in on, when you talk about this kind of growth, the best part is yet to come. How big a role will inorganic play? We've been seeing reports that you are in talks with Danone to acquire their India nutraceuticals and specialized nutrition portfolio. If you could come in on that, if, that is the kind of space you're looking at inorganic opportunities in, and at what stage, if at all, where these talks are.
So Ritu, if I got the question right, you're asking me about Danone and what was there on the front pages for newspapers, right? I wouldn't comment specifically on media speculation per se, but we're always talking to multiple entities at the same time, because we've got a clear view of how to shape our portfolio. We were a tea and salt commodity-based company. We've slowly moved up the value chain, if I may. We acquired Soulful. We've built Sampann from scratch. We're now building Tata Simply Better. We acquired Capital Foods, Organic India. Health and wellness, that space is always of interest. Organic India, supplements, green tea, etc. That was very much part of the play. Yeah, but as and when something happens, I'm sure I'll let you know first.
You left us at a cliffhanger when it was the Bisleri deal as well. Thereafter, there was the Organic India deal and the Capital Foods. Two of them happened. One did not happen. Like you said, a lot of things happen. At the same time, you had said that dairy by itself may not be an industry of interest to you. But we'll discuss all of that. We're leaving our viewers at a cliffhanger too. We'll take a short break, come back, discuss whether Tata Consumer buys Danone or not, and more on the business after this short break. Stay with us.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Left you at a cliffhanger. Now we are continuing our conversation with our consumer. Sunil, Ritu asked you about the Danone deal. You said that you will not comment on speculation. But just as a category, dairy, how would you look at Danone versus all the others? And what would your thoughts on the category be?
I wouldn't comment on Danone because I don't know the details of their dairy pieces. But conceptually, we have said we will not get into dairy, right? We made a public statement.
Yes, exactly.
Because if you need to get into dairy, you have to be full-fledged into dairy. Now, the whole hypothesis of having synergies, bringing in cost to bear, distribution systems, logistics, dairy is a different animal. Most dairy companies are dedicated dairy because you got to play the whole portfolio then. You got to play milk, butter, cheese, paneer, whatever, the whole range, right? You can't say, I will only play in this part of dairy and not the others. Then you're not a milk player. And then you got to set up your procurement systems. Then you get into this whole thing of cooperatives, governments, local governments, etc. So we've decided that that's not this thing. And especially if you're getting into high-end dairy, then you've got to set up chilled distribution systems, right? Which is a completely different kettle of fish. My whole hypothesis has been putting up a truck in which there is tea, coffee, pulses, spices, everything going onto the same truck, right?
So you take that as a no?
Again, I'd say I would not comment on media speculation.
So there are specialized nutritional products in Danone and not just dairy. So probably maybe some part of that business. He'll pick and choose on his plate. Anyway, Parsi, you want to go on the dairy?
but you know, Sunil, you mentioned they've seen decent volume growth after the GST rationalization and you're expecting the full effects to come in from Q4. But do you believe that the market share is coming back as well along with the volume growth? We're seeing some bit of decline in the market share in this quarter.
So on the market share, I've got a specific point of view, right? If I give you my numbers, last quarter, 14% was quick commerce, 7% was e-commerce, that's 21, 16 modern trade, 37, and I've got about 5 to 7% institutions and other business, right? So just about 55, 57% is general trade, and that's what is measured in a sampling manner by Nielsen. Nielsen, while they do give us online shares, I believe they're not confident enough of their entire panel, and that's why they don't make it public, right? But even if I ignore that for a minute, you're only sampling half the market. That's number one. Number two is I would lay more emphasis on reading competitive commentary and comparing like-for-like growth rates. And I do think if you look at it, at least for the last probably 3 or 4 quarters, we've been outpacing the rest of the players in the market.
All right, first half, just under 10,000 crores. You end this year with over 20,000 crores in top line and 15% margins before we let you go?
The full year might not land up at 15, but the exit should be comfortably 15 plus because in the initial part of the year, we did have the pressures of tea and we had US tariffs. Now, US tariffs on tea, for example, have gone to 0, right? So I've got good business out there. And yeah, top line, we are gunning for the 20 range.
All right, we take that point. Thank you so much, Sunil, for joining in and hope to get you more often in our studio as well. With that, we'll take a short break, come back, get you more of the markets and a lot of stock-specific action on the other side. Stay with us.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. Markets still under pressure. The Nifty now below that 26,100 mark, down about 125 points as we speak. And the Sensex below the 85,500 mark, down about 320 points as we speak. Plenty of stock-specific activity. But for now, we're going to take a goodbye from all of us. It's a wrap on this trading hour edition. Stay tuned. Halftime report will take all the market action forward.
"26 years of CNBC TV18. "26 years of CNBC TV18.
Markets under pressure with the Nifty once again flirting with the crucial 20-day moving average technical level.
Mid-caps and small caps face severe selling pressure with the small cap index down 1.5%. Overall market breadth is deeply in the negative with nearly 4 stocks in the red for every one which is higher.
Interglobe Aviation is the top Nifty loser, down almost 8% as operational disruption continues over the weekend and today. The company also has a deadline to reply to the DGCA show cause notice by 6 p.m. today.
As CNBC TV18 celebrates its 26th birthday, industry stalwarts and market veterans ring in the opening bell from our studios. Veteran investor Ramesh Damani says we should get ready for the index in the 7 figures by 2047, compounding at 12%. Hello and welcome to Halftime Report live from the CNBC TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Sonal Putra. Well, it's turning out to be a session which is definitely weak. We've started the week on a pressured note, you'd have to say. So we have the Nifty as well as the Sensex, which is just about lower. We have the Nifty, in fact, just about holding at around 26,000. And we have the mid-cap index, which underperformed last week. So there is follow-on underperformance this week as well, or at least we started on that note. The mid-cap index currently down around 1%. We have the small-cap index, which is under pressure as well. What stands out is a lot of the stocks which are in focus on account of news. So case in point would be Keynes, which is down around 5%. There was an analyst call at 8:30 this morning. We have Indigo, which has lost 16% this month, and even Biocon, which was in focus post the board meet on Saturday. That stock down around 1% post all of that news.
Okay, yes, so those are the market cues, but the other cue that we are tracking is, of course, 26th birthday that CNBC TV18 is celebrating, and we've had market stalwarts, we've got corporate conversations, CEOs joining us today, and we have a very special guest who's joining us in the studio today, the leadership of CEAT. We are now joined by Mr. Arnab Banerjee, who's the MD and CEO at CEAT. Thank you so much, Mr. Banerjee, for joining us in the studio today. We'll be discussing, of course, the industry outlook, auto sales. We are seeing raw material prices, the acquisition that just got completed, Camso acquisition. But first up, thank you so much for joining us on your birthday. It's always a pleasure speaking with you. And since the last time we spoke to you, there's so much that has happened. The GST cuts, that industry turnaround in terms of rate cuts and demand boost. How have you seen things changing as far as demand is concerned? 11% volume growth in Q2. What kind of outlook do you have for the rest of the fiscal and the next year as well?
Well, congratulations on your 26th, first of all, and it's a pleasure to be in the studio after a long time. We always speak virtually, so it's a change for me as well. Coming to your questions, I think, first half has been good. Q2 had 5% quarter-on-quarter growth. Q2 usually is a down quarter. And September was a degrowth month in replacement because of the GST announcement. So the trade kind of reduced their stock levels. I had mentioned at that point of time that the impact of GST will come slowly in this industry because it's not an item which is bought every day. And we are seeing some early traction, I must say, especially in farm tires and two-wheeler tires, because these are spread over a large class of towns, etc. So we are seeing positive traction in demand, particularly in these two categories, also a little bit in passenger and truck tires. So I think it will be a good impact going forward.
Okay. Mr. Banerjee, thank you very much for joining in and celebrating our 26th milestone birthday. Just wanted to get a sense in terms of where the raw material prices are, because we do understand that they were largely benign last quarter. How exactly are they trending this quarter, and what does that mean in terms of margins for you?
Well, last quarter we had a 5% decline from Q1. So it was a big decline for us. But overall also, if you see the industry, there has been a decline. We think it will kind of moderate to a stable kind of situation in Q3 and Q4, maybe with slight decrease vis-a-vis Q2. But we won't have that kind of a delta again quarter-on-quarter is what we think. So therefore, it's generally positive as far as margin is concerned. Our margins have been 41% in Q2. I'd been mentioning that whenever we operate at about 40 to 42% margin, we are comfortable in terms of the whole operating margin as well. So that's come in the good zone. And sales realization is also stable. It's not that the margins, the raw material prices completely going through to the market. So I think 42% margin is expected going forward.
Okay, so that's about the margin aspect. When you said things are looking good, the replacement part saw some decline in September because of GST impact, but you still saw 11% overall volume growth that came by. What are your targets in FY26, FY27 once the acquisition also is completely coming into your books? You have international markets as well, which contribute to your P&L, and that is not impacted by GST cuts, but other macroeconomic headwinds that we've been seeing. Considering that, do you think you'll continue the growth rate that you have seen, or you will do better than that?
Well, our objective is to consistently grow in double digits, and we have been 11-12%. We would like to grow a little bit faster. If you see our value CAGR of the past, it's around 15%. So we would endeavor to beat that kind of a benchmark in the medium to long term, including next year. You are right, international business is a bright spot for us, and before the Camso acquisition, and about 19-20% had been coming from international business. Post the Camso acquisition, I believe it will jump straight away to 24-25%, and will continue to push this further up because it is value accretive, profit accretive.
And high margin as well?
Yes, absolutely.
Okay. Well, Mr. Banerjee, I just wanted to narrow down a little bit because the MHCV outlook actually, which you've given, is quite interesting. In the replacement demand, you're just about expecting, I think, mid-single digit growth in the MHCV. And in terms of the OEM demand, you're expecting it to be absolutely flat to maybe 0 to low single digit. So what's taking place when you talk about demand in the MHCV space?
Well, if you see the long-term demand outlook in MHCV, it generally mirrors the GDP growth, generally, right? And if you see sub-segments, construction is doing well, mining is doing well. And if the GDP growth has been 8% in Q2, and if that kind of trend continues, then mid-single digit is very much possible in replacement market. The OEM demand is cyclical, so it doesn't follow a flattish kind of pattern. So we have seen a down cycle with the GST thing coming up, so on and so forth. Maybe we are a little bit more positive now on the OEM demand on MHCV as well.
But you're concerned about passenger vehicles as a whole, or maybe just in the replacement space?
Replacement market has not expanded adequately in the first half of this year. Okay. And with this GST impetus, we expect at least for the smaller tire segments, there will be a positive outlook in the Tier 2, Tier 3 towns, like we have already witnessed for two-wheeler. That kind of trend could come in for passenger as well.
So net, what are you expecting as a whole in terms of replacement demand growth as well as in terms of, say, OEM growth for the second half of the fiscal?
Second half, Jan and February are again low demand months because of onset of winter in north and east. So taking into account the seasonality factor, I would say the outlook is positive from whatever we have mentioned in the past. It could give about 2 to 3% higher growth in second half vis-a-vis first half.
Okay. The other part of the business is balance sheet. You made this acquisition recently. How much would it add to the debt overall? And do you think there are more inorganic growth plans that you have? Maybe in any other space, EV tires, tires for EV segment, is that something that you're looking at and expanding into as well?
First, the balance sheet question. I think we are fairly comfortable in terms of debt equity ratio, which is about 0.6. Debt EBITDA is also 1.5-ish, so very much under control. Debt has gone up by 1,000 crores, Q2 on Q1 if you see. Our capex guidance is around 1,000 crores for the year. We at this moment stay with that guidance. So everything, even after Camso acquisition, is very much within our operating limits. So that's not an issue at all. Coming to the question of future acquisition possibilities, yes, we will be active in the market, but it's a matter of what is available and what we are interested in and what is our financial muscle at this point of time. But a short answer is yes, we'll be on the lookout of opportunities.
So is there any, you said interesting opportunities, anything specific that you're looking out for? And what's the kitty? With this, how much has gross debt come to, that 1,000 crore addition?
The kitty has to be balanced with our internal growth imperative. With this kind of a growth, double digit, we have to invest in brownfield and later on in greenfield expansion also. So the kitty is not a fixed kitty, it's a dynamic thing. And as we grow, the kitty will swell. So the money will be available. Ratios will be benign, and we will be aggressive for both organic and if the opportunity permits for inorganic.
Okay, just quickly before we let you go, what exactly are the inventory levels like as of now, and what are you anticipating in terms of festive demand, if you have to compare it year on year?
Festive demand has just gone by, so the inventories are a little lower than normal. We maintain 26, 27 days of inventory. It's a little lower, but not too much lower. We are operating at about 80% plus capacity utilization in most categories. So you will see a lot of brownfield investments accelerating going forward. And that there will be a regular capex guidance over the next few years for organic growth as well.
Okay, all right. Mr. Banerjee, always a pleasure speaking with you. Thank you so much for joining in today with your thoughts and the outlook going forward. A special day, so good to have special guests in the studio as well.
Thank you very much. 26 years is a great deal of time.
Yes, thank you very much, Mr. Banerjee, for taking the time out and gracing us with your presence. Thanks very much. Well, that is the management of SIA talking to us. On that note, we need to take a short break. But on the other side, Manisha Gupta is going to be talking commodities. She has with her Sachin Jain, the MD at World Gold Council. Stay tuned.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. Well, under pressure for the markets, so we have the Nifty, which is just about holding at around 26,050 as we speak, down around 140 odd points. We have the Sensex, which is split around 361 odd points as well. The midcap index has accelerated in terms of losses. So we have the midcap index, which should come up for you. It's at the low point of the day, down around 1.34%. And maybe the BSE small cap index should come up for you to give you a sense in terms of how exactly that particular index is performing as well. So down almost 2 odd percent currently for the small caps. In terms of specific stocks, if you have to talk about a couple of these Nifty stocks, what seems to be holding its head above the water is a lot of the IT stocks. You've seen that outperformance come through, especially with the rupee depreciation and the hope that the AI trade is possibly not as aggressive. So we have stocks such as Wipro, which is up around 0.5%, HCLTech, which is up around 0.4%, and Infosys, Tech, all of these stocks which are managing to hold up quite well. On the downside, Indigo Bank and a couple of others such as Geo Financial, Eternal, JSW Steel, all of these stocks from varied sectors are showing pressure at this point. We need to take a short break on that note with the news that the Nifty is just about holding at around 26,000. We'll be back with more. We'll get you that promised commodity stock as well. Stay tuned.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back, and joining us on the show now is Sachin Jain. He's MD at World Gold Council. Sachin, hi, thank you so much for joining us on a very special day for us. And what an year this has been as well. We're looking at all-time highs in case of gold and perhaps the best yearly performance since 1979 with 60% of gains that we've seen in gold. How would you look back at 2025 and analyze on how have Indians bought gold this year?
Manisha, first and foremost, my heartiest congratulations. And I think you guys do a phenomenal job in bringing not just transparency, but information and legible and confident information that we can bank on. So congratulations to you for the great work that you guys do. With that, as you rightly said, 2025 has been phenomenal. We've seen, I don't have to repeat, an all-time high, over 45 all-time peaks this year. The returns have been phenomenal. And we believe that as you get into 2026, the fundamentals on which gold price has been based on are still going strong, are going to be in favor of gold, and that's how we see. And the changes that we witnessed is that financial consumer in general, particularly when I look at India, is getting more sophisticated. There's more conversation, and not just conversation, but activity around diversification of portfolios, more transparency. If you look at the jewelry side, where of course we witnessed some drop in volume, but of course unprecedented up in the value that jewelers are dealing with. I think they're getting ready for the next phase of gold, which is going to be 26 to 27.
Sachin, would you also say that the financialization of gold that we have been talking about all these years has started to make very, very strong inroads in mainstream investment when it comes to this year?
Absolutely. Just if you look at this year, Manisha, the investment demand is going to cross $6 trillion. $6 trillion in INR terms means 18,70,000 crore worth of gold that got traded on a daily basis. Now, if you look at it, this makes gold as the most liquid asset on planet Earth. And it is, as you rightly said, the impetus on gold is an important asset class with every financial asset class investor is more and at the highest ever.
The other thing I want to talk to you about is jewelry numbers, really, Sachin, because $90 billion worth of a jewelry market is what we are looking at in India in 2025, with various reports suggesting that it could head to $150 billion by the time we are in 2033. Would you say it is about corporatization of jewelry, organization as well, with various companies now looking at this with a different view, really, and the kind of buying that we've seen within India, whether it has been about with the way of wealth creation or millennials as well buying it?
I think, Manisha, a few things are happening in the jewelry space. First and foremost, we are getting more transparent. With the event of BIS and their activation around a unique HUID on every jewelry piece, takes up the confidence on the jewelry at a different level. That's number one. Number two is the interest in gold and the ownership of gold is high. Number three is, the way the brass tacks of India, the sheer disposable wealth in the hands of Indians is going year by year. And if you look at a 5 to 10 year perspective, we believe it's going to double. Now, with all of those elements, historically, we've seen every time an Indian consumer's wealth goes up by 1%, the interest to consume gold or consumption of gold goes up by 1%. And I think with those perspectives in mind, with one, what's happening at gold as an asset class, and secondly, with increased wealth creation and increased wealth in the hands of consumers, I think the next few years on gold will be very strong. I think as an industry, we need to do a much better job to relate better to younger consumers and millennials. And work is happening, but I think it's an ongoing pursuit of being the most aspirational sort of aspirational asset class for the younger millennial who wants to dress up.
Sachin, there has been said, and yes, with the kind of returns gold has given, it has clearly been mainstream. Almost everybody that we've had on the channel has spoken about gold in some sense or the other, and obviously giving higher highs expectations for the next year as well. But talk to us about the various age groups that are buying gold. One, we do understand the ETF buying is picked up, fund on funds as well. Via mutual funds, we've seen gold buying happen. And it was said at some point in time that it is only the older generation invests in gold and not the younger one. Have you seen that change as well?
Actually, Manisha, we've seen the folios in which consumers are buying gold ETFs and others. That's getting younger, and that's getting very interesting because I think it'll reflect on how we'll market our products and bring them to our mainstream. ETF, if you look at it, the starting of the year, our AUM was about 56, 57 tons. We've crossed 86 tons last month. on the gold ETF bit. And I really believe that it's still at the cusp of a phenomenal growth, because ETF as a product is still not completely, has a popularity or the awareness on a mainstream India. And I think that will happen. That is what we'll witness in 26 and 27. What will work with the millennials is ease. What will work with the millennials is their ease to buy, hold assets. And I think that change of mentality in terms of holding assets digitally is going to be the driver. We've had over 9 million additional folios that have got added up on gold ETFs this year, which is phenomenal in terms of number of consumers who've come across. And as you said, historically, we were consumed by large or sort of generally by old age consumers, or perhaps a certain above a certain age. But I think in the current perspective, the young consumers are driving the growth.
Okay, all right. Sachin and Manisha, thank you so much for joining us today with that discussion and the outlook on what's happening with the gold market and prices as well. With that, we'll slip into another break. Rajiv Bajaj, the MD at Bajaj Auto, will join in on the other side of the short break.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. Well, a further fall. We are off 50 points from when we started the show, very close to that 26,000 mark. Remains to be seen whether we break that level or continue to consolidate above 26,000 or not. IT name. So Nifty IT was the only gainer in trade today. That too has moved into the red. So we have the likes of Infosys, TCS, all these stocks which are lower in trade right now. So watch out for that one. The other stock which is lower is Tata Steel. So a lot of pressure coming in on the metal side as well. So let's talk about which are the big movers in the broader markets. Vivek is here to take us through the stocks that are moving around in trade. Vivek.
Well, thank you so much for that. To put it mildly, it's a bit of a meltdown that we're seeing, especially as far as the broader end of the markets are concerned. Advanced decline ratio is extremely weak, especially has deteriorated in the last half an hour or so. In terms of individual stocks, very few stocks doing quite well. Canfin Homes, select NBFC stocks after the rate cut, they continue to move higher. Canfin being one amongst them. Policy Bazaar, continues to be an outlier, especially in the last week or so, has managed to move higher, cooled off a little bit from the day's high, but still in green territory. And Sulzlon, over the weekend, the company did hold a manufacturing day, some positive commentary coming in on back of that stock too, after cooling off from the day's high, trading higher by around 1%. But on the other hand, quite a few stocks are, trading with significant cuts. The entire realty pack today, another day we are seeing very sharp cuts. Have a look at name like Prestige, Godrej Properties, almost 5% lower for both of these names. Eternal, we spoke about the block deal, but that stock too has cooled off significantly from the recent peak, down another over 2% today. Keynes Technology, multiple clarifications coming from the management. They also held an investor call today at 8 a.m. But despite all of those clarifications, that stock lower by over 7%. Have a look at Indigo as well. Flight cancellations is something that all of us are grappling with. But a lot of analysts on the street have highlighted the fact that they're going forward, cost structure will be elevated, and the back of that lower by over 7%. And lastly, if you look at BSE as well as Angel One, once again, commentary coming in from the SEBI chairperson in terms of a consultation paper, both of these stocks cooling off significantly from the day's highest point.
Okay, all right. Thanks very much for that, Vivek. So those are a lot of the buzzing stocks at this point. We'll take a short break, but up next, Rajiv Bajaj, the MD at Bajaj Auto, will join in. Stay tuned.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. Well, as CNBC TV18 celebrates 26 years of leadership, Parikshit is in conversation with Rajiv Bajaj, the MD of Bajaj Auto. Parikshit, over to you.
So what's going to be Bajaj Auto's game plan for 2026 in terms of EV launches, pushing exports and the overall growth of the company? Rajiv Bajaj is in conversation with us. Rajiv Bajaj, always a pleasure to have you here on CNBC TV18. We complete 26 years today. Give us a sense of your association with CNBC TV18 and the role that the channel has played in reporting on the automobile industry and the milestones of the automobile industry in the country.
Well, Parikshit, first and foremost, congratulations to all of you. And thank you so much for having me here on your special day. I must tell you that my first most significant business interview was on CNBC almost 24 years ago. So it was 2001. Govind did it. It was on the occasion of the launch of the Pulsar. So whether it's India, whether it's Bajaj or whether it's me, the association goes back almost to the beginning of CNBC. And I can tell you from my experience, I like to call it the ABCD of CNBC. A for authentic, B for balanced, C for compelling, and D for delightful. You know, authentic because you're probably the only channel that doesn't this nonsense about source-based information. You know, everything is so credible. Balanced because there's always both points of view put before your viewers. Compelling because, you know, it is said discipline is repeating the boring brilliantly. So sometimes it may appear to you internally that what you do is getting boring, but to us on the outside, you know, it seems brilliant because it is so finely honed. And finally delightful because there is always an X factor in what you do, you know, from Young Turks to Future Female Forward and everything in between. It's a delight to watch CNBC. So, you know, I've had a great 24 years with you.
All right. Thank you so much for your compliments and support, Rajiv Bajaj. Now, let me come back to the two-wheeler business. Now, with the acquisition of KTM complete and approved, how do you now plan to scale up in India and global markets?
Yeah. So first, let's take India. So in India, Parikshit, as you may be aware, for the last couple of months with KTM, we have pretty strong tailwinds, primarily due to the launch of new products. You know, from the new Adventure to the Supermoto, most recently the Duke 160, etc. As a result of which, we have been now experiencing our highest ever retails in India. Also from India, in terms of exports, the new products are helping us to, move to the next level in terms of KTM volumes. And in fact, in that context, I must share with you that even in terms of exports to the US, which are not insignificant, we export about 10,000 KTM motorcycles every year to the US. Let me share with you something very interesting, that when confronted with the 50% tariff, Bajaj reduced the FOB price out of India to absorb most of this 50% impact. And yet we are able to export at a EBITDA that is greater than our 20% corporate EBITDA. So this is not about the power of KTM or the power of Bajaj. This is about the power of India. It is so cost competitive to manufacture out of here that really more of us should be taking this strength out, to other markets. So that's about KTM in India. As far as KTM globally is concerned, I said to you when we spoke the last time that at the heart of the turnaround globally is going to be, the concept of less being more, less in operational terms, in the sense that KTM was brought down by this 12-month plus inventory that had piled up in its network.
Right.
So I'm happy to say that, retails are on course. that inventory is more or less depleted now, will be at the end of the year. And even strategically, it is about resetting the brand. Less is more. Get rid of the bicycle business, the car business, the smaller brands like MV Agusta, etc., and just focus on KTM Husqvarna going forward. So with this less is more approach, I feel quite confident that we are on the right path for the medium term.
How do you plan to increase your market share in ICE two-wheeler segment in India? What's going to be the game plan for 2026?
Well, when it comes to ICE two-wheelers in India, Parikshit, basically it's about motorcycles for us because we don't make ICE scooters. Within that, our focus has always been on the 125cc plus space. And as Rakesh shared with your colleagues just ago, whatever we are doing now in product and marketing terms is already yielding results. Between August and November, our share, as we calculated in the 125cc plus segment, has grown by 2% already. And I think, I just told you that 2001 was the launch year of the Pulsar. So next year is the 25th year of the Pulsar. And you will see that it will be the year of the Pulsar. Already as we speak, we are rolling out the first wave of new products, which will be reaching dealerships very soon. And you will see wave after wave of new stuff coming out of the Pulsar platforms all through 2026. And since in the domestic market, Pulsar is like 2/3 of our volume, I think if the new Pulsars do well, then this is going to be the primary basis for share gain in the domestic market.
Any investments in bikes over 350cc, considering that the government has hiked the GST there?
Well, I'd like to start by saying that I certainly hope the government will reconsider what it's done. And without dwelling on it too much, clearly this action is going to marginalize motorcycles above 350cc in this market. And if that happens, then it greatly handicaps the manufacturers from developing such motorcycles and taking them out to the world. So I sincerely hope this will be reviewed. Meanwhile, our plans continue unchanged for now, Parikshit, because I don't know how many people are aware that when it comes to, and we measure it as 250cc plus, not just 350cc plus. So in the 250cc plus segment, between our like Pulsar, Dominar, KTM and Triumph, we are neck to neck with Royal Enfield in terms of export leadership. With 4 brands across 108 countries, there is no reason for us to kind of put our plans on the back burner because of a domestic adversity. But as I said, I hope that will be relooked at. So for now, in terms of both development and investment, our plans remain unchanged.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. Well, Keynes Technology, the stock which has lost around 25% of its market cap this month itself, is down another 8% today. And this is despite the clarifications which came in from the company in an analyst call this morning. We do have Upasna joining in with more details on what they exactly detailed to investors and what the key questions might have been. Upasna.
Well, the stock continues to see a sharp decline today as well. Mind you, last week Kotak had raised some serious concerns in terms of company's balance sheet and cash flow concerns, questioning the company's overall revenue growth, excluding its smart meter business. Now, company today had held an investor call in which it clarified on the various questions that were raised by the Kotak, in which the company said that the presented financial statement is relevant and reliable, has been presented in a reliable manner. There are no inconsistencies and most of the implications are not valid. It says that the Kotak's entire report is based on one small omission that was mainly a typo error in one of the submissions, in which the company had omitted some subsidiary related disclosures in which the company was face the heat in the Kotak's report. It has also said that there was just one mistake of not mentioning in the notes to accounts of a related party disclosure, which was duly corrected now. Now, company has also mentioned that the working capital intensity, which was one of the main points highlighted by the Kotak, it says that it is a very typical for every EMS player to face such a high working capital. Taking various measures to improve it is what the company is indicated. The smart meter business also contribution to the total sales is trending down, and the other businesses are also showing strong growth rates is what they've indicated. The growth of other verticals such as industrials, automotives, railway, they are seeing a fairly strong growth now onwards, and it believes that going forward the company's reliance on its smart meter business will come down substantially is what they have highlighted. And lastly, they've also said that the no promoter stake sale is on the cards as of now. So these were mainly the key highlights highlighted by the management in response to the Kotak reports.
Okay, all right. Thanks very much for that, Upasna. But now let's go across to Manglam. He joins in with the F&O setup on what is a weekday. Manglam, over to you.
Well, the indices are lower, no two ways about that. The Nifty Bank, the midcap index as well. And with the indices being lower, what's also higher is the volatility. So the India VIX comes up for you. That's up around 3.5% as well. Bears will take heart from that, not so much the bulls. And bears will also take heart from the advanced decline ratio, which is firmly in favor of decliners right now. Over 2,000 stocks in the red for just about 700-800, which are in the green. The Nifty 20-day moving average at 26,000 is holding out, and that is something that the bulls will monitor very, very closely. The other thing that bulls will monitor is the range that the option writers are playing for as well. We've seen writing at the 26,100 call, the 26,200 call, telling you upwards of 26,150 to around 26,200. There would be some sort of supply coming in, but they still have heart of the 26,000 put, which is seeing a fair amount of writing. At some point, this call writing and put unwinding will go into the favor of bulls, because the put call ratio has now moved to 0.75 versus 1.18. Typically around 0.65 to 0.7 is where it bottoms out. So we'll monitor that. And alongside that, a couple of stocks, a lot of short positions added on Interglobe Aviation. The stock nearly 20% away from its 52-week high, continues to see some selling. And Hitachi Energy too has seen some selling, so short positions added out there.
Okay, all right, Manglam, thanks very much for that. Well, on that note, we need to wrap up on Halftime Report. Business Lunch will take all the action forward.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Markets are under pressure with the Nifty once again flirting with the crucial 20 DEMA, and it is a very important technical level.
Mid-caps and small caps face severe selling pressure with the small cap index down 1.5%. Overall market breadth deeply in the negative with nearly 4 stocks in the red for every one which is higher.
Interglobe Aviation is the top Nifty loser, down almost 8% as operational disruptions continue over the weekend. And today, the company has also a deadline to reply to the DGCA show cause notice by 6 p.m. this evening.
As CNBC TV18 celebrates its 26th birthday, industry stalwarts and market veterans ring in the opening bell from our studios. Veteran investor Ramesh Damani says we should get ready for the index in the 7 figures by 2047, compounding at 12%.
Good afternoon. You're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios on this very momentous occasion of the 26th birthday of your favorite business news channel, CNBC TV18. I am Hormaz Fatakia. With me, as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormaz. Great day, 26 years for CNBC TV18, and it's all thanks to our viewers, right?
We owe it all to them, and that's what has been the driving force behind this 26-year journey. But the markets today have not begun this week on a very optimistic note, though. The Nifty continuing to flirt with its 20 DEMA at the moment of around 26,000, still managing to hold on to those levels. But as of now, not good going for the index, not good going for the broader markets either. And the Nifty for now at 26,012. So it's around about what, a 200-point cut on the index. It's the broader markets that are facing the bigger pressure, though. The mid-cap index is now down 1,000 points, and it's almost across the board selling that you're seeing. At the lowest point of the day is the mid-cap index, no different on the small caps as well. So as the index continues to defend some key technical levels, can't say the same for the broader markets.
Absolutely. The broader market's taking a beating, both the mid-cap index, the small-cap index, all of them down over 1.5%, right? And in some stock-specific action, Indigo is the top Nifty loser, down for the 7th day in a row, and its market cap, as you can see, is now below 2 lakh crore rupees. Tech is another one of those. It's down 6%. In fact, that stock had seen its worst week last week, and it was one of the worst since its listing, right? Now take a look at the realty sector. That sector also taking a beating, down about 1%, but also the PSU Bank stocks. Those are also in the red. If we can bring up those stocks for you, and if you see Bank of India, all of them in the red, over 1% lower.
And that's not good reading for the markets. The PSU Bank Index is now at the lowest point of the day, is down almost 6.5% from the peak that it had hit on the 26th of November. And since then, it's been a downward spiral for them since the clarifications came in on the FDI norms. And of course, leading the losses has been Indian Bank, SBI too, among the top contributors to the Nifty downside today. And it's only IT and only very little is what is holding out in the green in today's session. But the other talking point in today's session before going into the weekend was Biocon, and it was supposed to have a board meeting over the weekend where it announced that it is now going to make Biocon Biologics a 100% subsidiary. The board has also approved the swap ratios for the transaction and cleared a proposal to raise up to 4,500 crore rupees through a QIP as well. Ekta is here with the key details of this deal and also the key takeaways from the conversation that she had with Kiran Mazumdar-Shaw. Ekta.
Well, yes, Biocon is going to make Biocon Biologics a 100% subsidiary. They will be shelling around 6,951 crores in terms of a share swap, or the share swap is worth that much. And separately, they will be paying an additional $400 million to Mylan to buy out their stake. Now, a couple of key important points that the management did mention and did speak to us about as well in the call as well as in the interview, where one of the key reasons for doing this is that Kiran Mazumdar-Shaw mentioned that the Biocon stock, in fact, was undervalued post Viatris biosimilar buyout, which took place a couple of years ago. And with this, they will also be getting rid getting rid of the holding company discount that Biocon had. Now, they will have to assess Shriram Mylan's timeline in terms of shareholding. But if it comes to, say, a succession plan, the board has been very well managed. And so hence, in terms of putting to rest any kind of speculation in terms of the longer term plans that Shriram as well as Mylan could have in Biocon going forward. Now, about the promoter holding, which has now fallen below 50%, Kiran Mazumdar-Shaw said that she is comfortable with a 44% promoter holding in Biocon and that it is large enough. They will be raising additional funds for the Mylan stake via QIP, and this is something that they'll have to complete by the end of March. And before that, there will be an 1,800 crore bridge financing, which they will have to undertake. $1 billion is a comfortable level of debt, which they will look to manage going forward. The EBITDA and the EBITDA growth should be sufficient enough for the company as a whole to manage the debt levels. And when it comes to Syngene, remember that they have been reducing stake in Syngene since a couple of years, but they are looking to retain their current shareholding in Syngene, which is at over 50%.
All right, Ekta, many thanks for taking us through those details. But let's take a listen to Kiran Mazumdar-Shaw on the merger and the impact it could have on the company's financials. Take a look.
I think, Ekta, this whole concept of promoters is also fast dissipating. And of course, I will continue to be the largest shareholder in Biocon. I think at 44%, it's a pretty hefty shareholding. And I think today it's really about ensuring that you have good governance and that, shareholding should just be about being rewarded through performance. Well, I think we were oversubscribed when it came to the QIP, and I think we will go the QIP route because that would be the most elegant way of raising capital. And since we know that there's a huge interest in the Biocon stock, and especially through this announcement, we believe that the QIP would be the preferred route. So I think $1 billion debt for the kind of business we are building is a very comfortable debt to manage. And of course, as a company, because we will be throwing off free cash flow now going forward, given the fact that we've retired all the structured equity debts, which will of course throw up another 300 crores next fiscal, and the fact that we are now pursuing this route of merger, where a lot of the minority interest calculations and the kind of related party transactions will also free up more profits, I think puts us in a very strong position.
Kiran Mazumdar-Shaw there of Biocon. The other newsmaker today had been Fino Payments Bank, and after receiving that in-principle approval from the Reserve Bank of India to operate as a small finance bank, the stock though is taking a bit of a knock in today's session, down at the lowest point of the day now, 8.5% lower as we speak. Earlier today we spoke to Rishi Gupta, the MD and CEO, to understand how all of this would aid the company's growth strategy. Listen in.
From a margin point of view, I think the margin of a lending business and annuity income which will come up will definitely boost the bottom line of Fino to a large extent as we move in the direction of a small finance bank. As I said earlier, we already have the rails on the ground. We have the people at the corporate level. We already have a lot of people on the field. So our cost structures will not drastically change or will get added to a large number when we move from a payments bank to a small finance bank. From an investor point of view, I think a lot of profit booking is happening at this stage because this has been in the offing for the last couple of months. So some profit booking is happening. But from a long-term point of view, I think the build-up to the small finance bank and further as a small finance bank, I think the certainty with regard to the top line and especially on the bottom line will be there. We expect that the bottom line growth will be exponential once we move to a SFB model.
And Indigo is the top Nifty loser as operation disruptions continue. The company is also due to respond to the DGCA show cause notice by 6 p.m. today. Madhya Mujawar is here with all of those details. Madhya, tell us what the impact has been like so far.
Well, the impact is huge because Indigo is India's largest airline, controlling 65% market share. It operates over 2,200 flights every day. So we can only imagine how many passengers were impacted. And since December 2nd, Indigo has cancelled nearly 6,000 flights, hitting close to 9 lakh passengers, many of whom were left stranded across major airports. Some missed their job interviews, some missed their own weddings. Many don't have the money to book flights on other airlines due to the exorbitant rates. And it is a crisis that India has never seen before. Indigo CEO and the COO have been given time till 6 p.m. today by the DGCA, the aviation regulator, to give a complete comprehensive response on their failure to ensure reliable operations. The airline is slowly pulling itself out of a crisis that has shaken the entire aviation ecosystem. It claimed to have operated 1,650 flights yesterday, which means nearly 600 flights continued to be cancelled. The Indigo board has set up a crisis management group to bring operations back to normal. As per the Aviation Ministry, Indigo has processed refunds worth 610 crores and returned 3,000 luggage bags to passengers. But that's very little considering the scale of impact this crisis has had on passengers. Indigo has been the only profitable airline in India and has been expanding rapidly, and it would have never anticipated this kind of crisis. The stock is down nearly 15% since the crisis began, and the airline has lost over 37,000 crores in market cap since the 27th of November. So operations may be improving, but the accountability questions and the regulatory consequences are far from over for the airline.
Far from over indeed. 9.5% lower now, and as Madhya went on with her link, the stock kept on moving lower as well. And 9.5% now, the biggest single day fall that the stock has seen since February of 22. And the biggest, so it's almost what, 4 years now for Indigo to have witnessed such kind of a fall. 7th straight day of losses for the stock. Market cap below 2 lakh crores, as Arundhati mentioned earlier in the show as well. And now even below the 1.9 lakh crore mark as well as we speak. So top Nifty loser, Indigo, not good going for the stock, and the uncertainties seem far from over. Madhya, thank you for that update there. Take a short break. More news and updates on the other side.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. You're still with us on Business Lunch. Markets under pressure. Nifty over 0.5% in the red. But the midcap index taking a beating, down over 1,100 points. A US trade delegation will visit India from December 10th to the 12th to push forward talks on the first tranche of a bilateral trade agreement. Sources say the team will be led by Deputy US Trade Representative Rick Switzer, with India represented by Joint Secretary Darpan Jain. While this isn't an official negotiation round, both sides are aiming for strong progress on tariff issues.
Meanwhile, US President Donald Trump has weighed in on the proposed deal between Netflix and Warner Brothers. Speaking to reporters on Sunday, Trump said that he expects to have a say in whether the deal should move forward or not. Listen in.
I met with Ted. I think he's fantastic. I think he's, in the history of Hollywood, has really been almost, you could say, nothing like what he's done. You'd go back to Louis B. Mayer, maybe, Metro Goldwyn Mayer, MGM. Ted has done an incredible job. I mean, he had a company that was very troubled 7 or 8 years ago, and he took it over, and he's really done a legendary job.
Should they be allowed to buy Warner Brothers? Should Netflix?
Well, that's the question. They have a very big market share. And when they have Warner Brothers, you know, that share goes up a lot. So I don't know. That's going to be for some economists to tell. And also, and I'll be involved in that decision too.
Did they make?
They have a very big market share.
Did he make any guarantees to you about the merger if they do merge?
No. He came up. He was in the Oval Office last week. I have a lot of respect for him. He's a great person. But he's done one of the greatest jobs in the history of movies and other things. He's got a lot of interesting things happening aside from what you're talking about. But it is a big market share. There's no question about it. It could be a problem.
On that note, it is time for us to head into a short break. But more news and updates coming up on the other side. Stay tuned.
"26 years of CNBC TV18. 26 years of CNBC TV18.
$26,000 taken out on the downside on the index now. Below the 20 DEMA is where the Nifty currently trades. A cut of 210 points at the lowest point of the day is where the index lies. 98 stocks on the mid-cap index in the red, 96 on the small-cap index in the red. Well, it's been 26 years since CNBC TV18 went live, a time when markets were in a completely different dimension. Prashant Nair takes you back 26 years to tell you the shape, size, structure and returns that the market has provided over what has been an incredible period for the Indian economy.
26 years ago, CNBC TV18 went live and India's markets were a completely different universe. Even as we complain about how this has been a tough year, why not take you back 26 years to tell you the shape, size, structure and returns over this incredible period. Let's take a look at the massive reset which just played out. Let's look at the size of the market itself to begin with. From under 5 lakh crores when CNBC TV18 started to now over 470 lakh crore rupees in market capitalization. It's been a 100-bagger over the last 26 years. The number of companies listed has also grown nearly 5 times in this period, as you can see up on your screen. A look at the growth in trading activity in cash markets, stunning. I mean, from about 1650 crores to about 1 lakh crore in terms of daily turnover. Perhaps the biggest structural change, the financialization of India. Mutual funds share in household savings has gone up. I mean, I found data for 2011-12 used to be about 0.9% to about 6% today. And of course, many believe that we're just about starting. From barely 20 lakh demat accounts in 1999 to more than 14 crore today. From almost no SIP culture, which is now the bedrock of all the money which is coming into the market. I mean, regularly 20,000 crores every month. This is a market no longer owned by institutions, at least only by institutions. It's a market owned by India's households. Let's go back to the Nifty 50. I mean, the OG before the Y2K hit, right? 50 names that told the story of old India. And the names, I don't know how many of those names you recognize. I mean, Oriental Bank of Commerce was there in the Nifty. There was IDBI Bank in the Nifty and so many others. I mean, PSUs, lots of refiners, etc., etc. And that has changed. IT, private banks beginning to rise. Old-timers, of course, would recognize some of the logos up there. Cut to today, only 17 survivors on the benchmark. Basically, out of the 50 in 99, only 17 are there in the Nifty 50. And Reliance and others on your screen now. Let's take a look at the average. What did the average mid-cap, small-cap, large-cap look like in 99 and what it looks like now? What I've done is taken the current definitions of large, mid and small for comparison's sake. Top 100 is large, next 150 is mid and everything 250 first onwards is small. In 99, the top 100 companies made up 87% of total NSE. Today, that number is 60%. The largest stock used to be HUL with a market cap of 50,000 crores. Reliance, of course, 3-month ended average market cap November is 19.5 lakh crores for Reliance. Mid-caps make 20% of NSE now, while back then they were about 9% of the NSE. The largest mid-cap used to be Gujarat Gas, 800 crore market cap. The largest mid-cap today is 125 times that by current definition. DRL worth 1 lakh crore in market capitalization. Small caps now make up 20% of the NSE today. Guess what they were? 4% back, with the largest small cap being Foseco India, 150 crores in market capitalization. Today, ACC with 35,000 crores in market cap is the largest small cap. Markets ultimately follow earnings, and India's earnings story tells you why maybe this bull market has legs. And I've just divided this into phases. Between F505 and F510, EPS grew 11%. CAGR. Then came almost like a lost decade, F510 to F515, just 3% earnings growth. And of course, I mean, followed by about 6% from F515 to F520. And of course, I mean, COVID hit 20 to 25. We've seen a CAGR of about 20%. This is the strongest earnings phase we've had in about 2 decades or so. I will end with, of course, asset class return stable over the long term. As you will see, equities have delivered. The Nifty has compounded at about 12% for 26 years. It's beaten gold, beaten bonds, and every other traditional asset class.
So Prashant, outlining how much the Indian markets have grown in the last 26 years since CNBC TV18 started. But with that, it is a wrap on this edition of Business Lunch. Midcap Radar coming up next.
26 years of CNBC TV18. ...26 years of CNBC TV18.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. CNBC TV18 celebrates 26 years, so thank you for tuning in every day. But while we do that, the Nifty has seen a sharper fall. We are below the 26,000 mark. Big cuts coming in throughout. The broader market is seeing a lot of pain as well. So we'll get tracking that on the show today. Hey Vivek.
Good afternoon, and a big heartfelt thank you to all of our viewers for tuning in so religiously for all of these years. Well, talking about the market, you spoke about the Nifty. In fact, if you're looking at the broader end of the markets as well, look at the mid-cap as well as the small-cap index. As you can see on the bottom of your screen, seeing much sharper cuts. But, there's a lot lined up on the show, so let's start off with the top headlines. Markets under pressure with the Nifty near the 26,000 mark and the mid-cap index falling nearly 2% in trade. Realty and bank stocks dragged. IT stocks hold on to some ground.
Fino Payments Bank slips over 7% on trade amid profit booking as the company gets in-principle approval from the RBI to convert into a small finance bank. Management tells CNBC TV18 that profit growth will be exponential as they turn into an SFB.
Biocon slips in trade after the company announced its plans to make Biocon Biologics a 100% subsidiary. The management tells CNBC TV18 they will see synergies such as supply chain procurement playing out.
Kaynes Technologies continues to sell off even as the management holds an analyst call to assuage concerns over related party transactions. The stock is down another 4% after a 10% fall on Friday. Okay, a big fall all around. The Nifty is at the 25,900 mark, very close to breaking that as well. So very crucial levels to watch out for at the day's low. And there's been a swift fall in the last couple of minutes itself. That is the same case with mid-caps as well. We are down 1,300 points on the mid-caps, and that is a more than 2% cut that we are witnessing right now. All the sectoral indices in the red today. Nifty IT, which was in the green for some bit, has seen some reds as well. Now only Tech Mahindra is the stock which is seeing some green right now from the IT pack. Even other than that, we usually don't talk so much about Nifty, but there are hardly any green constituents on that one. Small cap index seeing a big battering as well from the highs. And that has actually continued, 25,900, the next important level to watch out for on the Nifty.
That's right, especially in the last 15-20 minutes of the session, the meltdown as far as the broader end of the markets has been even more significant. One particular space in the last week, and especially today, seeing quite a bit of a meltdown is actually the EMS space. So Kaynes Technologies continues its losing ways, down another 10%. This is despite management clarification as well as the commentary in the analyst call, and dragging it along is also Dixon as well as Umber Enterprises. But these stocks and a whole host of other names is what Hormaz has on the wall. He's standing by the wall to take us through all of the mid-caps that are moving around in the session.
You may want to hide if you're a bull. We look at the screens right now, but it's losing selling pressure across the board. And real estate stocks are leading that fall in today's session. Every constituent on the real estate index is trading with losses. Look at Godrej Properties is down 6, Prestige Estates down 5, DLF, Sobha, all of them at the lowest point of the day. No, similar looking picture for the PSU Bank index as well. It made a high towards the end of November, and since then has been on a downward spiral ever since that FDI clarification from the government had come. PNB, Canara Bank, Bank of India, Union Bank, all of them down anywhere between 4 to 4.5% in today's trading session. What's also not doing well within the broader markets are the defense stocks, and they have been on a bit of a selling spree as well over the last 5 to 7 trading sessions. Data Patterns is now down 7, Masgao Dock is now down 5, it's now almost down 30-35% from its recent highs. Garden Reach, Bharat Dynamics, all of them seeing pain in today's trading session as well. Look at the newsmakers in today's session. Are expecting Fino Payments Bank to react positively to the announcement. Quite the contrary, 9.5% lower. As Vivek highlighted, Kaynes Technologies, another 10% knocked off after its worst week since its listing. Matrimony is one bucking the trend, of course, considering a buyback proposal next Monday. And of course, Deccan Gold Mines announcing its rights issue details last week and extending those losses now down another 9% in today's session. Apart from Matrimony, what's also bucking the trend in today's session is Rolex Rings. SpiceJet is significantly off the highs of the day. A very sharp knock in the last few minutes, was up almost 10-11% just a few minutes ago. But Dredging Corp and Latent View are also holding on to gains of anywhere between 7 to 11%.
Okay, some interesting names there. Thank you so much, Hormuz, for joining us. Some big moves on the downside in the broader markets, but there are some stocks which are buzzing on the upside as well. Let's do one thing. We'll slip into a break. When we come back, we'll focus on Kaynes Tech. A big fall on that one. We'll get you the reasons why that's happening.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. Well, 26 years of CNBC TV18, so we've got to celebrate. Let's go across to our managing editor, Shriram Finance, and our entire team in Mumbai, Noida, and other newsrooms as well. Bengaluru, we see our colleagues from Bengaluru as well. Guys, happy birthday to all of you, and what glorious journey. And every day that we come to the studios, to our viewers, we do it with just one thing, that we will not waste your time. Every minute matters. Shriram.
Well, yes, happy birthday, everybody, and happy birthday to all of our colleagues in Bangalore, in Mumbai. It's fabulous to be here and still be around to celebrate CNBC TV18's 26th anniversary. But, you know, that's what drives our newsroom, right? Plenty of passion, plenty of energy, perseverance, and we hope that we can continue to dominate the Twigital era. That's my favorite phrase now, where we're going Twigital. So we hope to be able to be leaders, not just on television, but off television as well. But, you know, you're seeing a lot of faces here on your screens today. Not many of them are people that you normally see regularly on the channel, but this really is the backbone. They are the heart and soul of CNBC TV18. It's a few of us that you see every day, but this is the army. It's the CNBC TV18 army that puts together all of our shows day in and day out. And so huge thank you to everybody at CNBC TV18. Our heartfelt gratitude for keeping this channel going day after day. Thank you so much. And I'm going to hand it over to Mangalam because he's been officially given this job. Mangalam, go ahead.
No, you spoke about digital and you spoke about 26, so I thought I'd surround myself with the people of the digital team, at the same time the ones who are sub 26, because when I joined CNBC TV18, I was sub 26 as well. So guys, what a wonderful journey it has been for us. I just want to know how it has been for y'all and what y'all are looking forward to the most. Shreya, incidentally, Shreya is 26 as well.
Yeah. Somehow, I just had to come here some years ago, and I was born in the same year as CNBC, and I'm very grateful. It was a coincidence and a lovely one at that. So I'm grateful. Is like a lot of happiness and a lot of success is what I wish for CNBC. And yeah, all of us are very excited.
And we also have someone who's not much above 26 as well. And we're talking about Lata. Lata, please, not too far away. You're young from your heart, a lot younger actually.
I joined when I was 16, and I'm 16 even today. Don't ask me this question again.
What about, we have someone else, Rachna as well.
I mean, Shreya just turned 26. But yeah, it's been great. I came here when I wasn't even 25, and it's been fabulous 2 years.
Prashant, you want to chime in?
No, I just want to say that I think we all feel younger because we work with such bright young people that it's just incredible. It's an incredible feeling, and I think they're the ones who make all of us seem younger. I mean, some have natural inspiration like Lata ma'am, but others need...
I feel younger nevertheless, Prashant. Right, you know, we have Ritu with a lone pastry in Bangalore, or is there a big cake there as well, Ritu?
Well, there's a huge cake, Mangalam, not as many people to eat it. Strong, but small team here in Bangalore, very excited. And of course, very excited for the 26th birthday. I'll toss it to you guys back in Mumbai as we look to cut this cake very soon. And I'm hoping to get more colleagues in to be able to finish this. It's a huge one, 26 years, milestone year.
Where everybody's on a diet. I don't think we're going to be able to finish any of these cakes. People are perpetually on a diet here now. So
Shriram, speak for yourself. Shriram, on diet, speak for yourself.
No, I'm not on a diet. I'm never on a diet. I'm never on a diet.
I think on a per capita basis, Bangalore has the most cake. I
don't know. We'll be mindful of that.
I think we're looking for Shankar, who's around somewhere.
We're looking for
he's hiding somewhere.
All right, and in a short while from here, we'll start the cake cutting.
Where is he?
We need...
Mangalam, go find him.
Yeah, no, you had a command, which was what? Cake cut?
Yeah, let's cut the cake. Let's eat cake.
No.
All right.
So this this is for those of you who are watching. This man is our pillar, and he's sort of the karta dharta of CNBC TV18. So mark that face.
Shriram, I believe if Indigo had Shankar, maybe they would not have had these problems.
No, we're not.
All right.
We're not going down that road. We're not going down that road. Let's get to the cake cutting.
Yes, let's get to the cake then. The only thing that I'll say is that, in Hindu mythology, Shankar's the destroyer. In CNBC TV18, he's the creator. Let's go, please.
Come on, Dipali.
Stop singing.
Happy birthday. Who's 26? Yeah, who's 26?
Happy birthday.
Come on, quickly. Come on.
Happy birthday to you.
Happy birthday to you.
We'll now know who's on that diet and who's not.
26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back to Midcap Radar. Well, the celebration continues here at CNBC TV18 as we celebrate 26 years of leadership. Our colleague Parikshit Luthra spoke with Tata Motors PV's MD and CEO Shailesh Chandra on the response to the new Tata Sierra launch as well as the road forward. Let's listen in.
Response to Sierra right from the time we released the brand film, and then we had the brand days, followed by the launch event that we had on November 25th. Since then, I think the response has been overwhelming, I would say. Much more than what we were really expecting in terms of response that we would get. The inquiries have been phenomenally high. And as you know, that bookings are really going to start from 16 December. So we have to wait till then. But the extent of inquiries that we have been getting, and also people booking their interest, is enormously high, and we expect that when the bookings open on 16th, the numbers would be overwhelmingly high. So we are just expecting on 16th we get a positive surprise for all of us.
All right. Could you give us a sense of the discount levels of December year-end sales, and how will that impact the costs that the company will have to incur on account of discounting?
Yeah, so Parikshit, you know that December, typically it's a very high retail month. And generally the customers who buy cars in December are seeking, attractive offers ahead of the start of a new year. And therefore, typically you see as a part of seasonality that the offers are higher in the market to tap that customer who's looking for that kind of an offering. So generally the discount levels are higher as compared to the earlier months. So every OEM goes very selective about which models they would like to, top up the offer of what was ongoing in the earlier months. So similar kind of calls we would have also taken, but these are very planned VMEs, I would say, very planned well ahead of the December sales. So this will be slightly higher in select models, and we hope that therefore retail, which we are going to see in December, should be very comparable to what we were seeing in the festive period.
Right. Could you give us the range of discounts, starting from the minimum to the maximum?
Very difficult. I would not have the numbers offhand. But whatever was prevailing in November, it is slight increase from that level, in select models.
All right. Is Tata Motors likely to increase prices in January? And if yes, by how much?
See, the increase in price needs to be put in the context of the GST 2.0 drop that had happened. And therefore, the baseline of prices of all the cars went down, depending on the segment of the car, by anywhere between 3.5% to 8.5%. And that baseline drop is something which we have to maintain in the spirit in which the government has reduced that. Having said that, there has been an increase in the commodity prices right from January 25 and we have not been able to pass on as an OEM this commodity price increase to the market. And I would say the extent of commodity price increase would have been in the zone of 1.5% to 2% of the revenue. And to some extent, we have been able to offset that with the cost reduction actions that we have been taking internally. So whatever residual part of that commodity price increase, which we have not been able to pass it on to the market for the last 1 year, is the extent to which we will consider as a price increase somewhere in Q4, maybe in Jan. That is to be decided yet. We are still reviewing that part, but the residual part of commodity increase is something which we are looking forward to take as price increase in the Q4 without disturbing anything as far as the GST 2.0 reduction is concerned.
Right. So what will be the residual amount of commodity price increase which you've not been able to absorb so far, sir? And how much is likely to be passed on as per initial estimates?
I would not like to share that number because, as I said, that it is still under review. but I have already given the extent of commodity increase as a percentage of revenue that has happened since the last price increase that we had taken somewhere early this calendar year. And that is to the extent of 1.5–2% of revenue.
All right. How would you describe the overall sentiment in the market right now?
Yeah, it's been very buoyant, right, since the GST 2.0, implementation from 22nd September. We have been seeing, at least in Tata Motors, I can say that the inquiries, year-on-year growth in inquiries is pretty much been seen in double digit. And to that extent, one is getting reflection in the bookings also. And you are also seeing the growth rates for the last 2 to 3 months as far as industry is concerned, mostly double digit. So therefore, the overall mood remains very good. And so is the trend that we are seeing in December too.
All right, that's the word coming in from Tata Motors PV. With that, we'll take your leave on this edition of Midcap Radar with the news that the Nifty is above the 25,900 mark, but will be very, very important to track those levels. We'll take your leave, closing bell when we return.
26 years of CNBC TV18.
Fairly subdued picture across the Asia Pacific as well. No major directional cues.
Refunds worth over 600 crore have been processed.
The number of companies listed has also grown nearly 5 times in this period.
2047, 100 years after independence, I think get ready for us. Index in the 7 figures.
I really don't think people should worry about succession planning. I think we have an excellent management team.
2,100 stocks which are in the red, for about 700 stocks which are in the green.
Point of view, I think the stock will jump from the point of view that we have building a model which is more stable and more predictable.
As we speak, we are rolling out the first wave of new products, which will be reaching dealerships very soon.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC TV18 Motilal Oswal studio. Last 1.5 hours to go and markets have sunk to the day's low and trading with steep losses now. 1% gone on the benchmark indices. Look at the mid-cap index. Mid-cap index down 2%, small-cap index down 2.5%, and the advanced decline ratio 1:6. 423 stocks advancing to about 2,500 stocks declining. I think since the year, the problem has been that the broader markets, the portfolios have been struggling and not performing. And look at the way it's pretty much ending. I know here we've been celebrating at CNBC TV18 26 glorious years, but today the market at least doesn't feel so glorious.
Well, that's right, Rima. In fact, the manner of the fall is a little bit worrying in today's trading session because we started off more or less stable, had a mild cut, and on an every hour basis, actually, we have been making a lower low. So I think that's a bit of a worry as well. The breadth of the market, portfolios are getting absolutely hammered. But the hope is that maybe, in fact, the excesses are getting cleared out. And I think one point, Rima, two of the leading sectors, whether it was aviation or EMS, both those two have come for profit taking. So that's a bit of a worrying aspect because Interglobe Aviation has lost its way. And the EMS pack, where everyone has been talking about the long growth, the runway that is there, that sector has come in for some profit taking. So that's a bit of an issue. And remember, this fall is coming on a growth-oriented RBI verdict as well as on a favorable GDP print as well. So I think that's a bit of an issue.
So the rate sensitives which rallied on Friday are getting undone now. So the Nifty Realty Index has a cut of about 3.5%. The Nifty Auto Index also underperforming the benchmark indices with a fall of 1.5%. The Nifty Bank has a cut of about 678 points. On Thursday and Friday, markets rallied, especially on Friday. But on Thursday, Friday, together we added about 200 points. But today, we've lost a lot more than that. On the Nifty, we're down close to about 270 points.
All right, a good time to welcome in, a market expert, market veteran as well, Manish Chokani, Director at Inam Holdings, who joins us on the show. Hi, Mr. Chokani. Good afternoon and good to see you in. It's always a pleasure to talk to you, sir. You've been a friend, to the channel, and it's been great interacting with you over the last many, many years. And obviously, CNBC TV18 even before I came on board. Tell us how do you feel today first about our 26 years?
Well, thanks for having me, Nigel, and congratulations on 26 years. I'm looking at you, looking young and handsome, and I can only think back to once upon a time I was like that too. So thanks for reminding me of how one looked when one was much younger. But I would like to say, though, that, there are few institutions in India which have stood the test of time and kept the trust of every citizen going. Our army being, of course, right on top over there. And there's so many institutions, the Election Commission. But in that list, I would like to add the capital markets, which are always on and always functioning and always helping people to get wealthier as time goes by. And like the famous old saying said, that you can, if you want to feed a man, give him a fish. But you want to feed him for a lifetime, then you teach him how to fish. Right. And in that context, the work that CNBC and others of your profession have been doing is just simply outstanding to actually bring the capital markets and wealth creation to every citizen of India and help them participate in this incredible wealth creation journey. So thank you for that.
All right, that's heartening to hear, Mr. Chokani, and thank you for those words as well. You know, before I joined CNBC TV18, I obviously was following you, and thanks to CNBC TV18, you know, the brand, that I get to interact with you more often as well. That said, we are celebrating our 26 years, but the market's a little bit subdued today. What are you making of the current market setup? You know, it's a little bit worrying because we had a pretty good GDP print. The nominal number obviously was still in high single digits, which is a bit of a worry. But the RBI has pivoted. Growth focus is what they're talking about. For the time being, the market is ignoring any kind of good news. How are you feeling about the Indian markets?
Nigel, it's not a sort of T20 game in a sense. And I sometimes laugh and joke with my colleagues that maybe I belong to the sort of earlier generation which played test matches and where victory was decided over 5 days. And not as, you have in T20, if you lose 5 overs of the T20, you are out of the game. So that's not the case with, when you're investing. You have to take a longer term view of businesses that you're owning and people that you're backing. And occasionally, if you get ahead of yourself, like we did, I think in September 24, when the valuations were completely off the charts, we spent a year kind of consolidating and still hoping for this growth to come back. But when you see a single-digit GDP print and RBI has to pivot towards growth, it's telling you that there's a challenge. And while all of us participants remain optimistic and hopeful about our earnings recovery, it's also a fact that if inflation remains, this 2-3%, and nominal growth remains 2-3%, then even getting to a 15% type headline earning growth is not kind of in the bag. And a market still trading, north of 20. And again, the challenge that I know you'll ask me is, at what point do foreign investors come back and so on and so forth? The reality is, look, everyone is here chasing growth and a higher rate of return. So people happily will buy, Zomato or a lot of even the QSR type companies at 100 times forward on 27 earnings. But they don't want to buy a 5P multiple, PSU Bank, for example. So it's always growth in context of valuation that one has to think about. And our market needs to digest that a bit, that we are ahead of ourselves in many, many pockets of the market.
Manish, hi, afternoon, this is Rima here. So we'll come to the pockets where you see some overvaluation still, because it's been a long period of consolidation, 14 months for our markets to get to their all-time high levels. But before that, your own verdict and view of the global markets. Do you think this AI tech momentum continues into 2026? And if that is the case, will India continue to underperform emerging markets, say Korea, Taiwan, China, which is seen as AI plays? What is your top-down view for the global markets?
So thanks for that, Rima. That I think the AI reality is a bit like what we experienced, in fact, when your channel started, that the 99 and 2000 period where it was complete euphoria on the emergence of the internet. And it was the telecom companies which were building the backbone. And you had all these global crossings and people like that who are, going hammer and tongs at building out the infrastructure. At a certain point, the market just pivoted and said, the capex doesn't justify the returns that are going to come out of this space. And in fact, I may be off by a few months, but I don't think the NASDAQ came back to its 2001 peak until 2013. So it's not a 3, 4, 5 month phenomena. It often takes decades for excesses of valuation to get corrected. Even our most famous company, Infosys, which peaked out in 2001, I don't think took out that previous peak for the next decade. And there are a number of places where, in the US also, where these 5 or 6 companies have taken out the bulk of valuation for that market. They've in fact been underperforming emerging markets as well as precious metals. And it's showing some sort of a regime change, that there is inflationary expectation in the developed Western world. And that inflation, therefore, will show up in terms of higher prices for commodities. And increasingly to things like gold and silver and uranium and copper and so on and so forth. Plus emerging markets, excluding India, have already started outperforming last year, and that trend is going to continue. So India needs to correct a bit for its excesses, I guess, on valuation, and also discover our mojo and what's our next big sort of profit opportunity, which even you guys are grappling with. Because in the absence of creating our own tech and our own brands and our own way to create the next burst of external businesses, we're sort of trapped in a sort of low growth, only a market share internal grabbing kind of exercise. So we will probably tread water for a while.
But just a simple answer. Do you think we are in an AI bubble? The setup is similar to 1999, 2000, because what followed was the dot-com bust. Are we there yet or not?
Yeah, so, like I said, it's similar to that period where internet companies, of course, continue to do well. It was the valuations which suffered. And again, it seems to me very strange that someone would pay, a $5 trillion valuation for what is essentially, essentially it's a capital goods stock, and don't hold me to that exact term. That if you're buying chips which will effectively become degraded in 3, 4, 5 years, and that capex cycle can't continue at this pace, plus others like Google and all have come into the the game as well, and the craziness which is going on with the OpenAI valuations. So valuations is really bubble-like, and typically what happens is demand suddenly everyone wakes up at the same time and says we're spending too much. So what looks like justified on current earnings not being excessive, people often point out that there are 25, 30 multiple stocks, but these are predicated on that level of earnings coming through. And typically what happens is that these earnings then don't come through, and stocks then typically correct, as much as 50, 60%. From where it takes a very long period to then, come back to the previous high. So I do think while AI is here and it's a transformational thing for all of us, and we'll all be living in that reality in the next 3, 4, 5 years, very much like the way the internet transformed our lives, it transformed our businesses as well. The same thing will hold true for AI, but not necessarily for stock prices of a lot of these AI companies. And again, to take that format forward, it were people who were users of the internet, for example, financial companies like ours, or healthcare companies, or retail companies, which will be big beneficiaries of this AI boom. And the way to play AI is therefore eventually to go to the businesses that benefit from that, serving consumers, rather than necessarily those who are, the providers of capital. Again, think of it in the Indian context that maybe Jio made a lot of investments to build out the broadband network for India, and it kept India going during COVID. But the people who benefited from it was not Jio in that sense, in terms of, the way they made the ROI. But it gave rise to people like, Zerodha and Grow, or indeed Zomato and the others. So you need to be thinking in terms of second derivative, that where is this, ball going towards? Let me pause on that.
All right, Mr. Chokani, if you had to give us a couple of themes, you're obviously highlighting that there has to be some bit of a corrective phase that could continue in the near term because of the valuations, because growth is not really catching up, and maybe earnings, as you mentioned the last time around, you cautioned us, maybe the street is a little bit too optimistic. But you have to name a couple of themes that still look well-placed, maybe post the recent correction in a lot of those sectors, whether it's EMS, renewables, defense, all through the last 12, 18 months or so, saw a lot of interest. And they've fallen off the cliff, actually, a lot of stocks out there. But in terms of themes that you still like, what would they be?
So, Nigel, I buy things bottom up, and it's not really thematic. When things become popular, actually, they tend to go to an excess. And like Dr. Mark Faber used to very famously say, at the beginning of a cycle, the entrepreneur has the vision and the investor has the money. And by the end of the cycle, the entrepreneur has taken away the money and the investor is left with the vision. And a lot of that is happening now, as you see, including companies from overseas selling down their stakes, Indian promoters selling down their stakes, private equity selling down their stakes. And really, Indian retail has been lapping it up by way of the massive inflows that one has been having. And even professional fund managers have been struggling to justify what they are buying at the valuations they are, and taking cover in the fact that they have no choice but to deploy capital. So the unloved segments, when you go and invest over there, for example, I could mention, PSU banks as possibly one example. The finance minister herself has said that her attention is going to be a lot more on privatization now. We also know that this whole trade shifting away from tech to hard assets is a decadal trade which will take place. You've seen the performance last year of gold, silver. Already it's happened with uranium, already zooming on copper and the others. So that's a trade which is taking place as well. And they're starting with, well, not exactly depressed and low valuation, but relative to where the rest of the market is, they may look very, very cheap. And I've spoken in the past about you win when you get asymmetrical bets. And if you think in terms of, is this a 5p stock 5 years out? So if you can't look out till say 2030, and you can't predict earnings of the company, you have no business buying it. But if it looks like it could be a 5p stock by 2030 based on what price you're paying today, the odds are that you'll reach a 15 to 25 multiple by that time, which means you make 3 to 5 times your money, which is a reasonable rate of return to make in a 5-year time span. So there are enough things to do. I don't mean to say the entire market is overpriced, but when you're buying stocks at 50 and 100 Ps, your execution has to go completely right, and your macro has to stay completely right for you to make money. And being a value guy, it's been harder for us, to hold on to stocks which we bought early, but we can't hold on till they go to 100. So we are rotating more towards what I call the value side of the market.
Manish, great chatting with you. Thank you very much for joining in. But the point is well taken that many stocks still today are priced to perfection in India. We will slip into a break on that note. On the other side, we'll talk market technicals. Mitesh Thakkar joins in. Dipan Mehta of Elixir Equities will also put the spotlight on individual stocks.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Okay, well, it's a tough looking screen and 256 odd points lower. We are starting closing bell, I think, what, about 5-6 minutes early. But it's not a good looking screen at all. I think we are below the 20-day moving average for the Nifty, and I think for the Nifty Bank as well, while I think the 20-day perhaps would not be broken, but we should be very, very close to it. Okay. It is broken. 59,140 is where we are at. And I think the 20-day, as of yesterday's close at least, is above it. So that daily average, 59,030 was the daily, the 20-day moving average. Okay, I think we're still above.
Today's low as well.
At today's low, we've
we have breached it and we bounced back.
Yeah. Just about breaching it by 1 point or so, and then from almost exactly that coming up today. Market breadth is terrible. Just look at it. 5:1 declines to advances. 2,600 stocks are lower, and you've got about 500 stocks which are higher at this point. Mitesh is with us with a quick technical view, and it's looking pretty bad. Mitesh, good afternoon. I don't know, when we spoke in the morning, it was a more tear-over kind of screen, at least from a GIFT Nifty point of view, and it just completely collapsed. What's your sense, Mitesh?
True, Prashant. I think, it was a quiet screen in the morning. But again, I think I maintain that we'll do this range of about 25,850 to about 26,300. And, we were kind of coming off from the highs, because Friday, I think we got a high of around 26,200. And therefore, getting towards the lower end of the range wasn't a problem. I think if we get a closing below 25,850, I think that will, be a first kind of big warning sign for me. And then you might look at further declines, possibly to even as low as 25,450 levels, and then maybe lower. So I think holding on 25,850, 800 zones for me would be very important. And a break below that, would be slightly negative and could start a short-term correction, which could then even evolve into something big. Given the fact we've been quite overbought after the rally from 24,600 to about 25 to about 26,300. And now we might retrace a significant part. So in that sense, the market structure is not very comfortable, and therefore 25,850, 800 to me remains a very decisive level in determining short-term trend. On the stock side, I have two sell calls right now. PNB is a sell with a stop at 120 for targets of 110, and Geo Financial is a sell with a stop at 301.1 and targets of 285.
Okay, PNB and Geo Financial, and 25,800, 25,850 is the pivotal level for Mitesh in terms of specifics. Mitesh, if I can request you to just stay with us, but I'll come back to you, maybe just a name or two from a broader market perspective and how things are collapsing. But we got some news as well with regards to industry data from general insurance, from life insurance companies. General insurance data came out earlier. Life insurance numbers came out just, I think, about an hour and a half back. Yash is here with what stands out. Yash, over to you.
Well, Prashant, it's blockbuster numbers coming from two companies specifically. One is SBI Life Insurance, and the second one is Axis Max Life or Max Financial Services. And it almost is like these two companies have gotten into a habit of delivering very, very strong numbers. Importantly, the strong numbers in the month of November comes on a very strong base as well. So that's an added advantage as far as the quality of numbers is concerned. Speaking about Axis Max Life, the new business premium has grown at 24%, total AP growing at 25%, retail AP growing at 23%. That is one. The second one is SBI Life, even better. New business premium growing at 35%, total AP growing at 30%, retail AP growing by about 33%. Speaking about other companies, to start with HDFC Life, it's a weak growth, but it has come on a strong base. New business premium growing by just about 2%, total AP by 16%, retail AP growing by 20%. ICICI Prudential Life, weak growth on a strong base. New business premium down 41%, total AP down 52%, the retail AP, that has seen a growth of about 13%. LIC, it's a strong growth, but the base was also quite favorable to the company. New business premium growing by 35%, total AP down by about 49%, retail AP up by about 23%.
Thank you very much for that. On a side note, the rupee too has depreciated today. When we opened, I think it was 90.07, and now as we speak, the rate is 90.17. I think the all-time low, record low, was 90.3.
90.4.
90.4. Okay, but there has been a gradual depreciation today, perhaps to do with the kind of weakness that we've seen in the markets, and maybe there will be strong outflows from the equity markets. Dipan Mehta is now joining in. Dipan, afternoon. How are you making sense of the fall? It's quite brutal when you look at the small cap index in particular. That's down over 2.5%, inching towards a 3% decline. The advanced decline ratio is just getting worse now. 2 stocks advancing for 13. I mean, if you had to put reasons to the fall today, what would they be?
Oh, I think they're difficult to put reasons to this thing, but it could be because a lot of money is flowing into the IPO market. I think we are seeing big IPOs getting fantastic collections as well. So a lot of, I would say, attention has got diverted over there. And also this delay as far as the trade deal with US, they're also kind of unnerving a few traders because bets have been placed on the fact that in a few weeks or so, we would have a very favorable trade deal, but that's not happening. That's getting delayed. So that's also affecting the trader sentiment and the rupee depreciation. I mean, it's all fine to say that it will not affect our economy is strong and everything, but it is definitely very negative for foreign investors. So that also seems to be affecting the sentiment over here. But all of these things seem to be transient because the underlying growth momentum seems pretty much stable. All the indicators are pretty strong. And I'm just waiting for the next year when we'll see December quarter numbers, which I think will surprise on the upside.
All right. Hi, Dipan. Good afternoon. Good to see you. And Dipan, at times, adversities bring the best buying opportunity. Interglobe is one such stock that's corrected 20% from the top. And the problem looks quite large at hand. But given the kind of leadership, given that they're a lean and mean machine, that's what they've shaped up to be in the last few years, would you look to buy into it after a 20% correction? Or do you think they're still far away from resolution? The employee cost is going to go up, the operational cost as well is going to go up, and you have the rupee weakness, that's could be another headwind. Would you look to buy this dip?
Good afternoon, Nigel. First, a disclosure, we already have shares of Indigo with ourselves in our model portfolio and with our clients. So we are feeling the pain of the stock price correcting, not to mention the pain of a lot of travelers also. It can be quite harrowing for flights to get cancelled, especially at this time when it's full wedding season. So yes, I think it's the company's in a bit of a problem situation. But I mean, I know that it is not right to say so. But these such companies with the kind of market share which they have and the kind of expansion and additional seat capacity coming into play, if you have a 2-3 year type of a view, then there definitely is a buying opportunity. They will solve all of these problems. Okay, some cost may go up, but the big cost for the company, of course, is the lease rentals which they pay and the aviation fuel. And that's pretty much stable, except that the rupee depreciation will cause a bit more of a problem in the December quarter as well. So if you are prepared to look for Indigo beyond December and March quarter and more into the next financial year, then I think it's available at reasonable valuations. It's amongst the very, very few Nifty companies which can still grow at kind of double-digit mid-teens type of growth rates. There are very few left in the Nifty just now. So from that point of view, I think if you're benchmarking versus the Nifty, then definitely I would like to be overweight Indigo. And otherwise also, I think if investors in their portfolio do not have adequate exposure to travel and tourism, which is in a secular growth mode, then this is a great stock, actually the leader in that sector. So at times like this, when there is panic and where there is so much of, I would say, angst around the stock, it may be a good buying opportunity, but you should be prepared for a high degree of volatility.
Dipan, hi, afternoon. The bigger question, and we don't know the answer, there's no way to know yet, is that a lot of criticism essentially exactly for, the kind of leadership that Indigo enjoys, right? That they're almost, they have about 0.75% share. So what happens when something like this happens with a player with 0.75% share? It's India halts. So, I don't know if this is the correct analogy, but look at what happened with NSE and BSE, right? NSE was the monopoly. BSE is now slowly over the last 3 years built a 25% market share. and I remember over the last 3 years, there are many who believed that, you know, the regulator, the government, they want more than one player because these are, you know, integral to healthy functioning of that sector of the economy. I mean, a large exchange is, and so is airline, right? I mean, so are airlines as a business. I don't know in what shape, form can the government encourage more competition, but I'm not even sure, but I'm just thinking out aloud. For now, though, let's go across to Madiha, who's here with what she's picking up. She's been in touch with stakeholders across the board. Madiha, I don't know if you have an answer to the question I was wondering aloud, but first take us through what you're picking up. What's the latest?
No, right, Prashant. That's the question on everyone's mind. The monopoly that Indigo has in Indian aviation, and why don't we see more players? I mean, aviation is so vulnerable to external factors. Startup airlines are struggling to begin because no lessor is ready to, lease an aircraft to them. So how can the government step in here, to support these startup airlines and encourage competition? But as far as Indigo is concerned, the impact is huge because Indigo is, as we were talking about, India's largest airline, controlling 65% market share. It operates 2,200 flights every day. And since December 2, Indigo has cancelled nearly 6,000 flights, hitting close to 9 lakh passengers. That's the impact, many of whom were left stranded across major airports. Some missed their job interviews, some missed their own weddings, and many don't have money to book flights on other airlines due to the exorbitant rates that we saw after this crisis started. It is a crisis that India has never seen before. Indigo CEO and the COO have been given time till 6 p.m. today, not much time left, by the DGCA to give a complete, comprehensive response on their failure to ensure reliable operations. The airline is slowly pulling itself out of a crisis that has shaken the entire aviation ecosystem. It claimed to have operated 1,650 flights yesterday, which was quite an improvement, and plans to operate over 1,800 flights today. That's what Indigo just said. The Indigo board has set up a crisis management group to bring operations back to normal. And as per the Aviation Ministry's latest data, Indigo has processed refunds worth 827 crores. That's the latest figure between the 21st December to 21st November to 7th December, and has returned 4,500 luggage bags to passengers out of the 9,000 that it claims it is yet to deliver. But that's very little considering the scale of impact this has had. Indigo has been the only profitable airline in India and has been expanding rapidly. It would have never anticipated this kind of crisis. The stock is down nearly 15% since the crisis began, and the airline has lost over 37,000 crores in market cap since the 27th of November. So operations may be improving, but accountability questions and the regulatory consequences are far from over.
And we'll see what the CEO and the management basically tells the government. 6 p.m. deadline. So about less than 4 hours to go. I mean, it's a report. They'll have to reply, but the pain, of course, being felt by consumers across the country. I just want to shift gears and talk about one more name, Fino Payment Bank. You know, they got the license from the RBI, a long time in the making, and so much speculation around it. License comes, stock actually, I don't think sees green at all. I mean, it starts lower and now down 13%. It's gone the other way. It's almost like, some license has been cancelled, not given. Deepan, what do you make of it?
I'm quite perplexed when I saw the stock price correction. And actually, it's quite an interesting bank, and the business model, the scale of operation, the nature of operation is very different from a lot of other banks. And actually, their correspondence or the network actually acts like a branch. I'm very surprised at this kind of a correction. I thought the quarterly numbers also were pretty much okay. So maybe there's something more that meets the eye over here, something that we are missing, some news or something. But I don't think there's anything negative that I've heard. But nonetheless, even I'm as surprised as you are. But it's not a bad bank per se, and I think becoming a full sort of small finance bank will certainly help enhance its image and also improve its profitability going forward. So I'm a bit surprised at this correction. So far, no negative news heard, but who knows?
Deepan, that you saw that eternal block in the morning, right? There was an unidentified institutional seller, which is, it was selling from one of the institutions. I don't know. Will we see a possible? It's basically the problem is everybody is on the sell side, right? Retail right now is on the sell side. Institutional investors are on the sell side. Sponsors are selling. Promoters are selling. Of course, foreign investors are selling. Only thing which is who not selling is mutual funds. And that retail money, which is, I guess, the 20,000 crores which goes in every month. Days like today make you wonder how long will that, is that going to be like a steady thing, or people's patience is going to be tested?
Shan, we just hit a new high, whatever, 5-10 trading sessions ago. Just a minor correction. I think this is part and parcel of the market. It's no big cause for concern.
Deepan, I'm not even talking about the Nifty. Nifty to jo karta hai kar. On the day, I'll tell you, I looked at NSE 500, right? Nifty went back to September 2024 level. Only 170 out of 500 companies were even in the green. And 170 companies which were in the green, I counted very generously. About 20-30 of them were up 1% over the same period. I should have knocked them out. So it's the broader market which is kind of very painful.
No, Prashant, you're right. I think there is a very, I would say, severe correction in investors' portfolios. So that certainly is a cause for concern. But I think investors will learn the hard way that this is not a market which goes one way up, and you got to take knocks on your portfolio as well. But I'm not that concerned. I think people who have still got cash in their portfolios or in their savings should put it to work. Of course, you should not be cancelling your SIPs or anything like that, and have a faith that and confidence that the overall economy, the corporate earnings certainly are looking up, and we are seeing a very good correction of the P multiples. Even the market is going up. Everybody's just talking about how high the P multiples are and how ridiculously high they are and how they are unjustified. Now we are reaching a stage where a lot of good quality businesses are available at reasonable valuations. And this is a great time for a long-term investor to put money to work. I know some may not have the cash. You don't have the cash. You remain invested. Reshuffle your portfolio into stocks, which you think can perform better. So you can do some relative performance, strategy over here as well, and try and improve the quality of your portfolio. But I'm not at all concerned about the way the market is correcting. This is part and parcel. It happens like that only. Who knows, 5-6 months down the line, once the Nifty has gone to another new high, and you will see pickup coming into small mid-cap stock. And one last thought I want to leave you with is that right now you may see a lot of FI selling. That is true. But the minute they feel the rupee is stabilized and the valuations are reasonable in small mid-cap, I am certain that a lot of their buying will go back into small mid-cap stocks, as a lot of FIs are very, very active in the IPO market, as can be seen. So once you feel that good quality businesses in small mid-cap space are available for the FI investors, I think they'll be there to support those prices and buy at those levels. So I'm not that pessimistic at all just now.
Okay, all right, Deepan, stay with us. We're going to just take a quick break here and continue this conversation. 25,920, so 270 points lower, but 5 down for every 1 stock higher. So that's advanced decline for you. Stay tuned, coming back.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. Markets continue to struggle at the low point of the day as we speak. But let's focus on a couple of names. Biocon will make Biocon Biologics a 100% subsidiary. The board has also approved the swap ratio for the transaction and cleared a proposal to raise up to around 4,500 crores via the QIP route. Ekta joins us to help us out with details of this deal and also the key takeaways from the management. Ekta?
Well, yes, Biocon is in focus. They will be making Biocon Biologics into a 100% subsidiary. So a couple of things which they said and Kiran Mazumdar-Shaw told us over the interview as well as over the analyst call is that the reason for this is that the Biocon stock was being undervalued post the Viatris biosimilar buyout which took place. And this will essentially also get rid of the holding company discount as well. Now, they will have to assess whether Shriram Mylan, the timeline in terms of the investments, when quizzed about whether or not they would be strategic partners going forward, Kiran Mazumdar-Shaw did say that they are really not essential to the longer-term story of Biocon Biologics. They are welcomed investors, but not really integral in terms of the way that Biocon Biologics is shaping up. And hence the question on board succession, where she said that it has been very well managed as of now. Now, talking about the promoter holding, remember that it is falling below 50%. It's falling to 44% if you count the QIP. And however, Kiran Mazumdar-Shaw did say that she's comfortable with that holding of around 44%. They will be raising additional funds via QIP. They've already raised it in June. They are confident about raising further funds via QIP. The $1 billion debt level is comfortable. They are confident about the EBITDA growing, and that should take care of the debt and the comfort level on the debt. Now, they will currently retain their holding in Syngene as well. Remember, they have been pairing off stakes since 2022, but as of now, they will keep the stake stable in Syngene.
Okay, all right. Thanks a lot for that, Ekta. Well, let's get a quick view from Deepan. Deepan, you want to weigh in on this one?
Yeah, Nigel, I think it's a very good development because, Biocon is a company worth watching. First, a disclosure, we and our clients are invested in it. It's got a very, I would say, very different type of a business model. Its manufacturing processes definitely give it a competitive edge. And I was always concerned about this holding company discount because Biocon Biologics is where the real action is. And now that they decide to merge it, I think it's very, very positive for minority shareholders of Biocon. And I think looking at this company in very positive light, maybe looking at very good numbers coming through as well, I think 2-3 quarters down the line, and a lot of opportunities opening up in the GLP, that is the weight loss, diabetes space for Biocon as well. So, and this acquisition also, I think, has got delayed. The benefits have got delayed, but will come through pretty much. So very positive on this company. And within the pharma space, I would rate Biocon among the top 3 or 4 companies from an investor's perspective to remain invested in.
Okay, all right. Thanks a lot, Deepan, for joining in, giving us that view. We noted your pure positive view on Biocon as we speak. But I think the market's a little bit jittery, and it's a good time to get you a check on the F&O basket. And I think the Nifty holding on to this 25,900 mark is extremely crucial. And the odds are that maybe, in fact, we do defend this mark. So 25,850, 25,900, extremely important. The reason I say that is the PCR has come down to the lower part of the range. We're currently at around 0.63 odd. That normally signals a near-term relief. So that's point number one, the technicals in favor of a bounce. The other factor is that the Nifty, though, has broken the 20 DMA. So you'll want that 25,900 mark to get defended. And maybe by the end of today, we closer to around the 20 DMA, which is going to be extremely important. And one of the key parameters will be if the Nifty Bank can defend the 20-year DMA. Remember, it went down to around that 59,030 odd mark. And from there, it's seen a bit of a bounce. So that 59,000 mark is very, very important for the Nifty Bank. Why has the PCR come down? Because call writing has become all too easy. 26,000 call, 26,100 call. Aggressive writing is what you're seeing. The PCR has crashed. The premium has crashed on both those two strikes, telling you that the bears believe that they have got it covered at higher levels. which explains why the PCR has come down. So I think the 25,900 mark needs to hold out. If that does hold out, then maybe in fact the cases of a bounce are rather high. Moving to stocks in focus, Interglobe Aviation, the total open risk built up is more than 30%. Fresh shots in the system out there. Hitachi Energy, one of those darlings that went from 3,000 to 23,000. Well, that's seen a lot of fresh build up. Fresh shots being sit on that one as well. And Keynes, that it appears the stock is under pressure because there's a combination cash-paid selling and there's some unwinding of long positions as well. So explains why that stock is under some pressure today at an extremely, extremely crucial juncture at this point of time.
Okay, we'll take a quick commercial break here. Nigel, thanks very much for those levels. We've been, of course, focusing on the market as we should be doing, but it's also our 26th birthday. And what we've done is invited a very special guest, a 26-year-old, to talk about markets. Samir Arora is going to be joining us on the other side in just a quick bit. Coming right back.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. Market 25,950 and it is painful looking screen. Broader market sinking, 5 down for every 1 up. Well, as promised, we on our 26th birthday have invited a 26-year-old young, vivacious, inimitable Samir Arora. Samir, great to have you with us here and thank you for being part of this journey all these years.
I'm sure I was there on day one also, but I don't remember. Please check.
No, we will check and we will then and now. We'll do a then and now. So, Samir, it's a bad-looking screen. I mean, you know, and I was just looking at this Fino Bank, right? There's got this RBI license. Stock is down 14%. It just, I mean, you know, you take that as an example of how bad it is.
You know, I had tweeted that on my birthday, the market went up a lot. And now we are talking about your birthday or your...
आपका birthday साल में 2 बार कर देंगे फिर अब. That is the effect.
So right now it looks like somebody is giving up on India in terms of selling. I guess I would call it indiscriminately because there is nothing new that is happening for, okay, that what you're showing is another example. But I'm saying in general, this looks more like dumping. Now many people say that some of the PMSs, which, you know, were exclusively or mostly into small cap stocks are shutting because they have been doing badly for 1 or 2 years or 2-3 years. Not sure what the story is. But in general, today doesn't look like a day from which you should draw a conclusion that somebody is seriously looking at it and has decided after the when the year is about to end that this is the time to sell. It looks like somebody walking out of frustration, being upset with whatever, and maybe wanting to buy some AI-related stock related to OpenAI. I hope he does that instead.
Samir,
and not Google-related.
Google. And everybody, basically, that's the problem, right? Everybody seems to be on one side, which is selling. Promoters, sponsors, corporates, foreign investors. And it is the SIP money which is keeping things afloat for now.
But SIP is also ultimately the same public's money. So you can't say public this side. And you know, all this thing about the promoter selling, we do see not literally directly the same guy who's selling today coming to us, but broadly we can see from the inflows into both PMS and mutual fund that these are the promoters who have sold, maybe not today, but in the last X number of months. Because they have set up family office or they've set up or they've got some advisors now. So that money keeps coming back and forth. It's not so blatantly just one way in that sense. But I think it's more end of year, somebody wanting to give up. Because this doesn't look like across the board everybody's decided today morning that when everything else is broadly okay, there's no extra incremental bad news that you have to hit literally every stock down 3-4%, 2-3% kind of thing. Therefore, I've seen this for too long. We have to give it a week or two, or if somebody thinks that they know something and we don't know, mostly that is not the case.
There is no hidden truth in that sense.
And particularly at a market level, you can say that for some stock that
correct.
Somebody has some information, but what do they have about the market?
Although, Samir, one thing I'll tell you, this growing feeling that we are kind of stuck, that nothing is moving. You know, RBI has cut, but you know, beyond that.
So all the things that we could have done, we means the government or the system could have done in terms of other than just directly buying stocks, they have done. And therefore, it may take some time to feed through, but these things are not wasted. You can't say that, oh, when they cut the rate that day, the market didn't go up, or the next 2 days, therefore what a waste. Now we need to do something more specifically for that. So if you've cut these 3, 4, 5 things, and in general, the market has corrected and the rest of the world is not falling apart. I still can't imagine that somebody is using money from India to fund an investment in some other market. Because the Indian market in general has done well over time. And this year it has massively underperformed. So it's very unreasonable to think that somebody is selling a market which has underperformed by 28-30%, which means broadly, and if they buy some moving stock in that other market, it is up more than 30% since their index is up 30%. So that means they're already giving a 50-60% or 40% spread in selling some Indian stock and buying some whatever they are doing with this money.
Yeah, but although in that during the course of that underperformance, maybe the underperformance may have been caused by that that India was used because it was very expensive. It was used as a funding market too. And this is a point which Neelkant was making a couple of weeks back, etc. Now, this SIP...
I don't think this funding business works. For just to give you the weight. So if you're a global fund manager, then India's weight in that will be plus minus, say, index weight, which might be less than 1%. Now, if you think that because obviously they're not making it zero. Because if you see in aggregate, they have sold till, I think 1 or 2 days ago, $17 billion year to date, in which January alone was 10 billion. That means from February to today, they have sold $7 billion on their own aggregate AUM of, say, 800 billion. So they have sold 1%. So what I mean is, if somebody's weight is 75 basis point and 1%, and you suddenly feel that you have to buy some other market, it's highly unlikely that you do it, that, okay, I will reduce this 10 basis points here and buy Korea with it. You can fund it if you so desire with the balance 99% that you have. So don't call it a funding market. Somebody doesn't like it. They have lost and they are out kind of thing. But hardly that suddenly 1 day later, 10 days. Funding means that 3 months later, they'll come back with that logic. I think people who are selling and people who are buying will buy. Not all the time is it a movement from one market to another.
Samir, hi, afternoon. Is there a reason to buy Indian markets? You know, we spoke about the underperformance versus rest of the emerging markets, 25, 30%, etc. But now looking ahead to 2026, do you think India plays...
There are many, many reasons to buy. First reason is to look at how good our market has been since March of this year. Since March of this year, the Indian market is up maybe 15-20%. Mid-cap stocks are up maybe 25%. If you look at it from October 1, Indian market has outperformed the United States even till right now, even including the US dollar. I mean, Indian market in dollars. You can see right now, you can show MSCI India from, say, September 30th, which means for the current quarter, and compare it to China, compare it to emerging market index, compare it to S&P 500, compare it to NASDAQ. India has outperformed. What I'm trying to say is that although on a yearly basis it looks bad, but if you look at it from, we are not saying look at first quarter, we are saying continuously from March 31st to today or March 15 to today, or you look at it from this quarter to date, which means it has changed a little bit. Now, if you look at it in absolute from an Indian investor point of view, that, oh my God, what he could have done on December 31, 2024, he couldn't have done something much different by buying something else. Because unless you say an Indian investor would have sold India and bought Korea, he would have, we are talking about, buying equity or buying debt. So even till right now, I can see the 500 index is up 5%. So it's bad, but it's not that he's bleeding to death. And if he had Nifty, it is up some 9.9%. It has more or less, the sad part is that other markets are doing very well. It is not so much that a correction in Indian equities is in line with what corrections happened when we used to have corrections, which is the market falling 10-20%. It is depressing in that sense that the other guys are doing well, but it is not so wildly bad that people should feel, oh my God, why did we ever think of equities?
Hi, Samir. Good afternoon and good to see you. An interesting point, right? So quarter four hasn't been so bad. We keep talking about India underperforming, but actually for quarter four, we're pretty much in line or maybe better than a few markets.
Outperforming, yes.
So that's good. And the sector actually that's outperformed even more has been the tech index, which has been an underperformer for the first 9 months of the year. So India's outperformance within the basket, actually tech has done well. How are you all feeling about tech? If I'm not mistaken, from the low that we saw towards September end, I think the tech index, the Nifty IT index is up close to around 17 to 18% or thereabouts. How are you all placed on
Maybe
Indian
about
tech companies?
17% because it is still down 14-15% year to date. No, sorry, 11%. Maybe it is. But no, we don't like Indian IT sector because we are thinking of the fact that all these guys, for example, Anthropics is about to do an IPO at a $350 billion valuation. And if you look at the interviews that those guys are giving, and I guess the US world is accepting it, because if they are really serious about a $350 billion valuation, that many of these jobs of Indian IT guys are gone. We have met IT staffing companies, and all these staffing companies, you can call these, there are only 2 listed companies, and ask them what they think of the demand of people in the Indian IT sector. Actually, if you look at it, that if you look at the GCCs, and if you see the growth in GCCs, that alone shows you how much, even without AI, the GCCs are effectively doing things which in theory could have been done by the Indian IT companies. So even ignore the impact of AI. The fact that the global companies are confident enough to set up GCCs in India and have now so many people there shows that some demand which theoretically could have gone to the IT guys has come here. So we are not buying IT. I'm talking in general. I will buy IT only when I can see that the either I over evaluated or whatever this thing, the impact of AI. I think the impact of AI is very big.
Yeah, no, negative. Yeah.
And big. Because you can see the other side. You can't have it both ways, that the Anthropic kind of guys will give AI to enterprises, and they will have X revenue, and they will be valued at equal or more than nearly our entire big IT companies. But the IT companies will not be affected. But McKinsey will be affected, and McKinsey will fire their consultants, but IT guys will not fire. So as I've said, actually I've said it a year and a half ago, I do not believe the Indian IT companies' managements. I have never believed them for the last 25 years. I've invested in them, but I don't believe in them. Believe in them sense that they tell the truth, that they come openly and tell what is the situation. They only talk quarter to quarter. If some company has got an order from a company whose market cap is 350 million and they are getting orders worth billions of dollars, I just don't like or believe all this.
You know, Samir, the basic way AI, like for example, right, DeepSeek launched this new model, which they say is 25 times cheaper than ChatGPT, and it is as good as GPT. Now, very tough to say where value will finally settle at. All this is fundraising, etc. But adoption will happen. And the way many people are thinking about adoption is not from only IT services companies' perspective, but for this constant refrain that India does not have strong foundational AI, and maybe that is the reason why money has not come, etc. But AI will lead to basically productivity improvement, which is margins going up at the cost of labor, at the expense of labor.
Correct.
That is the basic kind of at a broad level, right?
Because I get all my knowledge out of reading books. I read a book called The Engine That Moves Markets, and basically the logic there is that it is not easy to know who the winners are in anything. For example, suddenly from OpenAI and its cohort of partners from Oracle to SoftBank to even Microsoft, suddenly now the Google cohort and its partners are doing well, and suddenly OpenAI is under threat that Google is doing better. So what I'm saying is, it's according to that book, and there are some 100 examples in that which are enough for me, and even we can see it ourselves, that it is easier to know who the losers are than to know who the winners are.
Yeah.
And in any way we look at it, the losers are easy to see, that in big picture sense. The Indian IT, and particularly large Indian IT guys, are the losers. And now which fellow will get a better application, and which fellow will be able to use AI better, and who will be able to have a better model, that is more difficult. As of now, in front of us, it has moved from OpenAI to Google. And on the other side, Anthropic says that I have got so many enterprise customers. So it can't be both. No, that's what I'm trying to say. And if they are, we will learn with time. But I can't buy a stock only on the basis that We don't know about the revenue, but the rupee has weakened by 4%. That is a very boring way to buy a stock.
Samir, once again, happy 26th birthday.
Thank you very much. And same to you guys. And even if you flip it.
No. Arey, you are, I'm not joking, you are one of the, liveliest.
I am experienced, not old.
Correct. So absolutely. That I agree. And wise. Thank you very much, Samir, for joining us. And thank you for being with us on this special day. We'll take a quick commercial break here. We'll come back. With what's happening in the markets a little bit. Mitesh should be back with us. 20 minutes to go, less than 20 minutes to go for market close as well. I don't think there is any bounce afoot, maybe a little bit, right? So we're down about 200 points. The low was made at about, low actually was made at about 220 before 220. 25,920 was the low. And we're bounced about 60 points from.
A couple of those technical indicators moved, right, Prashant? Yeah. You had the PCR that moved to around 0.63 odd, and you had a lot of shorts in the system as well. So that was the near technical number, in fact, in terms of a bounce. And that's precisely what's happened as of now. And as I mentioned earlier, the bulls will like it if you end closer to the 20 DMA. It seems that could be the case, at least as of now. And the Nifty Bank's 20 DMA has got defended yet again. So keep an eye out on that. Nifty PCR towards the lower end of the range. The Nifty as well as the Nifty Bank look to be defending that 20 DMA as we speak. Slip into the break, come back, continue our focus on markets. We'll discuss a few stocks as well.
26 years of CNBC TV18.
Welcome back. A bit of a recovery is afoot. The Nifty is now at 25,950. And in this sea of red, a few stocks stand out. Rolex rings, 11% up move, very large volumes. Latent View, 9.5%. Ashoka Buildcon, whether it's that order win. Physics Wala, Grow. These are some stocks which are still managing to be resilient.
One more, Rima, Dredging Corp, I think, something's going on there. Volumes are very, very large in comparison to the averages. So just running a screener. And Dredging Corp as well as another stock that's moved to the high point of the day. It's up more than 10%, spiking up, more than 50 lakh shares getting traded, bursting away in this sort of a market. But let's get in Mitesh Thakkar from Bonanza Portfolio, who joins us on the show. Hi, Mitesh. Good afternoon. Some kind of recovery from the lows. What do you think? Is it getting a little stretched on the downside? A near-term relief rally is something that you would look for?
Not really, Nigel. I think, it's just that we are in a range and we are close to the lower end of the range. So some short covering could have happened. And I think you were rightly mentioning the PCR also, is coming into play. It's getting close to those levels from where typically markets tend to bounce back. And therefore, my belief is that this consolidation might extend for the next few days. So in that sense, I think, nothing much on the index. On the stock side, though, I think I have one VTST and one STVT. On the STVT side is Lodha Developers, with a stop at about 1,082, 82.5. And, I would look at a target of roughly around 1,055 to about 1,050 on the downside. And on the buying side, we've seen Indus Tower come off today after a good movement on Friday. But I think the support pivot is just right there. So try to buy it around 401 with a stop at about 398 and a target of 4067 can be looked at.
Thank you. You've been flagging off Indus Towers since morning. The stock is still down 3.5%. By the way, Starlink came out with its pricing for quite prohibitive. It's 8,600 is the pricing, and plus there will be some other costs associated with it. And analysts are pointing out that this is much more expensive than what the pricing is in other emerging markets like Bangladesh, Sri Lanka, etc. So I guess the takeaway is that there is no real threat to, say, a Bharti Airtel or a Vodafone Idea. But let's talk about Keynes Tech, because that stock continues to fall. Remember, brokerages had highlighted some governance concern, accounting issues. The management clarified. Upasana joins in to fill us in.
Well, certainly the stock continues to see a steep fall today as well, nearing its 52-week low. Now, mind you, last week, Kotak had flagged off some serious concerns in terms of its balance sheet and cash flow issues, and even questioning the company's revenue growth rate, excluding its smart meter business. Now, in response to that, the company held an analyst call today morning, and here are a few of the important takeaways. Now, company says that there are no inconsistencies. Most of the implications are not valid that the Kotak has given, and the Kotak's entire report is based on one small omission in notes to account, which is a related party disclosure, which will be duly corrected now. In terms of working capital, which was another concern raised by the brokerage, it says that the working capital intensity is very typical to EMS players, and company is going to take various measures to correct it and improve it further. Smart meter business contribution to overall sales is trending downwards, and other business verticals are showing strong growth momentum. Company's other verticals such as industrials, automotives, railway are seeing a strong growth rate, which is above the overall growth rate of the company. And company has guided that the going forward, reliance on company's smart meter business contribution will certainly come down. And in terms of promoter stake, the company has highlighted that they are not aware of any promoter selling its stake as of now. So overall, these were the fair details given by the company in its analyst call, and the stock certainly remains in focus today on the back of this.
Okay, all right, Upasana, thank you very much for that. We'll take a break. Gurmeet Chadha of Complete Circle Consultants on the other side. Stay tuned, coming up.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Putin's agenda for New Delhi. Parikshit.
Happy 26th birthday.
भी लगाएगी तू?
देखो है तो देखो.
Happy 26th birthday CNBC TV18 from the crown.
लाइन दिखाते रहना, वो इंडिगो का बोर्ड दिखाना, ठीक है?
Listen, I wanna be there with you no matter where you go. Life is a table for two and we're starting the show. I'm gonna spread my wings and fly so high up above the clouds.
It was simple.
Well, of course, we're celebrating 26 years here at CNBC TV18, and would have been nice if the market looked a little better, I guess, on a day like today. But, well, it is what it is, right? And across the board, I mean, once again, there is a re-acceleration down. There was a bit of a bounce, which we saw. We were, but it's gone south once again. So 245 points, 25,940 is where we're at. Once again, coming back to, we're about 45 points off the day's low, which was made at about 218 or so. Any thoughts, Mitesh? Let me ask you this Fino Bank. I don't know if you've ever looked at the stock, but it's a cash stock, a fair bit of trading history. Good news, stock goes south, price action wise. So what do you do with something like this?
So I don't track it regularly, Prashant, but yeah, I think today it just come in the scanner of stocks with good amount of decline. See, the 200-day average, which is where the last time the stock had bounced back, was around this 264, 265 levels. And I think, it might hit those levels again. Right now it's at 265. But in case it breaks below this 265 odd zone, then I think it's heading towards 248, 245 as a minimum, and worst case scenario, even possibly 230.
Okay, all right. By the way, just pull up a few stocks actually. We're seeing a few stocks that are moving higher and they're moving well. In a market that only 470 stocks that are advancing. Latent view, I think Remat spotted that earlier. That one has spiked up big time. You pull up Shriram Pistons as well. That's the other one. I think Sunil Singhania, Abacus, they hold that stock and they've been quite bullish from very early levels itself. That as well is up close to around 10%. So big move is what we're seeing on that one. Dredging is another stock that's now up close to around 17%. We were spotting that as well. Pull up Latent View as well. So a big uptake is what we're seeing on that particular name. I think Home First, Prashant already viewed. And RPG Life, another stock. So there are select stocks actually that are doing pretty well in an otherwise dull-looking market. Yeah, 10%. But I think that, from the word go itself was up because of that buyback news that came at around, 9 a.m. or thereabouts. So that one has continued to hold on to gain. So it's a tricky market. You have a lot of selling pressure on a whole host of names. The breadth of the market is negative as well. But a few of these names, they're brightening up the day a little bit. That said, let's wind down the markets today. We go on with the cut-off around 250 points. The Nifty Bank as well goes on with the cut-off around 620 points or thereabouts. The positive news is at least the Nifty Bank defended the 20 DMA. While the Nifty wasn't so lucky, that in fact ended with, below that 20 DMA. Stocks that lost out today, BEL came with some profit taking, down 5%. Interglobe Aviation, that was a casualty, down close to around 8%. And JSW Steel, after doing well last week, well, that came in for profit taking. That as well down close to around 4%. And they were selling across the board. Eternal was down, Geo Financial was down, Shriram Finance, all of them down 2.5% or thereabouts. The lone gainer on the Nifty, actually, with a gain of more than 1%, was Tech Mahindra, and add to the list, Wipro as well. From the broader markets, few stocks that did well. You had Dredging that was up. You had Rolex Rings that was up more than 10%. Latent View as well, up close to around 11%. And Matrimony up close to around 10%. But there were very, very few winners from the broader markets, with only 450 stocks advancing, while 2,500 stocks were declining.
For Interglobe Aviation, the fall is the most since February of 2022, and the market cap is now below 2 lakh crore. It's the 7th consecutive day of decline for Interglobe Aviation. Fino Payments Bank, 12.5% down. You had softness coming through in PG Electroplast. Keynes took a big knock, and even Biocon. The street, even after the announcement of the company making Biocon Biologics a wholly owned subsidiary for $5.5 billion, Biocon ended down nearly about 3%. We wrap up the day?
We wrap up the day, and I think many people will be saying, thank God, right? Because it just looked very, very bad. 25,934 is the final close. I mean, I think the adjusted close perhaps in a couple of minutes from now, but otherwise it's looking pretty bad to kick off this week. Well, it's a wrap on this edition of Closing Bell. Thank you very much for staying with us here on this show, but programming will continue on the other side in just a bit from now.
"26 years of CNBC TV18. 26 years of CNBC TV18.
26 years ago, CNBC TV18 went live and India's markets were a completely different universe. Even as we complain about how this has been a tough year, why not take you back 26 years to tell you the shape, size, structure and returns over this incredible period. Let's take a look at the massive reset which just played out. Let's look at the size of the market itself to begin with. From under 5 lakh crores when CNBC TV18 started to now over 470 lakh crore rupees in market capitalization. It's been a 100-bagger over the last 26 years. The number of companies listed has also grown nearly 5 times in this period, as you can see up on your screen. A look at the growth in trading activity in cash markets, stunning. I mean, from about 1650 crores to about 1 lakh crore in terms of daily turnover. Perhaps the biggest structural change, the financialization of India. Mutual funds share in household savings has gone up. I mean, I found data for 2011-12 used to be about 0.9% to about 6% today. And of course, many believe that we're just about starting. From barely 20 lakh demat accounts in 1999 to more than 14 crore today. From almost no SIP culture, which is now the bedrock of all the money which is coming into the market. I mean, regularly 20,000 crores every month. This is a market no longer owned by institutions, at least only by institutions. It's a market owned by India's households. Let's go back to the Nifty 50. I mean, the OG before the Y2K hit, right? 50 names that told the story of old India. And the names, I don't know how many of those names you recognize. I mean, Oriental Bank of Commerce was there in the Nifty. There was IDBI Bank in the Nifty and so many others. I mean, PSUs, lots of refiners, etc., etc. And that has changed. IT, private banks beginning to rise. Old-timers, of course, would recognize some of the logos up there. Cut to today, only 17 survivors on the benchmark. Basically, out of the 50 in 99, only 17 are there in the Nifty 50. And Reliance and others on your screen now. Let's take a look at the average. What did the average mid-cap, small-cap, large-cap look like in 99 and what it looks like now? What I've done is taken the current definitions of large, mid and small for comparison's sake. Top 100 is large, next 150 is mid, and everything 250 first onwards is small. In 99, the top 100 companies made up 87% of total NSE. Today, that number is 60%. The largest stock used to be HUL with a market cap of 50,000 crores. Reliance, of course, 3-month ended average market cap November is 19.5 lakh crores. For Reliance. Mid-caps make 20% of NSE now, while back then they were about 9% of the NSE. The largest mid-cap used to be Gujarat Gas, 800 crore market cap. The largest mid-cap today is 125 times that by current definition. DRL worth 1 lakh crore in market capitalization. Small caps now make up 20% of the NSE today. Guess what they were? 4% back. With the largest small cap being Foseco India, 150 crores in market capitalization. Today, ACC with 35,000 crores in market cap is the largest small cap. Markets ultimately follow earnings, and India's earnings story tells you why maybe this bull market has legs. And I've just divided this into phases. Between F505 and F510, EPS grew 11%. CAGR. Then came almost like a lost decade. F510 to F515, just 3% earnings growth. And of course, I mean, followed by about 6% from F515 to F520. And of course, I mean, COVID hit 20 to 25. We've seen a CAGR of about 20%. This is the strongest earnings phase we've had in about 2 decades or so. I will end with, of course, asset class return stable over the long term. As you will see, equities have delivered. The Nifty has compounded at about 12% for 26 years. It's beaten gold, beaten bonds, and every other traditional asset class. So that's the last 26 years. Joining me now to talk about the next 26. My job was easy. I just had to document, but I mean, their job is going to be slightly tougher. Madhu Khela, Nilesh Shah, and Navneet Munot. Gentlemen, great to have all of you here. And thank you very much for being part of the CNBC TV18 journey. I want to especially thank all of you. I was saying this earlier, viewers turn to us for advice, and of course, we turn to you. And you always oblige, so thank you.
Thank you. Many congratulations to CNBC family.
Thanks very much, Navneet.
Congratulations, Prashant, again to all of you. What a splendid job you guys have done to bring so much awareness and attract so many retail investors to be part of this journey. Yeah. And I hope this continues for the next 26 years.
And you know, we kind of sometimes quibble and complain, but sometimes history helps, right? Historical facts kind of help to calm the mind that equities, as I said, have done well over a very long period of time, even if, I mean, it's been a tough year so far in 2025. So just wanted your reflections first up, you know, and your one or two learnings, if I can start with that, and then we'll look ahead in terms of what the market may look like. Nilesh bhai, why don't I start with you?
So, 26 years ago, we were far more circumspect, and we were always looking east or west to figure out what will happen in India. The FPI activity was tracked very seriously. Their word was taken as gospel. Today, a lot of things have changed. We are far more confident. We do track east and west, but our markets are driven far more by domestic flows. The fear of FPI has gone. The confidence has come back. And hopefully, over next 26 years, this journey will just continue to expand. People will move from short-term to long-term, from speculation to investment, and indeed create their financial security.
You think the flows are here to stay? Local, I mean, I mentioned some of the numbers. Shift of household savings into financial assets like equities. Do you think it's just starting? How do you think about it? Nilesh bhai?
Yes, sorry. So, प्रशांत भाई मतलब एक शेयर ढूंढने की कोशिश कर रहा था, कुछ इस तरह है कि मेरी ख्वाहिशें कुछ ऐसी निकली, but जितनी निकली कम निकली. Obviously, it's far better. But the reality is that when we look back, we all feel proud. 5 crore investors, 80 lakh crore AUM, real return to the investors. Urban, semi-urban, rural, upper class, middle class, lower class, everywhere we are there. And we legitimately think mutual funds sahi hai. But when I look at the potential, we have barely scratched the surface. Despite the excess, have I reached to the common man? The total investment in mutual fund will be about 25 to 30 lakh crore. Rest is mark-to-market gain. This is less than the currency notes in circulation. I am unable to convince an average Indian that currency notes will not give you return. Your financial security will come by investing appropriately. That journey of converting an average Indian from a good saver to good investor, we have taken few steps, but अरमा बहुत आगे है, ख्वाहिश बहुत दूर है.
और अभी तो शुरुआत है.
And ये तो शुरुआत है.
Madhu bhai, tell us a little bit about it.
So, one of the biggest reflections, Prashant, if I look back my own journey or journey of capital market even 26 years back, are the real possibilities in financial markets. As Rakesh Bhaiya used to say, highs are much higher than what we can imagine in the markets. At least I would have not been able to emphasize that the market cap as a whole will go up 150x in matter of 26 years. And there will be companies which will go up like 100x, 200x, 500x, even 1000x in this time frame. So I think if you just step back and if you think that those are the possibilities which are there. So the mood question today is, are we done? Are those possibilities still exist for the next 26 years? I would say with conviction that those possibilities very much exist. Otherwise, what happens, and we are seeing that, what is happening in America, only on the AI field in the last 5 years is kind of demonstrating कि market कभी बूढ़े नहीं होते हैं. लोग बूढ़े हो जाते हैं, but markets कभी बूढ़े नहीं होते हैं. And those opportunities and possibilities exist. So one of the key lessons, at least for me, is when I look back, when I look for the next 26 years, is to really be able to capture the possibilities in the market. Right? You catch the right industry, which has got tremendous tailwinds. And within that, if you're lucky, if you can get the best entrepreneur, you're done.
Yeah.
Then you just have to sit tight.
You've given that example of internet as being the big wave and how much wealth that's created. And if you were positioned somewhere there in the right companies, I mean, you've made a tremendous
You
amount
made
of wealth.
tremendous clear. And the other thing which I would say, Prashant, is that, from a India perspective, let's say a lot of re-rating has happened. So if I may say that lazy investing, कि अपने पैसा डाल दिया और बढ़ जाएगा, maybe that era, according to me, is over. Now it is time to really work hard. You have to be able to bet on companies or sectors where there is real earning growth, because that is what will get rewarded. You are seeing already in last 18 months, if you are a lazy investor, you have been actually been punished.
Easy discovery part is...
Yeah, actually been punished.
Yeah.
In last 18 months, a lot of portfolios are down. So while India's story, India is happening, but it is not that you just put money and your money will be made. Last 5 years, post-COVID, that was the scenario. If you just invested in the market, you made money.
Correct.
But now is the time we have to be able to bet on right companies, right. And the third point which I would like to put, I travel a lot. The real thing, Prashant, which is happening in India is entrepreneurship. I see, come from a small place like Raipur. I was just telling, there are 5 companies which will be making more than 1,000 crore profit in a place like Raipur. And we have companies with 25,000 crore market cap, 1 company each. So the real entrepreneurship is actually happening. So the opportunities are really phenomenal, and they are happening in
And
tier
for
2,
viewers
tier
who are
3.
watching, all that will be captured in public markets eventually.
It will get, it is getting captured. The fact that, every day there one new company is getting listed, and there is so much fancy about these new companies listing, a lot of it is coming.
And the coming of age of venture capital and private equity industry will also play a very big role in increasing that momentum. Now you have, like, as he talked about, like a lot of companies in a small town or in variety of sectors which are small today. There are private equity and venture capital guys investing today, and over a period of time, we have a beautiful public market where several of them will see a listing.
Just to take off Madhubhai's point, Navneet, in terms of what he said, right? Easy discoveries happen. And I think that discovery, and also, by the way, not just easy valuations have been, I mean, everything is priced in a way because there's so much money which has come in. So the investable universe has been discovered, discovered 2x, 3x. So, it's kind of gone up. So,
Can I counter that before you complete that?
Please.
So you showed a lot of those companies, and you go back in every bull market. Actually, 99 was a roaring bull market, and we saw a big crash in 2000. Market was sideways for next 3 years. We saw a big crash in 2008, 2013, 2020. Even if you invested in the right companies, at the peak of the market, several of them have multiplied money many times. So in late 90s, as I said, when you started, at the peak of the market, there are so many companies in the Nifty which have multiplied money over a period of time. India is a stock picker's paradise. I think what you need to keep a close eye is on finding the right business, right management.
So which means, does it have any implications for viewers who are watching in terms of how do you own India? You own the Nifty. I mean, is there any...
That's one of the ways, but if you look at the funds...
But as he's saying, that maybe you got to be more... I mean, I think what I'm taking away is you got to be more active. You got to be more...
No, not active. You have to be alert. What I'm saying you is that in the last 12, 18 months, and these guys, they manage multiple billions of dollars, so they will vouch even better. That just saying that I have invested is not making money. To be able to pick the right sector, within that to be able to pick the right companies is what is making money.
And that's why several funds have multiplied much more than what Nifty has multiplied.
Exactly.
And that's the reason. You talked about some of the names which don't exist, avoiding them, and there are many who have done very well.
You're quiet.
See, investor has a choice. There is a public transport bus available. There is a chauffeur-driven Mercedes available. It's up to them which they want to choose. If you use public transport bus like a Nifty index, yes, it will also reach the destination, maybe little late. The cost is little less. But if you want an experience, there is active fund management available. And हम लोग कितना charge करते हैं? 25 paisa, 30 paisa, 50 paisa, 75 paisa.
Yeah.
Including distributors, advisory fees and commission, it is 1.5, 1.75.
Or a chauffeur-driven car.
Or a chauffeur-driven Mercedes, not a normal car. Luxury.
Yeah.
And we have seen in last 26 years when markets have gone X, funds have gone 2X, 5X, 10X, 20X. Choice is yours. But at least please sit in the car so that you reach your destination. You need to be financially secured. Our parents' generation, we were their retirement solution. We may think we have done a good job. Their opinion could be different. But why should you become a liability on your kids? please secure your financial freedom. Whether you choose index fund, whether you choose active fund, your choice. But please sit in the...
1 minute, I just want to make one point again, learning out of 26 years. And I was just looking at data. Fixed income actually has given you 6.5% CAGR in last 26 years. Equities reinvested by dividend has given you 14.5%, right? If you reinvested the dividend. So this thing which is put in our head, that fixed income is the biggest security, to my mind is the biggest myth. Fixed income is not proven to be a fixed security. Bank deposits have not proven to be a security. Because see, if you have not been able to even beat inflation, what are we talking about? You have actually lost money by keeping money in the bank, in real sense.
Yep.
On the face of it, it may look like it is being safe. But if you look at what is see, there are two kinds of losses you make, Prashant. One is the financial loss, which is very easy to compute. The bigger loss, which is hidden, is the opportunity loss. What I'm trying to say, people have not realized what kind of opportunity they missed by saying that yes, because we have invested in bank deposit, we are safe. You calculate yourself. What would have happened if you invested 1 lakh rupee in equity 25 years back and you invested 1 lakh rupee in fixed income? It would have made difference of crores and crores of rupees.
Absolutely.
And it's an important point because life expenses, expectancy and expectations are increasing. And that's why you need to save more and save longer for...
Although I would say Nilesh Bhai will say that when he was managing the fixed income business, he beat equities. Huh?
But that was different time. That was 16%. In 2000, repo rate was 16%. And you were getting interest of maybe in peak of 2000, repo rate was 16%. At that time, if your inflation was 6-7%, you're still making 17% in fixed income. That was great time to invest in fixed income. But now the pendulum has reversed.
I switched at the right time.
Exactly. As always.
I want to get to...
As always. He always at the right time.
26 years of CNBC TV18. "26 years of CNBC TV18.
This multi-asset funds, right? You think they make more and more sense? It's been a year where multi-asset has done very well. Although Madhubhai is saying that maybe multi-asset, I don't know if what you said...
I am saying, Prashant, the multi-asset will do well, but you will need to be alert. I am just saying, don't be a lazy investor. That's all I am saying.
I want your perspective. For viewers who are watching in an actionable way, I mean, pure equity versus a multi-asset kind of a product, from here on, what's your sense?
So it all depends upon your risk-return profile and your investment objective. If you can do allocation on your own, then you can choose between equity, debt and precious metal on your own. If you don't want to do asset allocation, then give that responsibility to the fund manager. They will decide between debt, equity and precious metal. Now, last year, precious metal has done exceptionally well, and which is why multi-asset allocation funds have outperformed equity. But that's not the reason to invest. You are investing because you believe fund manager will do a better job in terms of asset allocation.
I just feel awareness about these kind of multi-asset kind of funds have also really taken off in the last 2 years, 2.5, 3 years or so, right?
Whenever performance comes, awareness goes up. We want the other way around.
Navneet?
No, the last thing one should chase is like the recent
the
performance
recent fad or
of
whatever.
any sector or theme or particular asset class. And that's why we always advise investors to have a proper asset allocation in place. It's very important.
Whether you do it yourself or you hand it over to the
fund manager. And we have the best products in the industry. As an industry, we have come out with many hybrid funds, many asset allocation products where investors can put money in the one fund and get all the asset classes exposure.
Let's talk about themes as we look forward. I'm not asking for specifics, but big themes. Where, I mean, this is the set you should focus on.
Yeah. Prashant, I will only talk about one thing. We are talking about 25 years, right?
Not necessarily 25.
But I'm saying 25 years. We are talking about a larger context. Correct. What can really change?
Correct.
So I think then let me make a distinction. When I talk about AI, I'm not talking about investing in AI companies. I'm actually bearish on a lot of the American AI companies because I feel in the short term there is a clear bubble out there. You know, in the long run they may still do well, but in the short term I clearly see a bubble. But AI usage is going to transform many companies, many industries, many entrepreneurs. So if we can really identify companies where AI usage is going to either scale up their business or going to bring in efficiency, I think that's a real game changer. So on one hand, if you have pricing power, which you don't have to actually pass on to consumer, and let's not fool ourselves that it is available to whole world. Yes, everything is available to the whole world, but there will be people who will be early adopters. There will be people who will move in early and they will encash on this opportunity over the next 3-5 years. And I'm really, really bullish. We are actually working on this theme that wherever, and this is where you will get real multipliers. So this is one thing, AI usage.
But the way it will translate is basically productivity goes up, margins improve and
and also the scale goes up. Because of the AI usage, also the scale goes up.
Sure. Any sector in particular?
It happened in the internet boom in 90s. The world invested in fiber and internet capacity, but India was the biggest beneficiary. Several of the companies benefited so much from the internet, apart from the IT services companies, and now you are seeing a new set of companies which are building on the digital public infrastructure and ubiquitous broadband.
But just to narrow that point,
we have financial stocks. For instance, detecting fraud was such a big issue for last 25 years in the financial companies. Now you see all the major banks are actually starting to use AI to detect fraud because these are same patterns which gets followed up, right? So maybe financial stocks come, and there will be companies which will still go back and say, "Theek hai, dekhte hain, karte hain," and there will be companies which will be very aggressive. And you are seeing what is happening in AI usage in China. So it is not like we are living in some other world. If you just see what has happened in China and just watch companies which are aggressively adopting those usage only in financial sector, I think there's a lot of money to be made.
You can kind of make that case here. Nilesh bhai, big theme.
So apart from what Madhubhai said, companies which will leverage technology to deliver cheaper, better and faster solutions to their customer, and they'll have to be better than their peers. But the real theme over last 26 years we have seen is betting upon entrepreneurs. Technology was available to every single IT company. Few were winners, many were losers. Similarly, in banking and financial services, licenses were given to many players. Few created history, few became history. So it's all about entrepreneurs. And apart from many other things, the crucial thing will be governance. Last 26 years, we have seen entrepreneurs who didn't follow the dharma of governance have failed to create sustainable value for investors. And the narrative of governance is changing. What was right yesterday is not appropriate today, and you need to go one step further. So focus on entrepreneurship, but entrepreneurs who are following the dharma of governance.
Well put.
Beautifully, beautiful. I think.
I think companies with a growth mindset and having the nimbleness and agility to make the most of the macro opportunity and the tailwinds that we have for the next 25 years will do very well. I think there are opportunities in resurgence of manufacturing in India, indigenation in many sectors, and also where the consumer wallet will go. This will go more on caring, compounding, and convenience. These are the three places, and you can see where the consumers are going to put their money. And I think many sectors, many companies will be big beneficiaries of that.
Of this trend. You know, I have, we can go on and it's a wonderful chat to have all of you here, but, the tyranny of time on television. Thank you very much, Navneet, Nilesh Bhai and Madhu Bhai for dropping by. Thank you for being a part of our journey over the last 26 years and look forward to the next 26.
Thank you for having us and congratulations once again on all the best. Prashant.
Thank you for tolerating us for 26 years, passing the same message, be a long-term investor.
Thank you very much.
Thank you so much.
Thank you. Well, that's it. We slip into a quick commercial break. More comes up on the other side.
"26 years of CNBC TV18. "26 years of CNBC TV18.
Putin's agenda for New Delhi. Parikshit.
Keep chasing the sunshine and go out and play.
Happy 26th birthday.
भी लगाएगी तू देखो है तो देखो Happy 26th birthday CNBC TV18 from the crown
लाइन दिखाते रहना वो इंडिगो का बोर्ड दिखाना ठीक है
Listen, I wanna be there with you no matter where you go. Life is a table for two, and we're starting the show. I'm gonna spread my wings and fly so high up above the clouds. It was simple.
CNBC TV18 turns 26 today. On this day, we would like to thank all of our viewers for your continued trust and support. I am Arundhati Ramnan, and these are the headlines we're tracking this evening. A sharp sell-off on the Lal Street. Sensex loses over 600 points. Nifty drops below 26,000. All sectoral indices end in the red. More than 7 lakh crore rupees in investor wealth wiped out today. Indigo is the top loser on the Nifty as flight disruptions continue. Over 500 flights cancelled across India. The airline's management faces government scrutiny and faces a 6 p.m. deadline to reply to a show cause notice from the aviation regulator. Civil Aviation Minister Ram Mohan Naidu promises strict action against Indigo in Parliament, says the airline did not flag any issues before the mass cancellation of flights, blames internal complications at Indigo after the new crew rostering rules. Pharma major Biocon announces the merger of its biologics unit, valuing it at $5.5 billion. Kiran Mazumdar-Shaw says the deal will boost supply chain synergies and allow value unlocking. That's an exclusive. 2026 will be the year of the Pulsar and expect several launches, says Rajiv Bajaj. Tata Motors likely to hike prices in the new year, says the CEO of passenger vehicles, Shailesh Chandra, citing the rise in commodity prices. That's another exclusive. U.S. trade delegation expected to visit India on the 10th of December to hold negotiations for 3 days. Another delegation from the European Union is slated to meet Commerce Minister Piyush Goyal as trade negotiations gather pace. Thailand launches airstrikes along the Cambodia border, suspends the implementation of a peace deal brokered by the United States in October. Both nations trade blame for the clashes that killed 1 Thai soldier and 4 Cambodian civilians in what has been a fresh escalation in a decade-old conflict. Starlink will offer satellite internet services in India at a cost of 8,600 rupees per month and a one-time hardware cost of 34,000 rupees. The monthly subscription cost is nearly 3 times higher than that of Bangladesh. Those were the headlines that we're tracking for you this evening, but let's start with the day's market action. An all-round fall across the Lal Street dragged the Nifty below the 26,000 mark. Broader markets witnessed major pain, with the midcap index recording its biggest fall in 4 months. 46 out of 50 stocks closing in the red. Prashant Nair joins us now with all of the day's market action. Prashant, it's red across the screen.
A really bad day, and markets, of course, just sinking after what looked like a pretty steady kind of session. I mean, it was not as if you woke up to a bad Wall Street or bad Asian screen. I mean, actually, if anything, the S&P is only about 0.5% from an all-time high, and Asia was not too bad either. But here in India, just terrible. And the breadth of the market, almost 5 stocks down for every one up. Nifty selling off, Nifty Bank down. The Nifty, of course, under the 20-day moving average. The Nifty Bank bouncing off from there. So it was bad. And look at the mid and small cap indices. Mid cap index down about 2%, small cap index down about 2.6%. So that really told you what went on. If you're wondering, I mean, was there an underlying thread, one pointed reason which could kind of neatly explain what happened? I don't think there was one. Just, this feeling that something needs to happen, especially with regards to things like, I mean, the India-US trade deal. There is one other element, which is that just with 17 more days to go, trading sessions to go for the close of the year, I mean, interest levels, volumes, participation, etc., will start to wind down. It will look lower and lower. So keep that in mind as you approach things. Now, Indigo, I'll just look at the Nifty first. Indigo was down sharply, 9%. We know reasons why. BEL, that is Bharat Electronics, was down 5%. JSW Steel was down 4%. Shriram Finance, Nestle were the other stocks which were down about 2.5% each. Just 4 or 5 names which ended the day higher. And it was basically a bunch of tech names, Techem, Wipro, HCLTech, and Reliance, which managed a absolutely flat kind of close. As I said, the real damage, of course, in the broader space, Keynes down 12%. So now you're basically looking at almost, near 50% cut from the start of the year on Keynes. Fino Payment Bank, I mean, tough to explain. They got a license from the RBI. Stock goes south, 12% lower. Excelsoft, recent listing, big volumes, 4%. Spark was down. HCC, 7%. SW Solar down 8%. Honasa was down 7%. So many names which kind of sold off aggressively on, and at least the one that I mentioned had volumes in it as well. On the upside, I mean, the Latent View was the #1 volume-led gainer, 13% pop here. Shriram Piston, second day running, 10% on this one. Dredging Corp was up 17%. Rolex Rings, 18% gains here. Dynamatic Technologies, 7.5%. Cupid was up 4%. Home First, Niva Bupa, I mean, the other 2-3% kind of movers. Matrimony was up about 11% as well. So it kind of really stood out in a market which otherwise was pretty dull and poor as far as overall breadth goes. Back to you.
So all-round fall there on the last seat. Many thanks for those details, Prashant. Now, in the money market, the rupee remains above the 90 mark against the dollar. The rupee weakened by 9 paise against the greenback today. Bond prices declined in trade today, and the 10-year yield shot up above 6.5%. Pharma major Biocon will fully integrate Biocon Biologics as its wholly owned subsidiary. The company will acquire remaining stake in Biocon Biologics via share swap, valuing it at $5.5 billion. The company announced that it will be issuing shares to shareholders of Biocon Biologics at a price of 405.6 rupees per share. This is a 3.3% premium to Biocon's closing price last Friday. Speaking exclusively to CNBC TV18, Kiran Mazumdar-Shaw, executive chairperson of Biocon, has said that this merger will see synergies including supply chain procurement. Take a look.
Because we will be throwing off free cash flow now going forward, given the fact that we've retired all the structured equity debts, which will of course throw up another 300 crores next fiscal, and the fact that we are now pursuing this route of merger, where a lot of the minority interest calculations and the kind of related party transactions will also free up more profits, I think puts us in a very strong position.
The Indigo stock was the top loser on the Nifty today. Flight disruptions continue with around 500 flights cancelled today. The airline's management is facing government scrutiny after sparking chaos at airports and leaving thousands of passengers stranded. Indigo has time until 6 p.m. to respond to a show cause notice issued by the aviation regulator DGCA. The Union Aviation Minister Ram Mohan Naidu addressed the situation in Parliament today. He said the government will set an example for every airline. According to the minister, the airline did not flag any issues before the mass cancellation of flights.
What honorable member has also observed, we are talking about December 3rd, after 1 month. So there was 1 full month of operations in the new FDTL also. Why I am mentioning this point, even though we are saying because of the FDTL this situation has arisen, there have been a lot of internal complications. This is a day-to-day operations thing that the Indigo should have maintained. Indigo was supposed to manage the crew, was supposed to manage the roster through its day-to-day operations. We are there to check if the FDTL is properly implemented or not, and there has been no compromise on that side. And for 1 thorough full month, we have been observing. On 1st of December, we had a meeting with Indigo on FDTL itself. When they required some clarifications, we have given the clarifications also with that idea, and they have not flagged this issue. So everything was running normal till then. Suddenly, we have observed this on 3rd. Immediately, when this was observed, the ministry came into the picture. We are not taking this situation easily. We are doing an inquiry, and we will take very, very strict action, not only for this situation, but also as an example We will set an example for all the airlines. If there is any miscompliance, any non-compliance or non-adherence for any single person, any entity or any organization or any operator functioning in this civil aviation, we will take very, very strict action so that we set an example in the industry.
Madhiya Mujawar joins us now with more details. Madhiya, take us through the impact on Indigo.
Well, the impact is huge because Indigo, remember, is India's largest airline, controlling 65% market share. So we can only imagine the kind of control they have on Indian aviation. It operates over 2,200 flights every day. And since December 2, Indigo has cancelled nearly 6,000 flights. That number could even be higher, hitting close to 9 lakh passengers, many of whom were left stranded across major airports. Some missed their job interviews, funerals, some missed their own weddings, and many did not have the money to book flights on other airlines due to the exorbitant rates. It is a crisis that India has never seen before. Indigo CEO and the COO have been given time till 6 p.m. today, not much time left by the DGCA to give a complete comprehensive response on their failure to ensure reliable operations. They failed to ensure that the operations were not disrupted. The airline is slowly pulling itself out of a crisis that has shaken the entire aviation ecosystem, as we have been seeing on social media. It claimed to have operated 1650 flights yesterday and plans to operate over 1800 flights today of the 2200. The Indigo board has set up a crisis management group to bring operations back to normal. As per the Aviation Ministry's latest data, Indigo has processed refunds worth 827 crores between 21st November to 7th December and returned 4,500 of the 9,000 luggage bags to passengers so far. But that's very little considering the scale of impact this has had. Indigo has been the only airline, remember, that is profitable in India and has been expanding rapidly. It would have never anticipated this kind of crisis. The stock is down nearly 15% since the crisis began, and the airline has lost over 37,000 crores in market cap since the 27th of November. So operations may be improving, but accountability questions and the regulatory consequences are far from over for Indigo.
Absolutely, Madhiya. Many thanks for taking us through those details. Now, the crisis at Indigo has brought the new crew rostering norms under the radar, officially known as the flight duty times limitations. The rules are laid out by the DGCA to ensure adequate rest for pilots in the crew and prevent fatigue-related safety issues. But how are the norms placed when compared to United States and Europe? Shivani Bazaz gets us a comparative analysis.
Well, yes, India's new pilot duty time rules, the FDTL norms, are at the center of the debate regarding the Indigo disruptions, with pilots calling them essential for safety and airlines saying they're too restrictive. So where does India stand globally? Let's take a look at that. To begin with, India is now among the strictest on weekly rest. Pilots here get 48 hours off every week according to the new norms, compared to 30 hours in the US and 36 hours in the Europe. India also uses a wider night flying window. Night duty runs from midnight 12 a.m. To 6 a.m. in the morning. In the US and Europe, it starts later from 2 a.m. So India builds in more protection during the low alertness hours. Night duty limits follow the same pattern. India caps night duty at 10 hours, Europe allows 11 to 12 hours, and US ranges between 9 and 11 hours. So that is where India stands in the night duty. Where India is the toughest is the night landings. Pilots can do only 2 night landings in a week and not more than 2 night duties in a row. The US and Europe don't have separate caps here at all. But in the daytime, India is broadly aligned with global practices, allowing 11 to 13 hours of duty, similar to Europe and just slightly lower than US, which allows 14 hours of daytime duty. So the biggest difference is structural. India follows fixed prescriptive limits on number of hours, number of landings, while the US, Europe and even in Canada, they allow airlines to use scientific fatigue risk models for more flexible scheduling. Overall, India is among the strictest globally for night operations and rest, even as daytime limits stay in line with the international standards. Back to you.
Right, Shivani, many thanks for those details, but it is time for us to head into a short break. Coming up, Starlink will offer satellite internet services in India at a cost of 8,600 rupees per month and a one-time hardware cost of 34,000 rupees. Details when we come back. Stay tuned.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. You're still with us on Business 360. Elon Musk's Starlink will offer satellite internet services in India at a cost of 8,600 rupees per month. The hardware required for the service will cost 34,000 rupees. The monthly subscription cost is nearly 3 times higher than that in Bangladesh. Rachna Dhanrajani has more on this. Rachna, how do these rates compare to the other markets that Starlink is in?
Starlink has inched a step closer to its India launch, and today we're getting a first real look at what it may cost Indian users. The company has quietly updated its website with residential pricing that's at 8,600 rupees a month, plus a one-time hardware fee of 34,000 rupees. But what's drawing immediate attention is how sharply this compares with the rest of the world. In markets like Brazil, the Philippines and Nigeria, Starlink's monthly tariff is far lower. But let's look at our neighbors. In Sri Lanka, it's roughly half of the Indian rate. And in Bangladesh, it's nearly a third. This makes India one of Starlink's most expensive consumer markets yet. And remember, this is before adding the terminal cost. And even so, the service isn't live here. India remains waitlisted as the company is still navigating the last set of regulatory and spectrum approvals. But on the ground, preparations are clearly underway. Licenses have been secured, trials have been authorized, and multiple gateway stations are being planned to meet India's data localization rules. Starlink's pitch is not toward India's crowded cities, so we may not see it in Mumbai, Delhi, or Bengaluru. Elon Musk has been clear about that one bit specifically. He is targeting the vast rural and remote parts of the country where conventional broadband is patchy at best. So while the pricing is raising eyebrows, the bigger question now is whether this high-orbit, high-cost service can still find strong demand in the regions it aims to serve.
All right, Rachna, thank you so much for taking us through those details. But with that, it is a wrap on this special broadcast. Many thanks for watching.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Good time to welcome in, a market expert, market veteran as well, Manish Chokhani, Director at Inam Holdings, who joins us on the show. Hi, Mr. Chokhani. Good afternoon and good to see you in. It's always a pleasure to talk to you, sir. You've been a friend, to the channel, and it's been great interacting with you over the last many, many years, and obviously CNBC TV18 even before I came on board. Tell us how do you feel today first about our 26 years?
Well, thanks for having me, Nigel, and congratulations on 26 years. I'm looking at you, looking young and handsome, and I can only think back to once upon a time I was like that too. So thanks for reminding me of how one looked when one was much younger. But I would like to say, though, that there are few institutions in India which have stood the test of time and kept the trust of every citizen going. Our army being, of course, right on top over there. And there's so many institutions, the Election Commission. But in that list, I would like to add the capital markets, which are always on and always functioning and always helping people to get wealthier as time goes by. And like the famous old saying said, that you can, if you want to feed a man, give him a fish, but you want to feed him for a lifetime, then you teach him how to fish. Right. And in that context, the work that CNBC and others of your profession have been doing is just simply outstanding to actually bring the capital markets and wealth creation to every citizen of India and help them participate in this incredible wealth creation journey. So thank you for that.
All right, that's heartening to hear, Mr. Chokhani, and thank you for those words as well. Before I joined CNBC TV18, I obviously was following you, and thanks to CNBC TV18, the brand, that I get to interact with you more often as well. That said, we are celebrating our 26 years, but the market's a little bit subdued today. What are you making of the current market setup? It's a little bit worrying because we had a pretty good GDP print. The nominal number obviously was still in high single digits, which is a bit of a worry. But the RBI has pivoted. Growth focus is what they're talking about. For the time being, the market is ignoring any kind of good news. How are you feeling about the Indian markets?
Nigel, it's not a sort of T20 game in a sense. And I sometimes laugh and joke with my colleagues that maybe I belong to the sort of earlier generation which played test matches and where victory was decided over 5 days. And not as, you have in T20, if you lose 5 overs of the T20, you are out of the game. So that's not the case with, when you're investing. You have to take a longer term view of businesses that you're owning and people that you're backing. And occasionally, if you get ahead of yourself, like we did, I think in September 24, when the valuations were completely off the charts, we spent a year kind of consolidating and still hoping for this growth to come back. But when you see a single-digit GDP print and RBI has to pivot towards growth, it's telling you that there's a challenge. And while all of us participants remain optimistic and hopeful about our earnings recovery, it's also a fact that if inflation remains, this 2-3% and nominal growth remains 2-3%, then even getting to a 15% type headline earning growth is not kind of in the bag. And a market still trading, north of 20. And again, the challenge that I know you'll ask me is, at what point do foreign investors come back and so on and so forth? The reality is, look, everyone is here chasing growth and a higher rate of return. So people happily will buy, Zomato or a lot of even the QSR type companies at 100 times forward on 27 earnings. But they don't want to buy a 5P multiple, PSU Bank, for example. So it's always growth in context of valuation that one has to think about. And our market needs to digest that a bit, that we are ahead of ourselves in many, many pockets of the market.
Manish, hi, afternoon, this is Rima here. So we'll come to the pockets where you see some overvaluation still, because it's been a long period of consolidation, 14 months for our markets to get to their all-time high levels. But before that, your own verdict and view of the global markets. Do you think this AI tech momentum continues into 2026? And if that is the case, will India continue to underperform emerging markets, say Korea, Taiwan, China, which is seen as AI plays? What is your top-down view for the global markets?
So thanks for that, Rima. That I think the AI reality is a bit like what we experienced, in fact, when your channel started, that the 99 and 2000 period where it was complete euphoria on the emergence of the internet. And it was the telecom companies which were building the backbone. And you had all these global crossings and people like that who were, going hammer and tongs at building out the infrastructure. At a certain point, the market just pivoted and said, the capex doesn't justify the returns that are going to come out of this space. And in fact, I may be off by a few months, but I don't think the Nasdaq came back to its 2001 peak until 2013. So it's not a 3, 4, 5 month phenomena. It often takes decades for excesses of valuation to get corrected. Even our most famous company, Infosys, which peaked out in 2001, I don't think took out that previous peak for the next decade. And there are a number of places where, in the US also, where these 5 or 6 companies have taken out the bulk of valuation for that market. They've in fact been underperforming emerging markets as well as precious metals. And it's showing some sort of a regime change, that there is inflationary expectation in the developed Western world. And that inflation therefore will show up in terms of higher prices for commodities and increasingly to things like gold and silver and uranium and copper and so on and so forth. Plus emerging markets, excluding India, have already started outperforming last year, and that trend is going to continue. So India needs to correct a bit for its excesses, I guess, on valuation, and also discover our mojo and what's our next big sort of profit opportunity, which even you guys are grappling with. Because in the absence of creating our own tech and our own brands and our own way to create the next burst of external businesses, we're sort of trapped in a sort of low growth, only a market share, internal grabbing kind of exercise. So we will probably tread water for a while.
Manish, great chatting with you. Thank you very much for joining in. But the point is well taken that many stocks still today are priced to perfection in India.
"26 years of CNBC TV18. 26 years of CNBC TV18.
We are joined now by Sunil Singhania, the founder of Abacus Asset Managers, on this very special occasion today. Thank you for joining in on our very special
Thank you,
day.
and best wishes on the 26th anniversary of CNBC.
It's a lot of coincidences, right? Your daughter celebrates her birthday around CNBC TV18's birthday, and
every year I come on December 7th.
Right.
Which is a birthday. This time
that's CNBC TV18's birthday as well. We are celebrating it on December 8th because the markets were shut yesterday. And also, it's a momentous day for you. The mutual fund launches today. So, multiple occasions for celebration. We only request you to come more often to our studio here to celebrate this. And also, obviously, we'll...
No, thanks a lot. So, yes, mutual fund gets launched today. So, it's a big thing. Nigel's mother shares the birthday with Khushi. So, it's always a pleasure to be here on December 7th. This time, we are on December 8th. And as you said, Mangalam, it's a coincidence that we are also launching our mutual fund today.
Many congratulations on that as well. Sunil, it's been a year of resilience, right, for our markets. We fell to those lows in April, then we have recovered, and we have had multiple headwinds. We had the tariff tantrums and so on and so forth. But what do you see now going forward into 2026? There are still headwinds that are still there. The trade deal is not signed yet and so on and so forth. But do you believe that the markets will continue to remain as resilient as they have been this year, especially because of the domestic money that's coming in?
No, I think you're right, but you're kind that we have been resilient. I think we have it's been a challenging 15 months when you compare it to other asset class, including global markets, obviously gold, silver, and particularly broader markets in India. Last 10, 15 days have been causing a lot of concern. But I think, as you rightly said, we have also seen so many headwinds, multiple small wars, and then this tariff thing just does not seem to be getting out of the way. Hopefully, I think tariff, the delegation is coming 10th of December. That is what I read in the news, and hopefully we'll have some positive coming out of it. We have seen at least world being more peaceful. Except Russia, Ukraine, most of the conflicts, at least for now, are set to rest. And even Russia, Ukraine, there are talks going on. I think domestically, both the central bank as well as the government seem to be on an overdrive. 10 lakh crores of liquidity surge into the system, 4 rate cuts totaling 125 basis points. From the government, you have an income tax cut, GST cut, and the mood is clearly to support domestic growth. So hopefully, as we move forward and we go into the next year, which will also be the time for budget, we will have this momentum continue. Corporate profits have picked up. September 25 was better, not the best, but better. But our view is that if some luck on the tariff thing happens, then the next half and the year following that will be good. I think one thing which is sort of a headwind apart from tariff is the huge flow or supply of paper. Right. And that is meaning that all the incremental inflows are just going into absorbing that flow. Right. There's not too much money left to buy stocks which are already listed.
Which is why we need people like you who have the money to go ahead and buy some of the stocks, etc. You said that we were kind in calling this market resilient, but you've also been humble in calling it bad, because some of the stocks that I was looking at, some of the names, Shriram Pistons, etc. 1,000 in this market has become 3,000. Some of these SME bets that you've made, all of them are at near record high, if not at record high as well. So you've been good in the space that you have, the identifying mid caps, small caps, the themes that there are, betting on the Indian entrepreneurship. Are there any opportunities right now? Because I remember Nimesh had put out a piece last Friday saying that even as the indices are at near record high, in the broader markets, there are 40-50% of the stocks which are down 30, 40, 50, some of them even 60, 70% lower. So in this correction, are you looking at some opportunities? What are the themes?
So we are always looking for opportunity. I think that is our job. But just to give you a little bit of perspective, I think in 2024, particularly when the election fever was on, between June 24 to October 24, we had sort of a blowout rally in some of the smaller companies. So my view is, that time they got priced maybe 20-30% higher than they should have had. And I think now we are seeing in that correction mode. Obviously, it's coincided with at least a few sectors and few companies having headwinds in terms of their profit numbers, largely because of tariffs, some because of other reason. And I think, therefore, the pain looks pretty high. Yes, there have been winners, but there have been losers also. So you're very kind in just pointing at winners. We have also had our share of losers. But one thing which we are very clear is that we cannot afford to make mistakes at this point of time. Yeah. And mistakes can be of for multiple reasons. One is, obviously you buy something where fundamentals are not that great. So that we are very, very clear. And secondly, if you buy something priced to perfection, then even a small disappointment leads to a big drawdown. And I think that is what we have seen, that if you are priced to perfection, then the small drawdown leads to a big correction. And I think there is what one has to be careful. Coming to your question, yes, there are opportunities, and I think it's a good time to start looking at companies, start accumulating, because you are now able to buy without impact cost.
Right.
You're able to buy at a price you basically would have loved to 6 months back. But it is going to be a waiting game.
So what themes are looking attractive right now?
So I think among the fallen angels, I would say that engineering companies, a lot of them have fallen quite significantly. Outlook is pretty good. Some of the pharma names, they have not done anything. I would not say they have fallen, but they have not done anything because of tariff issues, so on and so forth. So there you have opportunity. We are also getting constructive on some select renewable plays. You know, it was like the darling, and suddenly in 15-20 days, it's been the reverse. But I think that segment has a lot to offer, particularly in an energy deficient country like India. So that is also where we are quite positive. And we continue to be positive on all facets of financials. I think that is a great play to be in.
But is capital markets a theme, considering the fact that we are growing the way we are, the rise in the number of demat accounts? How do you play this capital markets theme?
See, it has to be. We are a large country and we are growing in terms of per capita income and also savings. And the most important thing is financialization of savings. You don't have to now teach. Everyone knows. The best way to play it is through our business, frankly, asset and wealth management companies, because 6 crore unique investors are going to be 15-20 crores for sure. I think we are less than $1 trillion in mutual fund assets. I think we have a long way to go. One single asset management company in US is $13 trillion. So I think that is a good way. But I think all parts of, I would say, financialization of savings will benefit out of it, whether it's insurance companies, custodians, exchanges, and so on and so forth. Obviously, valuation are something which investors will... I always keep on saying this because the best company and the best theme might not be a good stock if it is priced beyond perfection.
We take a short break, come back on the other side.
"26 years of CNBC TV18. "26 years of CNBC TV18.
Well, as promised, we, on our 26th birthday, have invited a 26-year-old, young, vivacious, inimitable Samir Arora. Samir, great to have you with us here, and thank you for being part of this journey all these years.
I'm sure I was there on day one also, but I don't remember. Please check.
No, we will check, and we will, then and now. We'll do a then and now. So, Samir, it's a bad-looking screen. I mean, and I was just looking at this Fino Bank, right? There's got this RBI license. Stock is down 14%. It just, I mean, you take that as an example of how bad it is.
I had tweeted that on my birthday, the market went up a lot. So right now it looks like somebody is giving up on India in terms of selling. I guess I would call it indiscriminately because there is nothing new that is happening for, okay, that one you're showing is another example. But I'm saying in general, this looks more like dumping. Now many people say that some of the PMSs, which, were exclusively or mostly into small cap stocks are shutting because they have been doing badly for 1 or 2 years or 2, 3 years. Not sure what the story is. But in general, today doesn't look like a day from which you should draw a conclusion that somebody is seriously looking at it and has decided after the when the year is about to end that this is the time to sell. It looks like somebody walking out of frustration, being upset with whatever, and maybe wanting to buy some AI related stock related to OpenAI. I hope he does that instead.
Samir,
And not Google related.
Google. And everybody, basically, that's the problem, right? Everybody seems to be on one side, which is selling. Promoters, sponsors, corporates, foreign investors. And it is the SIP money which is keeping things afloat for now.
But SIP is also ultimately the same public's money. So you can't say public this side. And all this thing about the promoter selling, we do see not literally directly the same guy who's selling today coming to us, but broadly we can see from the inflows into both PMS and mutual fund that these are the promoters who have sold, maybe not today, but in the last X number of months, because they have set up family office or they've got some advisors now. So that money keeps coming back and forth. It's not so blatantly just one way in that sense. But I think it's more end of year, somebody wanting to give up, because this doesn't look like across the board everybody's decided today morning that when everything else is broadly okay, there's no extra incremental bad news that you have to hit literally every stock down 3-4%, 2-3% kind of thing. Therefore, I've seen this for too long. We have to give it a week or two, or if somebody thinks that they know something and we don't know, mostly that is not the case.
There is no hidden truth in that sense.
And particularly at a market level, you can say that for some stock that
Correct.
somebody has some information, but what do they have about the market?
Although, Samir, one thing I'll tell you, this growing feeling that we are kind of stuck, that nothing is moving. RBI has cut, but beyond that.
So all the things that we could have done, we means the government or the system could have done in terms of other than just directly buying stocks, they have done. And therefore, it may take some time to feed through, but these things are not wasted. You can't say that, oh, when they cut the rate that day, the market didn't go up, or the next 2 days, therefore, what a waste. Now we need to do something more specifically for that. So if you've cut these 3, 4, 5 things, and in general, the market has corrected, and the rest of the world is not falling apart. I still can't imagine that somebody is using money from India to fund an investment in some other market, because the Indian market in general has done well over time, and this year it has massively underperformed. So it's very unreasonable to think that somebody is selling a market which has underperformed by 28-30%, which means broadly, and if they buy some moving stock in that other market, it is up more than 30% since their index is up 30%. So that means they're already giving a 50-60% or 40% spread in selling some Indian stock and buying some whatever they are doing with this money.
But although in that during the course of that underperformance, maybe the underperformance may have been caused by that India was used because it was very expensive. It was used as a funding market too. And this is a point which Neelkant was making a couple of weeks back, etc. Now, this SIP...
I don't think this funding business works. For just to give you the weight. So if you're a global fund manager, then India's weight in that will be plus minus, say, index weight, which might be less than 1%. Now, you think that because obviously they're not making it zero. Because if you see in aggregate, they have sold till, I think 1 or 2 days ago, $17 billion year to date, in which January alone was $10 billion. That means from February to today, they have sold $7 billion on a their own aggregate AUM of say 800 billion. So they have sold 1%. So what I mean is, if somebody's weight is 75 basis point and 1%, and you suddenly feel that you have to buy some other market, it's highly unlikely that you do it, that, okay, I will reduce this 10 basis points here and buy Korea with it. You can fund it if you so desire with the balance 99% that you have. So don't call it a funding market. Somebody doesn't like it, they have lost and they are out kind of thing, but hardly that suddenly one day later, 10 days. Funding means that 3 months later, they'll come back with that logic. I think people who are selling and people who are buying will buy. Not all the time is it a movement from one market to another.
Thank you very much, Samir, for joining us, and thank you for being with us on this special day.
"26 years of CNBC TV18. "26 years of CNBC TV18.
We are doing an inquiry and we will take very, very strict action, not only for this situation, but also as an example. We will set an example for all the airlines. If there is any miscompliance, any non-compliance or non-adherence for any single person, any entity or any organization or any operator functioning in this civil aviation, we will take very, very strict action so that we set an example in the industry.
We will take strict action. We will set an example for all airlines. Strong words from India's Civil Aviation Minister Ram Mohan Naidu in Parliament as Indigo flight disruptions continue. Around 500 flights were cancelled today. More than 6,000 flights have been cancelled since the start of this month. Nearly 9 lakh passengers were left stranded at airports across the country, sparking chaos. The airline is facing heat from the government. The regulator has sent a show-cause notice. A parliamentary panel is expected to summon CEO Peter Elbers. The Indigo stock was the top loser on the Nifty today, down over 8%. The stock is down 15% since the cancellations began at the start of this month. With the government promising strict action, what can we expect next? To discuss that and much more, we're now joined by representatives of two pilot associations, Captain Anil Rao, General Secretary of Airline Pilots Association, and Captain Randhawa, President of Federation of Indian Pilots. Thank you very much for joining us. Captain Rao, let me begin by going to you first. The government has put the flight duty time limitation norms for Indigo on the back burner for 2 months so that they can put their house in order. How long do you think will it take for the airline, which is trying to recover operations, how long would it take for them to really put things back on track and also increase the strength of their crew, which they would need for the new roster?
Yeah, thank you very much. First of all, coming to the point of the word being used about the FDTL on the back burner is abeyance. We have got to mention that information that the FDTL rule has been put in abeyance. Now, how can an FDTL, number one, an FDTL put in abeyance has to be the whole of the FDTL for everybody. A rule cannot be put in abeyance for one operator and the other operator flies on some other rule. A rule is a rule, should be implemented in totality to everybody. A rule cannot be different from me and a rule cannot be different for you. So now our question is that the FDTL, which we are saying has put in, if at all, has been put in abeyance for Indigo, then what rule are they following right now? So, because if the rule has been put in abeyance, a new rule has to be replaced by it. So has the operator, has the DGCA clarified under what rule is Indigo flying right now under? And what rules apply to other operators? Question number one coming to. Question number two, if at all it is true that the rules have, if the rules have been put in abeyance for Indigo only, that is not legal at all, because you cannot have two different rules or three types of different rules for different operators, and that will be illegal. Number two. Number three, my dear senior here, Captain Randhawa, their organization has put a court case, and the court has ordered this FDTL to be implemented in phase-wise manner, which was being done, and suddenly the whole rule has been taken out of the window. Is itself is a contempt of court. So let me also get in Captain Randhawa, who's joining us right now. Captain Rao, I'll come back to you in just a bit. Captain Randhawa, the airline had been given enough time. All airlines had been given enough time to get ready for this. In fact, the aviation minister also said in Rajya Sabha that we held a meeting on the 1st of December to review things. Everything was on track. What action should be taken against the airline?
See, from day one, when this whole episode started and the crisis in India, we have been saying from day one, FIP stand has been that this is a problem with the software and it is pre-planned by the airline. But everything was going in a wrong direction, weather, ATC congestion, crew shortage, and FTTLCR. In fact, we've told the minister that why the dispensation has been given, because this is safety matter. You cannot have, the same law in the country for two different interpretations, or the same law being different for two different individuals. So this dispensation has been given up to 10th of February. It was very surprising because at 3 o'clock when the minister had a Zoom meeting with us, We were surprised that how in the evening he's given a blanket clearance to Indigo Airlines. And today on the floor of the House, he's saying that there is a glitch with the software systems. There needs to be, we have been maintaining a stand, there has to be a judicial probe and there has to be a strict action against the airline. And it is very clear that when this action is being taken, there has to be two things to this action. One is criminal proceedings against the senior management of Indigo, and the second one, thousands of crores of penalty, which should be payable to the people, the passengers who have been harassed and mentally tortured for hours together, when the Indigo Airlines very clearly knew that from 2nd of December, this problem is going to occur. Today also, the aircraft are on the ground, crews are available, but yet the flights are getting cancelled. It's really pathetic situation in the country.
Right. I would like to go back to Captain Anil Rao at this point. The aviation minister also said that we need more airlines in the country. We need 5 or 6 airlines. How will this really be done now going ahead? Is this even possible?
It's, I think what the minister meant was for the future and not immediately. You cannot open airlines just out of in a couple of days. What he said was, in future, if you have more airlines, then the competition makes the service better. If you see in 1990s, prior to 1990s, there were only 2 airlines, that is Indian Airlines and Air India, international and domestic. In 1990s, the open sky policies came up and a lot of airlines were introduced, because of which your services went better. Your monopoly was removed from the market. If you remember earlier days, you would have to wait for a long time to book an air ticket, like the railways. But now, if you come to a point where you have competition, your services starts to increase. Now, what happens is, when you're only person or the only operator here having a service of that kind of a nature of shares in the market, you are, whether if the service is good or bad, you're compelled to only use that operator or that service provider only. Now, example like Indian Railways.
Captain Rao.
Competition. One which
Captain Rao.
Only transportation on rail.
The government is now in touch with Indigo to put the operations on track. They are under pressure. Probably in the next few days, they will manage to put things on track. But how can we avoid such situations in future?
Of course, you can avoid these situations in future if you follow what the law was given to you well before time. You had almost 2 years for you to implement the law. The problem happens is when you take the law for granted and you think that you'll get what you wanted, is wrong. It doesn't happen. If it doesn't go your way, the way you wanted or expected it, you put the passengers or the people at ransom. And this is what happened. This leads to the catastrophe because your plan doesn't go the way you wanted it. See, when the car was implemented in Jan 2024, you had almost 2 years for it to implement phase-wise manner. The problem is, if you don't want to implement it, why other operators have implemented, they don't have a problem. Then why is there only one airline is having a problem? Is because you wish not to implement it and then turn the rules and regulations for your commercial interest. So this is bound to happen. So the government, ministry, DGC has to see to it that these things do not happen, and the facts which they're quoting is not correct. You cannot say there is a pilot crunch when the pilots actually are available to fly. There is no crunch of pilots, which they have said there is a shortage of pilot, which is wrong. Why? Because I'll tell you that we have members from Indigo as well. Their average flying is between 55 to 60 hours. That's about it. So how can you say that there is a crunch of pilots? For other reason, I'm trying to put in, tell you that the airline Indigo earlier had a minimum guaranteed hours which is paid to the pilots when you fly. Okay, so you fly or don't fly, you're being paid 70 hours. Okay. That was the contract. They had reduced this contract.
Captain Rao.
They were overstaffed.
Okay, Captain Rao, I'll get in a final word from Captain Randhawa. We managed to fix his frame. Captain Randhawa, now going ahead, do you think the government has set a right precedent by putting the FTTL norms in abeyance for 2 months. There will be questions as to why this was done for one airline after a period of 2 years when considerable amount of time had been given. So many meetings had been happening as well.
See, first of all, I'll like to tell you that, first of all, this dispensation is not understood by me. Now, can you give a dispensation on IPC 307 for murder? You cannot. Secondly, when it is very well known and we have been voicing that why this dispensation is being given when there are glitches with the software systems, aircraft are on the ground, the crew is on the ground, then why is this dispensation being given? And what is the criteria of 10th of February? How can you have in the same country two different people having different norms? Absolutely, it's absurd. And when you know that, that this is not the criteria, and on the floor of the parliament today, the honorable minister has said that it is because of the software issues. Immediately, the FDTL CR should be reversed. It should be implemented.
Right.
And they have to adhere to it. They cannot just keep a separate set of conditions for Indigo Airlines.
Okay.
The whole world
All
is
right.
laughing at us.
Completely run out of time. We've completely run out of time, but thank you very much, Captain Randhawa, Captain Rao, for joining us with those important recommendations for the aviation ministry going forward. We're taking a short break, but coming up next, we turn the spotlight on the crew rostering rules and analyze how they stack up against those followed in the United States and Europe. Also, what are the questions that remain unanswered during this crisis? My colleagues Shivani Bazaz and Madiha Majawar will be joining shortly. We'll also be getting you an interview with Devesh Chandra Thakur, JDU MP in the Lok Sabha and a member of the parliamentary panel on transport.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. The crisis at Indigo has raised a number of questions on the airline's operations and even the level of vigilance by the DGCA. I'm now joined by Madhiya Mujawar. Madhiya, why did Indigo continue to take bookings even after the cancellations began?
Right. So as Indigo slowly brings its operations back on track, the bigger questions about accountability are only getting louder because this crisis didn't just inconvenience passengers. It exposed how fragile India's aviation ecosystem becomes when its largest airline stumbles with 65% market share. So there are 6 critical questions that need to be answered. The first one: what exactly happened between November 1 and December 1? The Civil Aviation Minister told Parliament that Indigo implemented the new FDTL norms, the crew rest norms, on November 1 without any compromise. If that is the case, why did the system collapse a month later? What changed so drastically in 30 days? The second question: did Indigo plan such a fragile, risky manpower strategy that a shortage of just 300 pilots that it had told the DGCA it faced could break down operations across the entire country? This is an airline that runs over 2,000 flights a day. How was there no buffer, no redundancy and no safety net in its scheduling? The third question: why didn't Indigo plan its pilot requirement well in advance? Airlines had almost 2 years to prepare for the new rest norms because the norms were introduced in January 2024. Indigo had already informed the regulator about the cost implications, meaning it understood the manpower impact. So why wasn't hiring and training ramped up months earlier? The fourth question: why did Indigo expand its winter schedule, adding more flights and aircraft despite knowing it did not have enough pilots under the new rules? Was this an aggressive commercial bet that ultimately backfired on passengers? And why did the regulator approve this kind of winter schedule if it knew that the airline does not have adequate pilots? So even the regulator has to answer this question. The fifth question: why did Indigo continue accepting bookings even after disruptions began? If the airline knew it would not be able to operate many of these flights, why were passengers allowed to book tickets on flights that were almost certain to be cancelled? And finally, how will the government enforce accountability on a carrier that dominates 65% of the Indian market and owns more than 400 aircraft? So policies can encourage competition, but governments do not control aircraft deliveries. So how does India ensure true competition and prevent one airline's internal failure from paralyzing lakhs of passengers? These are the key questions that the airline, regulators and policymakers need to look at.
All right. Thanks, Madhiya, for joining us with all those unanswered questions, which will be very crucial in the days to come. Moving on, the crisis at Indigo has brought the new crew rostering norms under the radar, officially known as the Flight Duty Time Limitation Rules. These are laid out by the DGCA to ensure adequate rest for pilots and the crew and prevent fatigue-related safety issues. But how are the norms placed when compared to the US and Europe? Shivani Bazaz gets us a comparative analysis.
Well, yes, India's new pilot duty time rules, the FDTL norms, are at the center of the debate regarding the Indigo disruptions, with pilots calling them essential for safety and airlines saying they're too restrictive. So where does India stand globally? Let's take a look at that. To begin with, India is now among the strictest on weekly rest. Pilots here get 48 hours off every week according to the new norms, compared to 30 hours in the US and 36 hours in the Europe. India also uses a wider night flying window. Night duty runs from midnight 12 a.m. To 6 a.m. in the morning. In the US and Europe, it starts later from 2 a.m. So India builds in more protection during the low alertness hours. Night duty limits follow the same pattern. India caps night duty at 10 hours, Europe allows 11 to 12 hours, and US ranges between 9 and 11 hours. So that is where India stands in the night duty. Where India is the toughest is the night landings. Pilots can do only 2 night landings in a week and not more than 2 night duties in a row. The US and Europe don't have separate caps here at all. But in the daytime, India is broadly aligned with global practices, allowing 11 to 13 hours of duty, similar to Europe and just slightly lower than US, which allows 14 hours of daytime duty. So the biggest difference is structural. India follows fixed prescriptive limits on number of hours, number of landings, while the US, Europe and even in Canada, they allow airlines to use scientific fatigue risk models for more flexible scheduling. Overall, India is among the strictest globally for night operations and rest, even as daytime limits stay in line with the international standards. Back to you.
Joining us right now is Mr. Devesh Chandra Thakur, JDU MP and a member of Parliamentary Committee on Transport, which will be looking at this massive crisis in the Indian aviation sector. Mr. Thakur, thank you so much for joining us. Now, the new flight duty norms, all of this had been known to airlines for the last 2 years. There was a meeting also held on the 1st of December where the entire review over the implementation was conducted. Why do you think this crisis really occurred?
As a layman or as a passenger or as a citizen of this country, I would just blame it on the airlines. Absolutely absolutely callous attitude of the airlines, which has led to this disaster. Because it happened all of a sudden. There was no reason for that. And the attitude of the airlines people, everyone involved, whether it's the aircraft or the passengers or the ground staff, they were all so callous and so indifferent towards the trouble and the difficulties faced by the passengers that is just not pardonable. I don't know how such a thing can happen in these days, in these times. And the government has summoned them. I'm sure they will be going into the details of everything, and whoever is responsible should be taken to task, absolutely, without any fear, just a pardon.
When it comes to the Parliamentary Committee on Transport, which also looks at civil aviation, will you be summoning the Indigo representatives, including the CEO, to understand firsthand what has happened?
I think the government on their part has already done that as far as summoning them is concerned. When the time comes, the Parliamentary Committee on Tourism and Culture and Transport will definitely see whether we can also call them and see go into detail as to what the problems were and what are the causes for that and who is responsible for that.
Do you think the airline should have adequately prepared? They had enough time. A lot of people, a lot of experts are saying that this may be a deliberate way of trying to get an extension, because there are just 2 airlines which are monopolizing the aviation space right now.
So if it comes to light that this was deliberate, then their license should be cancelled. They should be kicked out of this country totally.
Right. I would also like to ask you about what the aviation minister said in Parliament today, that an inquiry is underway, strict action will be taken.
I don't think that matter was taken up in the Lok Sabha today. We were in the Lok Sabha for the whole day, and the whole day was dedicated to the views on Vande Mataram by different leaders and the parties. So we didn't see anything in the Lok Sabha. I don't know whether there was anything in the Raj Sabha about this, but there was nothing like this in the Lok Sabha.
I'm reading from his reply in the Rajya Sabha, but he also mentioned that India needs more airlines, 5 to 6 airlines. How do you think India can really achieve that?
We do. Why aren't there more airlines over here? That's true. There should be more airlines. There should be competition between them, and the passenger should have a choice. No doubt about it.
Mr. Thakur, for joining us with those views. Let's see what happens when the government gets a reply from Indigo, what action they take, and how the Parliamentary Committee will see this issue for the long term. Thank you once again for being with us. That's a wrap on this edition of News Center. Goodbye and thanks for watching.
"26 years of CNBC TV18. 26 years of CNBC TV18.
What's going to be Bajaj Auto's game plan for 2026 in terms of EV launches, pushing exports and the overall growth of the company? Rajiv Bajaj is in conversation with us. Rajiv Bajaj, always a pleasure to have you here on CNBC TV18. We complete 26 years today. Give us a sense of your association with CNBC TV18 and the role that the channel has played in reporting on the automobile industry and the milestones of the automobile industry in the country.
Well, Parikshit, first and foremost, congratulations to all of you. And thank you so much for having me here on your special day. I must tell you that my first most significant business interview was on CNBC almost 24 years ago. So it was 2001. Govind did it. It was on the occasion of the launch of the Pulsar. So whether it's India, whether it's Bajaj or whether it's me, the association goes back almost to the beginning of CNBC. And I can tell you from my experience, I like to call it the ABCD of CNBC. A for authentic, B for balanced, C for compelling, and D for delightful. You know, authentic because you're probably the only channel that doesn't this nonsense about source-based information. You know, everything is so credible. Balanced because there's always both points of view put before your viewers. Compelling because, you know, it is said discipline is repeating the boring brilliantly. So sometimes it may appear to you internally that what you do is getting boring, but to us on the outside, you know, it seems brilliant because it is so finely honed. And finally delightful because there is always an X factor in what you do, you know, from young Turks to future female forward and everything in between. It's a delight to watch CNBC. So, you know, I've had a great 24 years with you.
All right. Thank you so much for your compliments and support, Rajiv Bajaj. Now, let me come back to the two-wheeler business. Now, with the acquisition of KTM complete and approved, how do you now plan to scale up in India and global markets?
Yeah. So first, let's take India. So in India, Parikshit, as you may be aware, for the last couple of months with KTM, we have pretty strong tailwinds, primarily due to the launch of new products, you know, from the new Adventure to the Supermoto, most recently the Duke 160, etc. As a result of which, we have been now experiencing our highest ever retails in India. Also from India, in terms of exports, the new products are helping us to, move to the next level in terms of KTM volumes. And in fact, in that context, I must share with you that even in terms of exports to the US, which are not insignificant, we export about 10,000 KTM motorcycles every year to the US. Let me share with you something very interesting, that when confronted with the 50% tariff, Bajaj reduced the FOB price out of India to absorb most of this 50% impact. And yet we are able to export at a EBITDA that is greater than our 20% corporate EBITDA. So this is not about the power of KTM or the power of Bajaj. This is about the power of India. It is so cost competitive to manufacture out of here that really more of us should be taking this strength out, to other markets. So that's about KTM in India. As far as KTM globally is concerned, I said to you when we spoke the last time that at the heart of the turnaround globally is going to be, the concept of less being more. Less in operational terms, in the sense that KTM was brought down by this 12-month plus inventory that had piled up in its network.
Right.
So I'm happy to say that, retails are on course, that inventory is more or less depleted now, will be at the end of the year. And even strategically, it is about resetting the brand. Less is more. Get rid of the bicycle business, the car business, the smaller brands like MV Agusta, etc., and just focus on KTM Husqvarna going forward. So with this less is more approach, I feel quite confident that we are on the right path for the medium term.
How do you plan to increase your market share in ICE two-wheeler segment in India? What's going to be the game plan for 2026?
Well, when it comes to ICE two-wheelers in India, Parikshit, basically it's about motorcycles for us because we don't make ICE scooters. Within that, our focus has always been on the 125cc plus space. And as Rakesh shared with your colleagues just ago, whatever we are doing now in product and marketing terms is already yielding results. Between August and November, our share, as we calculated in the 125cc plus segment, has grown by 2% already. And I think, I just told you that 2001 was the launch year of the Pulsar. So next year is the 25th year of the Pulsar. And you will see that it will be the year of the Pulsar. Already as we speak, we are rolling out the first wave of new products, which will be reaching dealerships very soon. And you will see wave after wave of new stuff coming out of the Pulsar platforms all through 2026. And since in the domestic market, Pulsar is like 2/3 of our volume, I think if the new Pulsars do well, then this is going to be the primary basis for share gain in the domestic market.
Any investments in bikes over 350cc, considering that the government has hiked the GST there?
Well, I'd like to start by saying that I certainly hope the government will reconsider what it's done. And without dwelling on it too much, clearly this action is going to marginalize motorcycles above 350cc in this market. And if that happens, then, it greatly handicaps the manufacturers from developing such motorcycles and taking them out to the world. So I sincerely hope this will be reviewed. Meanwhile, our plans continue unchanged for now, Parikshit, because I don't know how many people are aware that when it comes to, and we measure it as 250cc plus, not just 350cc plus. So in the 250cc plus segment, between our like Pulsar, Dominar, KTM and Triumph, we are neck to neck with Royal Enfield in terms of export leadership. With 4 brands across 108 countries, there is no reason for us to kind of put our plans on the back burner because of a domestic adversity. But as I said, I hope that will be relooked at. So for now, in terms of both development and investment, our plans remain unchanged.
Right. You've become #1 in electric two-wheelers as of November and for several months in this year. What next in terms of consolidating your EV position, making it even stronger in the EV space?
Well, it's been a bit of 1-2, 1-2. It's between TVS and us, really. Between the two of us, we have almost 50% share now. And some months we are ahead, and more than that in other months TVS is ahead. I think, but more important than the number game, as I've always maintained with electric vehicles, especially with the Chetak, what is important to us is the qualitative side, the learning curve. And I'm candid enough to say that both in terms of product quality and service quality, I think at least when compared to the standards that we at Bajaj are used to, I'm still not satisfied. None of us are satisfied. So our primary focus continues to be to get up that learning curve of product and service quality. In the meantime, certainly to grow the business, to take it forward, we have to do what we always do, which is new products. So in fact, we have just started, I think in the last few days, the production of our second all-new model. So this is not some variant of the existing. It's a new Chetak because we want to grow the Chetak portfolio. So that production has started. It will be dispatched to dealers soon. We are expanding our capacity here at the Akurdi plant, where we make the Chetak, from where I'm speaking with you. And of course, expanding the distribution of Chetak, because Chetak is not sold through the Bajaj motorcycle dealerships. It has its own exclusive dealers. So this is how we have to keep it moving forward. And I'm also happy to share with you, I think I've done that before, that finally most of Chetak now has not just a positive gross margin or something like that. It actually has a positive EBITDA. So we now make money on most of the Chetak that we put out.
There are players like Revolt, Ola and Ultraviolet which have already launched electric motorcycles. Royal Enfield will launch the Flying Flea electric motorcycle early next fiscal. Will Bajaj Auto be waiting any longer, or will you be unleashing a electric motorcycle offensive soon?
No, at least for the domestic market, at least for the near term, I would think that our focus will continue to be on scooters in the Chetak brand. Our vision for Chetak, is inspired by brands like Vespa or the Mini. Again, this is something I've shared with you before. We have now in the pipeline several new developments for Chetak. We see it growing into a portfolio of possibly 7 very distinct scooters. So I think we must remain focused on that, at least for the domestic market for the next few years. But yes, Rakesh did mention, I think again on CNBC, that Bajaj is working on electric cycles. This is true. We have started work, but it is primarily for the export markets.
All right. I would also like to ask you, what's holding back EV adoption right now? The PM e-Drive scheme is coming to an end in March next year. What would be your recommendation on the kind of support you expect from the government going forward?
I think in terms of penetration, let's talk first about three-wheelers, a industry where we are a global leader and a overwhelming domestic leader. You may be aware that over 60% of this industry is now already electric between the e-auto and the e-rick. And very soon it will be 70%. So in terms of EV adoption, in three-wheelers where the payback is very quick, the consumer is already moving from various fossil fuel alternatives to EV. So there the adoption has been very rapid. Certainly with two-wheelers, I think it is taking longer. I think it is a matter of both having products that are more aspirational, because we can't reduce, the motivation to purchase to just a calculation of cost of ownership or payback period. And also a greater degree of reassurance is required in the marketplace because, let's be honest, across manufacturers, we've had product and service quality issues. So I think that's made the consumer a little tentative. But beyond that, I would make this point, Parikshit, going back to, my very early days at Bajaj, that if I'm not wrong, Hero Honda, with a very, very compelling proposition of 80 kilometers a liter, fill it, shut it, forget it, which became so famous. Hero Honda started around 82, 83. And it was only by around 95 that the entire ecosystem of customers, mechanics, and people at large got comfortable with the thought of moving from 2-stroke to 4-stroke. And EV is an even bigger leap to take. So I think if that took 10, 12 years, then I think EV will take a similar period of time before it gets to that tipping point, which means that sometime, therefore, around 2030, we should see this tipping point emerge. That would be my conviction for penetration as far as two-wheelers is concerned.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Tata Motors has relaunched the Sierra and they hope the SUV will drive up volumes in the year 2026 and the fiscal year 27. Joining us right now is the Managing Director of Tata Motors, Shailesh Chandra. Mr. Chandra, give us a sense of the response to the Sierra so far, the number of inquiries you're receiving, even though the bookings and the commercial rollout is yet to begin.
Yeah, first, thanks, Parikshit, for having me on the show. The response to Sierra right from the time we released the brand film and then we had the brand days, followed by the launch event that we had on November 25th. Since then, I think the response has been overwhelming, I would say. Much more than what we were really expecting in terms of response that we would get. The inquiries have been phenomenally high. And as you know, that bookings are really going to start from 16 December. So we have to wait till then. But the extent of inquiries that we have been getting and also people booking their interest is enormously high. And we expect that when the bookings open on 16th, the numbers would be overwhelmingly high. So we are just expecting on 16th, we get a positive surprise for all of us.
All right. Could you give us a sense of the discount levels for December year-end sales and how will that impact the costs that the company will have to incur on account of discounting?
Yeah, so Parikshit, you know that December, typically it's a very high retail month. And generally the customers who buy cars in December are seeking, attractive offers ahead of the start of a new year. And therefore, typically you see as a part of seasonality that the offers are higher in the market to tap that customer who's looking for that kind of an offering. So generally the discount levels are higher as compared to the earlier months. So every OEM goes very selective about which models they would like to, top up the offer of what was ongoing in the earlier months. So similar kind of calls we would have also taken, but these are very planned VMEs, I would say, very planned well ahead of the December sales. So this will be slightly higher in select models. And we hope that therefore retail, which we are going to see in December, should be very comparable to what we were seeing in the festive period.
Right. Could you give us the range of discounts starting from the minimum to the maximum?
Very difficult. I would not have the numbers offhand. But whatever was prevailing in November, it is slight increase from that level, in select models.
All right. Is Tata Motors likely to increase prices in January? And if yes, by how much?
See, the increase in price needs to be put in the context of the GST 2.0 drop that had happened. And therefore, the baseline of prices of all the cars went down depending on the segment of the car by anywhere between 3.5% to 8.5%. And that baseline drop is something which we have to maintain in the spirit in which the government has reduced that. Having said that, there has been an increase in the commodity prices right from January 25 and we have not been able to pass on as an OEM this commodity price increase to the market. And I would say the extent of commodity price increase would have been in the zone of 1.5% to 2% of the revenue. And to some extent, we have been able to offset that with the cost reduction actions that we have been taking internally. So whatever residual part of that commodity price increase, which we have not been able to pass it on to the market for the last 1 year, is the extent to which we will consider as a price increase somewhere in Q4. Maybe in Jan, that is to be decided yet. We are still reviewing that part, but the residual part of commodity increase is something which we are looking forward to take as price increase in the Q4 without disturbing anything as far as the GST 2.0 reduction is concerned.
Right. So what will be the residual amount of commodity price increase which you've not been able to absorb so far, sir? And how much is likely to be passed on as per initial estimates?
I would not like to share that number because, as I said, that it is still under review. But I've already given the extent of commodity increase as a percentage of revenue that has happened since the last price increase that we had taken somewhere early this calendar year. And that is to the extent of 1.5% to 2% of revenue.
All right. How would you describe the overall sentiment in the market right now?
Yeah, it's been very buoyant, right, since the GST 2.0, implementation from 22nd September. We have been seeing, at least in Tata Motors, I can say that the inquiries, year-on-year growth in inquiries is pretty much been seen in double digit. And to that extent, one is getting reflection in the bookings also. And you are also seeing the growth rates for the last 2 to 3 months as far as the industry is concerned, mostly double digit. So therefore, the overall mood remains very good. And so is the trend that we are seeing in December too.
What about rural versus urban sales in terms of contribution in your portfolio?
I think both are going very strong. Rural has definitely maybe slightly better than urban. So our share of rural would have definitely gone up by a percentage or so of the total sales that we do. So both in urban areas as well as rural areas, after the GST 2.0 implementation, the sentiment has really gone up. In rural areas, of course, because of a better monsoon and better liquidity availability, I think that is also helping drive the rural demand.
And finally, any message to CNBC TV18 as we complete 26 years?
Yeah, I would first congratulate you all for completing 26 years. It's a very important milestone. And it is very difficult in this very competitive industry to really survive in this cutthroat competition. But you have brought news to the viewers with a high level of responsibility and with very quality content. So I'm sure that the same values is going to continue with CNBC. And congratulations once again to you all.
Thank you so much, sir, for joining us.
Thank you, Parikshit.
Thank you so much, sir. Wonderful talking to you.
Thank you.
That's all the time we have here on this broadcast. Thank you for watching. Goodbye.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always is Shruti Mishra. These are the top headlines that we're tracking for you from the startup world. Ace Vector, the parent company of e-commerce marketplace Snapdeal, has filed updated DRHP with the SEBI to raise funds via IPO. The IPO is a combination of fresh issuance of shares worth 300 crore rupees and an offer for sale of 6.38 crore equity shares by existing shareholders.
Skincare startup Conscious Chemist has secured 15 crore rupees in a bridge funding round led by Atomic Capital. The D2C brand plans to use the new capital to scale its inventory and increase investment in R&D. It is also preparing to enter scalp and hair care segments.
Frex, a peer-to-peer payments platform, has raised 9.5 crore rupees in pre-seed funding round led by Zero Pearl VC and White Venture Capital. The fresh capital will be used to expand Frex's on- and off-ramp infrastructure across North America and India, strengthen the compliance and regulatory stack across key corridors.
Orthopedic recovery product startup Lumov has secured $1.2 million in a seed funding round led by Incubate Fund Asia. The startup plans to use the capital to expand operations, build stronger partnerships with surgeons, and speed up the development of new products.
Starlink will offer satellite internet services in India at a cost of 8,600 rupees per month and a one-time hardware cost of 34,000 rupees. The monthly subscription cost is nearly 3 times higher than Bangladesh.
Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. From organic beauty to a new age business powerhouse, Organic Harvest founder Rahul Agarwal is back with his next big bet, Rasa Group, a diversified conglomerate spanning 6 sectors: sustainable real estate, modern Ayurveda, adventure tourism, curated luxury cars, legacy Indian cuisine, and a multi-brand premium laundry ecosystem. Rasa is targeting a pan-India footprint over the next 3 to 5 years and is already eyeing a group or sub-brand public listing within 2 to 3 years. To tell us what's the strategy behind this bold conglomerate play, joining me now is Rahul Agarwal, the founder of Rasa Group. Rahul, welcome to Startup Street. From building Organic Harvest to now launching a diversified conglomerate, Rahul, what gap did you see that needed a conglomerate-style approach, and what philosophy ties 6 very different verticals together? What's the common thread?
Yeah, so the idea is to organize an unorganized market in India, and we believe that Indian economy is at a cusp where a lot of unorganized business will have to organize themselves, especially the brands which have done the legacy kind of format. So across all the 6 verticals, that's a common thread. We are trying to organize an unorganized market in India.
All right, let's take Avni Infratech first. Sustainable real estate is a crowded promise. What's the differentiated play, Rahul, across Delhi, NCR and Goa?
So if you see the real estate as an industry, it has always been a little opaque. The customers are not shared all the information right from the time they book their inventory till the time it is delivered to them. So what we are trying to do here is to be absolutely transparent with the customers with the help of tech and digital. So just to give you an example, all the customer of ours gets an app wherein they can easily track the progress of the project. So it's just one of the examples that we do the tech intervention in the industry, which is highly non-tech driven. So yeah, that's the idea.
All right, let me move on to the next one. Sarvagun combines Ayurveda with telemedicine and evidence-based care. Rahul, what's the business model and who's the core customer?
So business model is simple. What philosophy that we are following here in Sarvagun is that what Germans did with homeopathy, we Indians can do better than that with Ayurveda. And the business model is telemedicine as well as this, the clinic based. But again, with the help of tech, digital, and the other new age way of reaching out to the consumers. The target audience is anywhere between 35 to 65 age group, somewhere, working population.
Okay. You know, Adventix again is targeting high-thrill adventure experiences, hot air ballooning, paramotoring, ATV trails. Is India ready, Rahul, for large-scale adventure tourism? What's the safety and regulatory framework that you're building around this?
Absolutely, we are ready. If you see in hot air balloon, there are most of the tourists that Cappadocia in Turkey, they visit, it's majority of them are Indians. So the thought was, why not bring the same experience or maybe better to India with the world-class facilities and regulatory approvals. So that's what we are doing. In terms of the safety, we have the best-in-class people working on ground. So we have our pilot who does this hot air balloon. He's the gold medal with the Indian Army. So that's a kind of safety.
Let me go to Friday night cars. It is an interesting bet, curated luxury auto for India. How big is this niche and what is your entry strategy, Rahul?
So our idea was to import the American cars which are not manufactured in right-hand drive by the OEMs. So what we do is we procure the new vehicles from the US, convert them from left-hand drive to right-hand drive in Australia, Sri Lanka, and Middle East, and then import here in India and sell to HNIs. So that's a clear niche that we have identified. So these are the cars which you will not typically find on Indian roads because these are not manufactured in right-hand drive version of this. So that's the thing we are targeting.
You know, while G Bharke is bringing legacy food brands under one roof, you know, on the other hand, you've got next-gen dry cleaners already operating multiple sub-brands. If you could quickly tell us what's the scale and revenue ambition here and why go multi-brand in laundry care?
So the idea is to reach out to multiple consumer segment, multiple needs for the consumers. So right from the masses till the classes, everything is served under one umbrella. And with G Bharke, we are bringing all the legacy brands under one roof with an offline offering there.
Okay, you're targeting pan-India presence in 3 to 5 years. What does the expansion blueprint look like, Rahul? You know, consumer first, asset heavy or franchisee led. And also you've got, you know, you've set a 2 to 3 year timeline for a potential listing, you know, group or sub-brand. What are the metrics you need to hit before going public?
So we will always remain a consumer first brand. Anything that we do, right from the consumer, the communication of the brand ethos till the time we sell to the consumer, everything is direct to consumer. In terms of the matrix, we are very conscious about profitability. We don't, I mean, the cash conversion cycle has to be negative. That's a philosophy that we are following. And anywhere between 300 to 500 crores is the top line that we are targeting before we actually hit the public market.
On that note, it's time for me to wrap up our conversation. Rahul, many thanks for joining us on Startup Street and wish you the very best with all your growth plans.
Thanks for having me here. Thank you.
And moving on the hot seat today, Udly, the AI startup known for its realistic role-play simulations, is stepping into a new phase of growth. The Seattle-based company has raised a massive $40 million in a Series B round, led by Westbridge Capital, taking its total funding to nearly $60 million, all within months of its previous round. Udly is now positioning itself as a leader in experiential learning, giving professionals a place to rehearse high-stakes conversations and get instant personalized feedback. Joining me now to discuss this further is Varun Puri, the co-founder and CEO of Udly. Varun, thank you so much for taking time out and being here with us on Startup Street. Like I said, you're an AI role-play and experiential learning tool maker, right? Can you tell us what it is you have on offer and give us some use cases? What are you trying to sort of solve for?
Yeah, first off, it's such an honor to be here. Thank you for having me. The thesis behind Udly is simple. Too many smart people in the world miss out on opportunities because they don't back themselves while speaking. Think about any of us the night before a speech, an interview, a manager conversation, a difficult conversation, as we practice out loud in front of a mirror, a camera, a stopwatch. This is a problem that 2 out of 3 people face. So the idea behind Udly is how do we build an AI-powered communication coach that provides a private, real-time, judgment-free experience for folks to practice, go back and forth with an audience persona, and then get instant feedback to improve.
And, you know, you've raised this $40 million, right? Congratulations on that. What does this milestone sort of mean for Udly's evolution from, you know, a fast-growing startup to a trusted enterprise partner? If you could take us through how you plan to use these funds.
Yeah, it's humbling and exciting. We raised our Series A, which was a little over 13 million a few months ago. The Series B helps us make this dream a reality. We believe that Udly can help every enterprise out there, be this helping folks with sales enablement, partner certification, training managers, and helping consumers across the world as well. For instance, I use Udly before practicing for this interview. The fundraise allows us to double down into our engineering, to hire more, and to scale to more geographies.
Absolutely. And, you know, like you said, a lot of enterprises are already trusting you. You've got the likes of Google, Snowflake, and Databricks already who are your clients, right? So how are enterprise customers using the platform today? You gave us one example about how you used it before you came for this interview. So how are your customers sort of using it, and what are the kind of results they're seeing? If you could take us how you plan through the plan on growing your client base as well.
Yeah, so the core problem within an enterprise today is learning is scattered and it takes far too long. For instance, if I'm an organization like Google and I need to train 15,000 reps on my new sales play, I would get folks to watch a pre-recorded video, maybe do a quiz, maybe organize hundreds of seminars, and then hope that whatever they've learned sticks in practice. Udly provides an ecosystem where folks can practice, actually get a batting cage-like environment, and make sure they're ready for prime time. So the kinds of use cases where we see most success with are helping sales teams reduce ramp, helping close win rates, helping managers and partners get certified in the company's methodology, right? Every organization has a different way of speaking. Google's might be different from RingCentral's, might be different from Korn Ferry's or Sandler Sales. Udly provides this instant rollout of training and ensures your field sellers and your customer-facing teams are speaking in the right company voice the way you'd want them to.
And, you know, could you take me through the kind of revenues that you're currently clocking? Where are you at? And where do you hope to end this year? I mean, we're almost at a close, so you can give us a 6-month to 1-year target. Also, what's the revenue mix like, right? Which geographies are seeing the most demand? And how important of a market is India for you?
Yep, all great questions. So the revenue mix is between consumer and enterprise. On the consumer platform, anyone can go and sign up to Udly, use the tool, practice as a freemium model. If they like the tool, they can sign up. Most of our revenue comes from the enterprise side. It has been an exciting year. We've grown revenue by over 900%. We are poised to have the biggest quarter in company history. Right now, a lot of our revenue comes from North America and Europe, but we are seeing massive, massive demand from APAC, especially from folks in India, from speakers in Korean, Japanese, etc. And with this raise, we're excited to scale to new markets.
All right. And what would these new markets be for you to scale into?
It's a combination of Southeast Asia and more ecosystems within India.
All right. Communication is also becoming a priority skill for teams worldwide, right? That's the main thing here. What are the biggest demand drivers you're seeing in the enterprise learning and GTM enablement space?
Yeah, a couple of things. One, it feels like the whole world is having this Gen AI awakening. Everyone wants to get Gen AI as part of their stack. As a result of which, as companies are shipping product more quickly, it's becoming even more essential to train your teams all the more quickly, which is helping enable Udly. More than that, you know, as AI gets ubiquitous, there are lots of companies that are building AI to replace human jobs. Something we don't agree with. Our ethos is let's help humans be the best versions of themselves in the conversations that matter most. But as AI extends across organizations, the core essence of how we show up, our authenticity, our humility, whether we can build rapport with another person, is even more important in landing the deal, having the conversation, etc. And that's what's really urging this need for Udly.
Right, keeping ourselves still human at the end of it. And what would be the next big thing that you're looking to launch, if you could tell us in like 20 seconds?
Today, we are an AI role-play simulator. Tomorrow, we're hoping to be an experiential learning platform where you come and learn skills in addition to just practicing them.
All right, Varun, we're completely out of time. But thank you so much for joining us on Startup Street. And we wish you all the best on this journey going forward.
Thank you. See you.
See you.
Well, on that note, it's time for us to head into a short break. But coming up, EV manufacturer Ultraviolet bags $45 million in its ongoing Series E funding round. We put the firm's co-founder and CEO Narayan Subramaniam on the hot seat. To find out more about Ultraviolet's growth plans, stay tuned.
26 years of CNBC TV18.
Well, EV bike maker Ultraviolet has secured $45 million as part of its ongoing Series E round. The latest infusion comes from Zoho Corporation and Lingotto, which is one of Europe's largest investment management companies. Now, the company says this growth capital is going to accelerate the domestic and international scale-up of current products, F77 and X47, and future product platforms, Shockwave and Tesseract. Ultraviolet is now present in 30 cities across India and plans to expand to 100 cities by mid next year. For more on their growth plans ahead, joining me now is Narayan Subramanian, co-founder and CEO of Ultraviolet. Narayan, thanks very much for your time here on CNBC TV18. You've got this $45 million in this ongoing Series E round. One, what does this mean for your valuation? And two, also, when will you close this round at what kind of levels?
Oh, thank you, Ritu. I think while it's great news for us, it's going to, like you mentioned, scale our growth across the current and the future platforms. When it comes to the topic of valuation, see, we've been in this to build compelling products. We've established the motorcycle business in our firm way. We're entering more mass-oriented segments like the scooter and the Shockwave coming up in 2026. And perhaps looking at an IPO scenario in the next 18 to 24 months. And from where we are today, I think that would be the right time to get into details around the valuation. But very good to see continued support in our vision towards building world-class mobility solutions.
Okay, Narayan, you're saying an IPO is what you're considering in the next 18 to 24 months. So could you give us a sense of what kind of milestones you want to achieve before you do that? And the investors that may be seeking exits, I mean, what can you tell us about these plans? I know it's a little early, but what can you tell us?
Of course. So most of our investors, I think all of them, in fact, are in it for the long run. They've been backing the company through multiple phases, right from inception towards the scale that we are at today. And when it comes to working backwards from an IPO, what we believe in is having a very strong, robust business, both in India and overseas markets. And in that regard, we've taken a top-down approach. We started with more performance-oriented segments, like the F77 and the X47, that took us about 8 years of R&D. But the advantage that it's built into the brand today is the fact that we vertically integrated all of the core EV subsystems. We make our own battery packs. We make our own BMS modules. We make the vehicle control unit, the charging technology, the controllers, the softwares, all of it. So in essence, what we've built is an organization that is geared up for profitability. And we've taken the approach of building for profitability first and scale second. And today we're at that transition point where the last year plus has seen our growth in the motorcycle space. And starting 2026, we will enter into the mass-oriented segments. So if I was to think back 24 months from a potential IPO scenario, we would like to have an established business across the entire spectrum of two-wheelers operating in a well-oiled, robust way in India. We're already in Europe now. In 2025, June, July, we launched in Europe, and now we're retailing in 10 countries across Europe. And the good news is that the certification for Europe, while it took us a little over a year to get the certification in place, the hardware is the same as what we've launched in India. The vehicle goes out from here with no changes. But the benefit is that with the Europe certification, it opens up 40 countries for us across the world. So we will be looking at strong domestic and international growth, and of course, be close to EBITDA breakeven before we look at an IPO scenario.
All right, that's quite the comprehensive response you've given us there, Narayan. Lots to digest. But a quick word on these launches, and you were talking about the European market. The X47 crossover motorcycle you've launched in India. One, how soon before you ready it for the European markets, and two, the F77 is now in European countries already. Are you looking to ramp up production for both of these? I mean, what's the plan from here on?
Sure. Yes, the F77 launched first in India, and now it is already in Europe.
Yeah.
The platforms are quite common between the two motorcycles. We share the same battery, VCU, and the motor control systems across both of these products. So certification for the X47 for global markets is currently underway. And with the X47 crossover, like the name suggests, it sort of caters to multiple segments of two-wheelers, right from street motorcycles to roadsters to off-road motorcycles. And the interesting fact is we're also seeing a lot of electric scooter owners now upgrade to electric motorcycles. Right. So now with this in mind, we are seeing vastly increased demand as well across the country. Let me also tell you that in the last 12 months, we've gone from one city, which was Bengaluru, the home city, to now 35 locations across the country. So we've been having production and distribution scale up with the product portfolio ramping up as well. So yes, we will. The X47 should launch in Europe, I think, before May 2026.
Okay, so sometime next year you'll have the X47 in Europe as well. A quick word, Narayan, running out of time. Shockwave and Tesseract, what can you tell us about the timeline for these and the kind of product pipeline you have with these platforms?
So Shockwave and Tesseract, highly compelling products. The Shockwave addresses a more of an entry level and a dirt motorcycle market. It's going to be a lot of fun from college students to experienced dirt motorcyclists. Tesseract, of course, is a scooter. We have designed arguably the world's most advanced scooter, comes in with radars, cameras, and a whole host of technology. And not to mention that we are outputting over double or close to 3 times the power output of benchmark scooters in India from an electric scooter market standpoint, and significantly more range as well. We've spoken about range on a single charge going from 160 to 260 kilometers. So we're breaking a lot of barriers in both of these segments. Both of these are also in a very advanced stage of development and testing at our end, and we should be looking at launching them in series sometime through mid-2026.
All right. You're also expanding to 100 Indian cities by mid-next year. I mean, lots of targets you've set for yourself, including EBITDA break-even by next year. You're also aggressively entering Europe. Just tell us how you're going to balance the economics of scaling here in India at the level that you're talking about with the brand-building opportunities in these global premium markets you're eyeing. And outside of Europe, is there any plan at all?
Right. So, like you said, Europe is a motorcycle enthusiast market. If you look at how vehicles have evolved, it's been parts of Japan, parts of Europe and US where motorcycling culture has evolved. So very important market for us, sets the right benchmark for the brand in various parts of the world as well. And the fact that we're now certified in 40 countries opens up markets in Southeast Asia, Latin America, and parts of US as well. And these are the markets that we would subsequently be targeting, along with active, aggressive ramp up across India. So we are in 35 locations now. We're targeting expanding to about 100 locations through 2026.
All right. Finally, let me ask you, since you brought up the IPO as well, and you're talking about an EBITDA break-even. Currently, you're at 36 crores in revenues, 116 crores in losses, as per your last reported figures of FY25. How's FY26 shaping up so far? Will you be, break-even by the end of this fiscal, or what can you tell us about the next year or so?
See, for us, 2025 was a very, very strong year in terms of building the technology, building scale and distribution. And we talk about losses, but in fact, let me also address that. There's more of expense going back into R&D. It's expense going into international certification, international testing. So it is setting us up for the long run. It is not losses in the typical dictionary meaning of the word losses. It is investment towards the future growth of the company. And through 2026, we're targeting operational break-even, and through 2027 is where we will be looking at EBITDA break-even.
All right, Narayan, we'll leave it at that, and we wish you the best with these plans. It's been a pleasure having you here on Startup Street. Thanks very much for your time.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Putin's agenda for New Delhi. Parikshit.
Happy 26th birthday.
भी लगाएगी तू? देखो है तो देखो. Happy 26th birthday CNBC TV18 from the crown.
लाइन दिखाते रहना, वो इंडिगो का बोर्ड दिखाना, ठीक है?
Listen, I wanna be there with you no matter where you go. Life is a table for two, and we're starting the show. I'm gonna spread my wings and fly so high up above the clouds. Simple.
Well, CNBC TV18 turns 26 today. On this day, we would like to thank all of our viewers for your continued trust and support. I'm Ashmit Kumar, and joining me now for a very special conversation is with us the captain of the industry, a leader of the tech space, the CEO of Cognizant, Mr. Ravi Kumar. Mr. Kumar, thank you so much for joining us for this conversation. Again, a very timely conversation, not just coinciding with CNBC 26th birthday, but also coinciding with this transition that we are seeing in the tech space to a new world, to a new era, and also at a time when we're stepping into 2026. So, Mr. Kumar, thank you once again for joining us, for being a part of this conversation. Let me begin by asking you that as you step into 2026, what are some of the biggest changes that you saw in 2025, and what are the key priority areas that you're going to watch out for as you step into 2026?
Thank you. Thank you so much for the opportunity, and congratulations on the 26 years. Here is what I see. In the last couple of years, and 2025 was an inflection point, we saw a evolution of two specific swim lanes. The first is applying AI on software cycles. This is work we did for the last 25, 30 years. And software cycles have now got embraced with machine-led work, machine-led effort. And my personal belief is as more and more software cycles are assisted by machines, we're going to see elasticity of technology help us to consume more. So as you do more for less, you get to do more. That's the first swim lane, applying technology on software cycles, applying AI on software cycles. The second swim lane is applying AI on agentic cycles, which is operations of enterprises. This is new addressable spend because globally, enterprises are going to reorganize and re-architect their operations. There's going to be reinvention of business, reinvention of process, reinvention of workflows, and it will be intertwined.
Mr. Kumar, on the subject,
digital labor is going to be deeply integrated with human labor, and that will be the way forward. So getting into 2026, we're going to see these two coexisting as we go forward.
You've given me three very important cues. Let me take those up one by one. First, let's talk about AI. You talk about the next layer of growth that you're hoping to unlock using agentic AI. What I want to ask is that various reports suggest that the level of AI automation that we are seeing in India is limited to, again, very process automation. It's not maturing. Are you beginning to see that degree of IT spends being made by legacy enterprises that you hope to benefit from going forward in 2026?
In the last 2 years, there's been a build-up of AI infrastructure. AI is broadly in three layers. There is an AI infrastructure build-up on the compute, on LLM access, and we're going to see a significant runway from here to training the models and then leveraging it at inference time or production time. Once we get past that, you're going to see the third layer, which is building applications on top of it. The velocity has been very different. You rightly pointed out, the velocity of build-up on infrastructure is significantly higher than the velocity of its embrace in enterprises. So the bridge is getting built, and we call ourselves companies like Cognizant as companies which are actually AI builder companies on the bridge. So there are two different velocities. One velocity, high velocity on infrastructure. It has happened in all tech disruptions. Velocity of infrastructure build-up is going to be higher, and progressively velocity of its embrace on businesses is going to catch up. It's going to happen over the next maybe 1 to 2 decades. The urgency, though, today is because the shelf life of the infrastructure build is very short, because the scaling laws of AI are much lower. I mean, Moore's law, which kind of drove the past tech revolutions, was 36 to 48 months. In AI, those scaling laws are between 6 to 12 months. 6 to 12 months, the technology advances so fast that if you don't actually get the value from the enterprises, the technology will go obsolete. Just to give you an order of magnitude, in a year...
I'll just come in there, Mr. Kumar. I'll just come in there. I'll just circle back to question of what it translates into revenue for you. The question I wanted to ask you is that, again, are you seeing that degree of IT spends? A lot of reports seem to suggest that the ROI on a lot of these investments that are being made on Gen AI-led investments are not materializing in significant returns, either in terms of revenue or in terms of savings. Are you seeing that trend? Are you seeing some
billions of dollars,
or are you seeing greater momentum in 2026?
Yeah. So the billions of dollars which has been spent on AI infrastructure, I mean, just to give you an order of magnitude, in 2025, almost $400–500 billion of infrastructure spend has happened. Now, if you have to get a value out of it, there should be trillions of dollars of value in businesses, and the infrastructure companies have to make $600–700 billion for getting a strike rate of 10%. So that trillions of dollars of value has not happened yet. It is going to start to happen. And enterprise productivity will first build up, then societal productivity will happen. And over a period of time, AI, which is kind of on the side, will actually be at the center of everything we do. That's what happened with the internet. If you go back to the 90s, you remember, internet was on the side. Today, internet is in the middle of everything we do. It's in the background. And that's what is going to happen with AI. It's going to go into the middle of everything we do. That productivity will drift into businesses, it will drift into people, it will drift into societies. Now, going back to your question on automation, it's a layered process. It starts with tasks, then the workflows get integrated, then the process reinvention happens, and then there's going to be reorganization of business models. So it's a combination of all of these things which will drive productivity. Productivity is a 10 to 20 year journey. Every year there's going to be an uplift of it as we go forward.
Right, Mr. Kumar. So clearly there is consensus on the potential that this technology hosts. The question I want to ask you is, can you give us some guidance as to where we are currently? Some picture that you can give, some guidance you can give in terms of your revenue attributable to AI. HCL, of course, has given some guidance. They're measuring their AI revenue at about $100 million. Some guidance that you'd care to give as to where we are, where we stand right now as we close 2025?
Absolutely. We were the first company in 2024 which spoke about how much of our effort is machine assisted. And we started all the way in 2024. And today, my last earnings call, I spoke about how 30% of our code is assisted by machines. That's on the first swim lane. On the second swim lane, which is about how much of it is now moved into operations and agentic capital beyond traditional classical software, we've spoken about multiple proxies. I mean, just talking about AI revenues, it's hard to baseline. Everybody looks at it and measures it differently. So we took a slightly different approach. We looked at revenue per person, margin per person. And we created a 10% bump on our revenue per person and an 8% bump on our margin per person. That non-linearity is explained by AI. So number of projects, percentage code written by machines, productivity, which is driven by revenue per person and margin per person, non-linearity, because you're going to get a 10% increase in revenue per person, 8% increase in margin per person. A combination of all this gives an indication to investors and customers how much we have embraced AI. We are the only company today in our peer group which talks about what percentage of our code is written by machines. And that is because, if you remember, in the last 6 months, we ran this vibe coding hustle inside the company to create a cultural renewal of working alongside machines. And we hit the Guinness Book of Records with the number of coders who used vibe coding tools to assist themselves. So that's the hustle of how you can actually explain to external stakeholders of what AI is. Number of projects, productivity, revenue and margin, percentage code written by machines. If you layer them all, then you will start to see indications of how much has been impacted.
Mr. Kumar. Now, speaking of benchmarks, if not as a percentage of the revenue, can you give us some indication what percentage of your pipeline perhaps is AI contingent, is Gen AI dependent?
So, it depends on where you draw the line, right? I mean, it starts all the way layering from, specific standard automation to machine learning algorithms to AI algorithms to then generative AI algorithms. So if you just layer them out, that's how it works. So we've not taken the distinction because I personally believe everything you do today in the technology business will be AI-led. So carving that out as an AI thing is only going to be confusing to investors. So what we really did was we looked at indicators which help investors and customers to look at what does it do to our business model. It creates non-linearity in our business model. For the same kind of number of people, we are actually going to get more revenues. Just to give you a sense, between last year to this year, our total year-on-year growth, if you look at our revenue and you look at our people growth, there is a difference of 2%. And that difference comes from AI-led productivity. So we've taken more leading indicators which are tangible, traceable, and you're able to attribute it to AI versus tagging revenues or pipeline to AI, because that is a very subjective process.
Right, Mr. Kumar. I'll come to you for one final question, of course, and this is one question. Given your wide footprint that you enjoy here in the Indian market will be very relevant for a lot of coders, developers watching you very carefully. So the question is, as you step into 2026, as you're looking at these unlocked potential that AI agents offer to you, through our last conversation, you mentioned that 30% of the code is written by machines. The question I then want to ask is, as you step into 2026, some guidance that you can give as far as hiring, what it may look like in 2026, and whether this 30% of code being written by machines will influence any hiring decisions going forward.
That's a great question. There are a bunch of things I would like to tell the viewers. First, the number of freshers we hired this year is significantly higher than last year. I have a thesis that with AI, you can amplify human potential. If you are getting developers to work alongside machines, they're not going to get replaced. They're actually going to get higher productivity. And at the bottom of the pyramid, the productivity is the highest. So we hired more school graduates, almost 20,000 this year in comparison to last year. That's one. Second, the productivity at the bottom 50 percentile is higher than the productivity at the top 50 percentile, which means it's kind of an equalizer. Third, our ability to create new jobs using AI. Remember, AI is kind of, if you take an end-to-end process, you need human effort at the start, you need human effort at the end. Human effort at the start for prompting, for authentication, and human effort at the end for verification and validation. So the ability to create these jobs will be driven by how much you can use machines in the middle. I'm a big believer that if you do more for less, you actually get to do more. That's one part of the story. Right. The second part of the story is,
right, Mr. Kumar,
look at what's happened in the last 25, 30 years.
We've completely run out of time, Mr. Kumar. I'd like to thank you for joining us.
Operations.
We've completely run out of time, Mr. Kumar. I wish we could have stayed longer on this very intriguing conversation on what AI looks like going ahead in 2026. But that's all the time that we have. Thank you so much for joining us. With that, we're heading into a very short break. We'll come back on the other side with the day's top stories on the other side.
"26 years of CNBC TV18. "26 years of CNBC TV18.
Welcome back. Now, the top story this evening. The Indigo stock was the top loser on the Nifty today. Flight disruptions continue, with around 500 flights being cancelled today. The airline's management is facing government scrutiny after sparking chaos at airports and leaving thousands of passengers stranded. The Union Aviation Minister Ram Mohan Naidu addressed the situation in the Parliament today. He said that the government will set an example for every airline. According to the minister, the airline did not flag any issues before the mass cancellations of flights. Sources say the 4-member panel set up by the aviation regulator, DGCA, is likely to summon the Indigo CEO and COO to explain the cancellations. The situation at major airports was relatively calm today. Indigo said it has issued advance notice of cancellations to passengers to avoid crowding at the airports. Indigo says it operated more than 1,800 flights today, which is higher than 1,650 flights operated yesterday. It has also already refunded 827 crore rupees to passengers. Indigo also said that the on-time performance across the network is back above 90% as compared to 75% yesterday. Ratings agency Moody's has termed the crisis a credit negative for the stock and flagged lapses in planning and oversight. Here is the Aviation Minister Ram Mohan Naidu speaking in the Parliament on the Indigo crisis.
We are doing an inquiry and we will take very, very strict action, not only for this situation, but also as an example. We will set an example for all the airlines. If there is any miscompliance, any non-compliance or non-adherence for any single person, any entity or any organization or any operator functioning in this civil aviation, we will take very, very strict action so that we set an example in the industry.
Maharashtra's key cash crop soybean has turned into a liability for farmers once again this year. Already hit by rain-related crop damage, farmers are now forced to sell their produce below the minimum support price. Santya Gora brings us this report.
This year, an MSP of 5,328 rupees per quintal was announced for soyabean. The government had set a target of procuring 18.5 lakh metric tons of soyabean. The state government says 580 procurement centres have been activated across Maharashtra. Despite this, soyabean farmers continue to face distress in what has been a bad crop year. Flood-related crop damage in key soyabean growing districts such as Dharashiv, Amravati, Buldana and Nanded has caused heavy financial losses. Farmers now say they are unable to sell their produce at MSP. According to them, government procurement centres are refusing to purchase soybeans, citing deterioration in quality due to floods.
We are all worried because of this. Procurement centres are not accepting even slightly deteriorated produce.
Only top quality produce is being accepted at procurement centres. Because of the floods, the quality of our crop has been affected. The government can give us less money if it wants, but it should at least buy our produce.
The Maharashtra government's Cooperation and Marketing Department told CNBC TV18 that procurement is being carried out strictly as per government guidelines. The produce must meet fair average quality norms and should have moisture content below 12%. The department claims farmers meeting these criteria are not being turned away. However, farmers argue that given the floods this year, the government should have offered relaxation in procurement norms. That has not happened. As a result, many farmers across soyabean growing regions are being forced to sell their produce at 25 to 35% below MSP. This price, they say, does not even cover their cost of production. The government has assured all necessary aid and support to affected farmers. But the farmers we spoke to say procurement relaxation after unprecedented floods this year could have provided real relief. That support, they say, is missing. With Balaji Nirfal in Dharashiv, this is Santya for CNBC TV18.
And with that, it's a wrap on this special broadcast. Thank you for watching. More news and updates will continue right here on CNBC TV18.
"26 years of CNBC TV18. 26 years of CNBC TV18.
26 years ago, CNBC TV18 went live and India's markets were a completely different universe. Even as we complain about how this has been a tough year, why not take you back 26 years to tell you the shape, size, structure and returns over this incredible period. Let's take a look at the massive reset which has played out. Let's look at the size of the market itself to begin with. From under 5 lakh crores when CNBC TV18 started to now over 470 lakh crore rupees in market capitalization. It's been a 100-bagger over the last 26 years. The number of companies listed has also grown nearly 5 times in this period, as you can see up on your screen. A look at the growth in trading activity in cash markets, stunning. I mean, from about 1650 crores to about 1 lakh crore in terms of daily turnover. Perhaps the biggest structural change, the financialization of India. Mutual funds share in household savings has gone up. I mean, I found data for 2011-12 used to be about 0.9% to about 6% today. And of course, many believe that we're just about starting. From barely 20 lakh demat accounts in 1999 to more than 14 crore today. From almost no SIP culture, which is now the bedrock of all the money which is coming into the market. I mean, regularly 20,000 crores every month. This is a market no longer owned by institutions, at least only by institutions. It's a market owned by India's households. Let's go back to the Nifty 50. I mean, the OG before the Y2K hit, right? 50 names that told the story of old India. And the names, I don't know how many of those names you recognize. I mean, Oriental Bank of Commerce was there in the Nifty. There was IDBI Bank in the Nifty and so many others. I mean, PSUs, lots of refiners, etc., etc. And that has changed. IT, private banks beginning to rise. Old-timers, of course, would recognize some of the logos up there. Cut to today, only 17 survivors on the benchmark. Basically, out of the 50 in 99, only 17 are there in the Nifty 50. And Reliance and others on your screen now. Let's take a look at the average. What did the average mid-cap, small-cap, large-cap look like in 99 and what it looks like now? What I've done is taken the current definitions of large, mid and small for comparison's sake. Top 100 is large, next 150 is mid, and everything 250 first onwards is small. In 99, the top 100 companies made up 87% of total NSE. Today, that number is 60%. The largest stock used to be HUL with a market cap of 50,000 crores. Reliance, of course, 3-month ended average market cap November is 19.5 lakh crores. For Reliance. Mid-caps make 20% of NSE now, while back then they were about 9% of the NSE. The largest mid-cap used to be Gujarat Gas, 800 crore market cap. The largest mid-cap today is 125 times that by current definition, DRL, worth 1 lakh crore in market capitalization. Small caps now make up 20% of the NSE today. Guess what they were? 4% back, with the largest small cap being Foseco India, 150 crores in market capitalization. Today, ACC with 35,000 crores in market cap is the largest small cap. Markets ultimately follow earnings, and India's earnings story tells you why maybe this bull market has legs. And I've just divided this into phases. Between F505 and F510, EPS grew 11%. CAGR. Then came almost like a lost decade, F510 to F515, just 3% earnings growth. And of course, I mean, followed by about 6% from F515 to F520. And of course, I mean, COVID hit 20 to 25. We've seen a CAGR of about 20%. This is the strongest earnings phase we've had in about 2 decades or so. I will end with, of course, asset class return stable over the long term. As you will see, equities have delivered. The Nifty has compounded at about 12% for 26 years. It's beaten gold, beaten bonds, and every other traditional asset class. So that's the last 26 years. Joining me now to talk about the next 26. My job was easy. I just had to document, but I mean, their job is going to be slightly tougher. Madhu Khela, Nilesh Shah, and Navneet Munot. Gentlemen, great to have all of you here. And thank you very much for being part of the CNBC TV18 journey. I want to especially thank all of you. I was saying this earlier, viewers turn to us for advice, and of course, we turn to you. And you always oblige, so thank you.
Thank you. Many congratulations to CNBC family.
Thanks very much, Navneet.
Congratulations, Prashant, again to all of you. What a splendid job you guys have done to bring so much awareness and attract so many retail investors to be part of this journey. Yeah. And I hope this continues for the next 26 years.
And you know, we kind of sometimes quibble and complain, but sometimes history helps, right? Historical facts kind of help to calm the mind that equities, as I said, have done well. over a very long period of time, even if, I mean, it's been a tough year so far in 2025. So just wanted your reflections first up, your one or two learnings, if I can start with that, and then we'll look ahead in terms of what the market may look like. Nilesh bhai, why don't I start with you?
So, 26 years ago, we were far more circumspect, and we were always looking east or west to figure out what will happen in India. The FPI activity was tracked very seriously. Their word was taken as gospel. Today, a lot of things have changed. We are far more confident. We do track east and west, but our markets are driven far more by domestic flows. The fear of FPI has gone. The confidence has come back. And hopefully, over next 26 years, this journey will just continue to expand. People will move from short-term to long-term, from speculation to investment, and indeed create their financial security.
You think the flows are here to stay? Local, I mean, I mentioned some of the numbers. Shift of household savings into financial assets like equity. Do you think it's just starting? How do you think about it, Nilesh bhai?
Yes, sorry. So, प्रशांत भाई मतलब एक शेयर ढूंढने की कोशिश कर रहा था, कुछ इस तरह है कि मेरी ख्वाहिश कुछ ऐसी निकली, but जितनी निकली कम निकली. Obviously, it's far better. But the reality is that when we look back, we all feel proud. 5 crore investors, 80 lakh crore AUM, real return to the investors. Urban, semi-urban, rural, upper class, middle class, lower class, everywhere we are there. And we legitimately think mutual funds sahi hai. But when I look at the potential, we have barely scratched the surface. Despite the excess, have I reached to the common man? The total investment in mutual fund will be about 25 to 30 lakh crore. Rest is mark-to-market gain. This is less than the currency notes in circulation. I am unable to convince an average Indian that currency notes will not give you return. Your financial security will come by investing appropriately. That journey of converting an average Indian from a good saver to good investor, we have taken few steps, but अरमा बहुत आगे है, ख्वाहिश है बहुत दूर है.
और अभी तो शुरुआत है.
And ये तो शुरुआत है.
Madhu bhai, tell us a little bit about.
So one of the biggest reflections, Prashant, if I look back my own journey or journey of capital market even 26 years back, are the real possibilities in financial markets. As Rakesh Bhaiya used to say, highs are much higher than what we can imagine in the markets. At least I would have not been able to emphasize that the market cap as a whole will go up 150x in matter of 26 years. And there will be companies which will go up like 100x, 200x, 500x, even 1000x in this time frame. So I think if you just step back and if you think that those are the possibilities which are there. So the mood question today is, are we done? Are those possibilities still exist for the next 26 years? So I would say with conviction that those possibilities very much exist. Otherwise, what happens, and we are seeing that, what is happening in America, only on the AI field in the last 5 years is kind of demonstrating कि market कभी बूढ़े नहीं होते हैं. लोग बूढ़े हो जाते हैं, और markets कभी बूढ़े नहीं होते हैं. And those opportunities and possibilities exist. So one of the key lessons, at least for me, is when I look back, when I look for the next 26 years, is to really be able to capture the possibilities in the market. Right? You catch the right industry, which has got tremendous tailwinds, and within that, if you're lucky, if you can get the best entrepreneur, you're done.
Yeah.
Then you just have to sit tight.
You've given that example of internet as being the big wave and how much wealth that's created. And if you were positioned somewhere there in the right companies, I mean, you've made a tremendous
You
amount
made
of wealth.
tremendous clear. And the other thing which I would say, Prashant, is that, from a India perspective, let's say a lot of re-rating has happened. So if I may say that lazy investing, कि अपने पैसा डाल दिया और बढ़ जाएगा, maybe that era according to me, is over. Now it is time to really work hard. You have to be able to bet on companies or sectors where there is real earning growth, because that is what will get rewarded. You are seeing already in last 18 months, if you are a lazy investor, you have been actually been punished.
Easy discovery part is...
Yeah, actually been punished. In last 18 months, a lot of portfolios are down. So while India is story, India is happening, but it is not that you just put money and your money will be made. Last 5 years, post-COVID, that was the scenario. If you just invested in the market, you made money.
Correct.
But now is the time you have to be able to bet on right companies, right. And the third point which I would like to put, I travel a lot. The real thing, Prashant, which is happening in India is entrepreneurship. I see, come from a small place like Raipur. I was just telling, there are 5 companies which will be making more than 1,000 crore profit in a place like Raipur. And we have companies at 25,000 crore market cap, one company each. So the real entrepreneurship is actually happening. So the opportunities are really phenomenal, and they are happening in
And
tier
for
2,
viewers
tier
who are
3.
watching, all that will be captured in public markets eventually.
It will get, it is getting captured. The fact that, every day there one new company is getting listed, and there is so much fancy about these new companies listing, a lot of it is coming.
And the coming of age of venture capital and private equity industry will also play a very big role in increasing that momentum. Now you have, like, as he talked about, like a lot of companies in a small town or in variety of sectors which are small today. There are private equity and venture capital guys investing today, and over a period of time, we have a beautiful public market where several of them will see a listing.
Just to take off Madhubhai's point, Navneet, in terms of what he said, right? Easy discoveries happen. And I think that discovery, and also, by the way, not just easy valuations have been, I mean, everything is priced in a way because there's so much money which has come in. So the investable universe has been discovered, discovered 2x, 3x. So, it's kind of gone up. So,
Can I counter that before you complete that?
Please.
So you showed a lot of those companies, and you go back in every bull market. Actually, 99 was a roaring bull market, and we saw a big crash in 2000. Market was sideways for next 3 years. We saw a big crash in 2008, 2013, 2020. Even if you invested in the right companies, at the peak of the market, several of them have multiplied money many times. So in late 90s, as I said, when you started, at the peak of the market, there are so many companies in the Nifty which have multiplied money over a period of time. India is a stock picker's paradise. I think what you need to keep a close eye is on finding the right business, right management.
So which means, does it have any implications for viewers who are watching in terms of how do you own India? You own the Nifty. I mean, is there any...
That's one of the ways, but if you look at the funds...
But as he's saying, that maybe you got to be more... I mean, I think what I'm taking away is you got to be more active. You got to be more...
No, not active. You have to be alert. What I'm saying you is that in the last 12, 18 months, and these guys, they manage multiple billions of dollars, so they will vouch even better. That just saying that I've invested is not making money. To be able to pick the right sector, within that to be able to pick the right companies is what is making money.
And that's why several funds have multiplied much more than what Nifty has multiplied.
Exactly.
And that's the reason. You talked about some of the names which don't exist, avoiding them, and there are many who have done very well.
You're quiet.
See, investor has a choice. There is a public transport bus available. There is a chauffeur-driven Mercedes available. It's up to them which they want to choose. If you use public transport bus like a Nifty index, yes, it will also reach the destination, maybe little late. The cost is little less. But if you want an experience, there is active fund management available. And हम लोग कितना charge करते हैं? 25 paisa, 30 paisa, 50 paisa, 75 paisa.
Yeah.
Including distributors, advisory fees and commission, it is 1.5, 1.75.
Or a chauffeur-driven car.
Or a chauffeur-driven Mercedes, not a normal car. Luxury.
Yeah.
And we have seen in last 26 years when markets have gone X, funds have gone 2X, 5X, 10X, 20X. Choice is yours. But at least please sit in the car so that you reach your destination. You need to be financially secured. Our parents' generation, we were their retirement solution. We may think we have done a good job, their opinion could be different. But why should you become a liability on your kids? please secure your financial freedom. Whether you choose index fund, whether you choose active fund, your choice. But please sit in the...
1 minute, I just want to make one point again, learning out of 26 years, and I was just looking at data. Fixed income actually has given you 6.5% CAGR in last 26 years. Equities reinvested by dividend has given you 14.5%, right? If you reinvested the dividend. So this thing which is put in our head, that fixed income is the biggest security, to my mind is the biggest myth. Fixed income is not proven to be a fixed security. Bank deposits have not proven to be a security. Because see, if you have not been able to even beat inflation, what are we talking about? You have actually lost money by keeping money in the bank, in real sense.
Yep.
On the face of it, it may look like it is being safe. But if you look at what is see, there are two kinds of losses you make, Prashant. One is the financial loss, which is very easy to compute. The bigger loss, which is hidden, is the opportunity loss. What I'm trying to say, people have not realized what kind of opportunity they missed by saying that yes, because we have invested in bank deposit, we are safe. You calculate yourself. What would have happened if you invested 1 lakh rupee in equity 25 years back and you invested 1 lakh rupee in fixed income? It would have made difference of crores and crores of rupees.
Absolutely.
And it's an important point because life expenses, expectancy and expectations are increasing. And that's why you need to save more and save longer for...
Although I would say Nilesh Bhai will say that when he was managing the fixed income business, he beat equities. Huh?
But that was different time. That was 16%. In 2000, repo rate was 16%. And you were getting interest of maybe in peak of 2000, repo rate was 16%. At that time, you know, if your inflation was 6-7%, you're still making 17% in fixed income. That was great time to invest in fixed income. But now the pendulum has reversed.
I switched at the right time.
Exactly. As always.
I want to get to...
As always. He always at the right time.
26 years of CNBC TV18. 26 years of CNBC TV18.
This multi-asset funds, right? You think they make more and more sense? It's been a year where multi-asset has done very well. Although Madhubhai is saying that maybe multi-asset, I don't know if what you said.
I am saying, Prashant, the multi-asset will do well, but you will need to be alert. I am just saying, don't be a lazy investor. That's all I am saying.
I want your perspective. For viewers who are watching in an actionable way, I mean, pure equity versus a multi-asset kind of a product, from here on, what's your sense?
So it all depends upon your risk-return profile and your investment objective. If you can do allocation on your own, then you can choose between equity, debt and precious metal on your own. If you don't want to do asset allocation, then give that responsibility to the fund manager. They will decide between debt, equity and precious metal. Now, last year, precious metal has done exceptionally well, and which is why multi-asset allocation funds have outperformed equity. But that's not the reason to invest. You are investing because you believe fund manager will do a better job in terms of asset allocation.
I just feel awareness about these kind of multi-asset kind of funds have also really taken off in the last 2 years, 2.5, 3 years or so, right?
Whenever performance comes, awareness goes up. We want the other way around.
Navneet?
No, the last thing one should chase is like the recent performance
fad or
of
whatever.
any sector or theme or particular asset class. And that's why we always advise investors to have a proper asset allocation in place. It's very important.
Whether you do it yourself or you hand it over
to the fund manager. And we have the best products in the industry. As an industry, we have come out with many hybrid funds, many asset allocation products where investors can put money in the one fund and get all the asset classes exposure.
Let's talk about themes as we look forward. Big, I'm not asking for specifics, but big themes. Where, I mean, this is the set you should focus on.
Prashant, I will only talk about one thing. We are talking about 25 years, right?
Not necessarily 25.
But no, I'm saying 25 years. But we are talking about a larger context.
Correct.
What can really change?
Correct.
So I think this then let me make a distinction. When I talk about AI, I'm not talking about investing in AI companies. I'm actually bearish on a lot of the American AI companies because I feel in the short term there is a clear bubble out there. You know, in the long run, they may still do well, but in the short term, I clearly see a bubble. But AI usage is going to transform many companies, many industries, many entrepreneurs. So if we can really identify companies where AI usage is going to either scale up their business or going to bring in efficiency, I think that's a real game changer. So on one hand, if you have pricing power, which you don't have to actually pass on to consumer, and let's not fool ourselves that it is available to whole world. Yes, everything is available to the whole world, but there will be people who will be early adopters. There will be people who will move in early and they will encash on this opportunity over the next 3-5 years. And I'm really, really bullish. We are actually working on this theme that wherever, and this is where you will get real multipliers. So this is one thing, AI usage.
But the way it will translate is basically productivity goes up, margins improve, and
and also the scale goes up. Because of the AI usage, the scale goes up.
Sure. Any sector in particular?
It happened in the internet boom in 90s. The world invested in fiber and internet capacity, but India was the biggest beneficiary. Several of the companies benefited so much from the internet, apart from the IT services companies, and now you are seeing a new set of companies which are building on the digital public infrastructure and ubiquitous broadband.
But just to narrow that point, Madhubhai,
financial stocks. For instance, detecting fraud was such a big issue for last 25 years in the financial companies. Now you see all the major banks are actually starting to use AI to detect fraud because these are same patterns which gets followed up, right? So maybe financial stocks come, and there will be companies which will still go back and say, "Theek hai, dekhte hain, karte hain," and there will be companies which will be very aggressive. And you are seeing what is happening in AI usage in China. So it is not like we are living in some other world. If you just see what has happened in China and just watch companies which are aggressively adopting those usage only in financial sector, I think there's a lot of money to be made.
You can kind of make that case here. Nilesh bhai, big theme.
So apart from what Madhubhai said, companies